You get water vapor. Water vapor, what happens when it's really cold? Well, it freezes. It freezes gauges, knobs, uninsulated pipelines, wind turbine blades. Everything just kind of froze up. By the way, it is not quite over for the electricity side. Electricity is something we don't think about, guys. There were still trades being done yesterday in the thousands of dollars per megawatt hour. Put that in perspective, it would normally be about $70 for a megawatt hour if you wanted to buy electricity on the open market. There were still trades done at, a couple thousand or 7,000 per megawatt hour. Now, who has to eat that? If you're wondering, who's paying that? Okay, there's a couple companies you want to watch, one here, one in Germany. NRG, ticker NRG, by the way, New Jersey-based company, but has the naming rights of the Houston Stadium. That stock down 12% this week because concerned they have to go out in the open market to pay these prices to continue to supply power. And RWE, that is a name that's probably unfamiliar to a lot of us. It is Germany's largest power producer. They're actually a big wind farm owner in Texas. A lot of their wind farms were knocked out, and last night or yesterday they warned that they're going to have low to mid triple-digit million euro hits to earnings because also, guys, they had to go out in the open market in trading and buy and pay these prices. It can't pass, Andrew. I hope these prices onto their consumer. You'd literally have an electric bill that could be $10,000 a month or something like that. And I'm not exaggerating. So someone's going to have to eat that. And coming up in 7:15, I'll tell you about a new report that shows that ERCOT was minutes or even seconds away from a meltdown so catastrophic, the blackout could have lasted a month.
Wow. Wow. Thank you, Brian. Sounds like it would be cheaper just to maybe fly to Cancun for a day.
Yeah, depends which class of service. Both classes, actually. I'm sure it is cheaper.
Okay, thanks. Becky?
Thanks, Andrew. When we come back, fallout from the pandemic, the impact on workers hasn't hit all population groups equally. We're going to talk about women in the workforce right after this. And later, former Aetna CEO Mark Bertolini will join us on the vaccine rollout. Also, a reminder, you can watch or listen to us live anytime on the CNBC app.
Critics of carbon trading worry that countries facing economic difficulties might be tempted to cheat, either by making their overall emissions cap too generous or using accounting tricks to overstate reductions. For example, a nation might reduce its carbon emissions by building a wind farm to replace a coal-fired power station. This would free up a portion of its carbon allowance, which could be sold to another country but might still count as a reduction in the first country's emissions, even though overall output hasn't changed. There are also fears that major polluters might relocate across borders to avoid signing up for a cap-and-trade scheme or finding a more lenient jurisdiction. Another criticism of carbon markets is that developed countries, which have done most of the polluting to date, are able to invest in low-carbon technology and have reorientated their economies to less carbon-intensive activities, unlike poorer nations.
Welcome back, everybody. A lot's been written about the pandemic forcing women out of the workforce because they have to take care of the kids. According to the Labor Department, about 275,000 women dropped out of the workforce just last month alone. Joining us right now to talk more about working mothers in the midst of a pandemic is Joanne Lublin. She's author and former management news editor at the Wall Street Journal. She's out with a new book this week that's called Power Moms: How Executive Mothers Navigate Work and Life. And Joanne, welcome. It's great to see you. Thanks for being with us.
Thanks for having me.
So this is something you've been following for a very long time, and now everybody else is paying close attention to as well because of the pandemic. When you start looking at Power Moms, I know you looked at different generations of mothers, kind of the boomers versus the Gen Xers. What have you found in terms of where we stand, I guess, over the course of a few decades?
Well, the biggest change is that we've got more supportive spouses out there, and we've got more supportive workplaces. And all that is making the burden of being a working mom with high ambitions for their families and their careers easier than it was for my generation of boomers.
I think people were feeling pretty good about that until recently, until what we saw with the pandemic. With schools shut down in so many locations, it's really kind of focused the fact that working moms have had to bear the brunt of most of that.
Yes, and that's why rather than calling this the she session, I think we should be calling it the mom session. The burden definitely has been hitting working moms a lot harder than working dads. There was a study that came out yesterday, and it found that among moms with kids under 18, 28% had temporarily or permanently left the workforce since last March versus 10% of such dads.
Wow. You think about the gains that women have made in recent decades, and you just wonder if that setback is going to be more than just a temporary issue, if this takes a long time to kind of work their way back from that.
I think for many women it will be a long road back, but luckily we're living in an era in which employers are more aware of the needs of working parents, men and women alike, and they get it. They know, particularly as we look ahead, if they want to attract and retain the best of the brightest, they need to be catering to their needs. And it seems to me that means more permanent arrangements for working from home, as we've already seen in recent weeks, like the announcement by Salesforce.
You know, part of what you do in your book, Joanne, is talk to some of the trailblazers, women who did this first, women like Carol Bartz, who went through this. I know you also spoke with Hershey CEO Michelle Buck and Mindy Grossman, and these are women who really pushed through at a time when workplaces weren't quite as accepting. What lessons did they offer in terms of things that we could all kind of learn from?
Well, I think it's really important to not only choose the right spouse and also to choose the right workplace, but it's equally important, these women learned, to have mentors and sponsors at critical stages of your career, men and women alike, but probably more so men because the guys are still in charge of most companies.
In terms of what the workplaces are doing right now, Joanne, is this a national movement that you think is going to be hard to ignore in terms of more flexibility, in terms of letting people go out on maternity leave, come back in, and not feel like they're punished for it?
Well, I think the national movement is one about this experiment about working from home. And because no one really thought that was practical, having proved that it works, I think is changing a lot of attitudes about other issues related to working parenthood. And so you have more companies, particularly bigger ones, offering paid parental leave irrespective of the gender status.
Joanne, I want to thank you for your time today. It's an issue we're going to be watching very closely as we continue through this pandemic, but we want to thank you and congratulations on the book.
Thanks, Becky.
Thank you. Andrew?
Okay. Thanks, Becky. Coming up on the other side of this break, we're going to talk about some of the tech names that are part of the work from home trade and whether they still have room to run. Those names right after this.
On to our podcast. You'll get interviews, original content, and behind-the-scenes access. Look for us on Apple Podcasts or on your favorite podcast app. And subscribe to Squawk Pod today.
We're ushering in the year of the ox. After an unprecedented year of turmoil, we'll look at what's ahead.
The U.S. is in recovery. The rest of the world is starting to catch up.
As China marks a major milestone.
The CCP goes into its 100th anniversary feeling very confident.
And will travel finally get back to normal?
In a normal year, you will see hundreds of million, maybe 200 million people out there on the move. But this year, probably only at 50%.
All that and more in our special year of the ox, Plowing On.
Real money.
Heat map right now, pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
So when I look at our online sales at $700 million, that's not dissimilar to the size of Coke. And so really comfortable with how we're going to market in that online space. The lowest cost of doing business in our industry. You know, you think about double the sales, you know, the JV business actually has double the sales per square metre of many of our competitors. So we're incredibly efficient in store, but also we recognise that customers want a different shopping journey. Some are online, some are in stores.
Welcome back to Squawk. Our next guest says millennial purchasing power and the potential stimulus packages are what's currently working. And joining us right now with some stocks that he likes based on that very premise is Tegus Wright, Chief Investment Officer of Decanter Capital Management, as well as a CNBC contributor. Good morning to you. So play this out. If that's the thesis, what are the stocks that you think are working right now, but also how you think about that in the context of whether we actually get a new stimulus package or not, and how big that package ultimately is?
Yeah, Andrew, great question. So the way I look at this, and we talk about millennial purchasing power, there's some companies that are really doing well because of the movement away from the ways we traditionally did things. Let's look at Square, for instance. And one of the things that Square has as a product is Cash App. A lot of things occurred over the last few days, particularly with the Robinhood trade. And some people are disgruntled with Robinhood. Cash App, I don't have this statistically, but anecdotally, Cash App picked up additional users. The reason why I like Square in that in this particular marketplace, they've been able to gain about over 60 million users in a period of about 8 years. It took JP Morgan 30 years, 5 acquisitions to get the same number of customers. So that's why we really like this. Square had a great quarter last quarter, came in about 12 cents EPS compared to a loss of 4 cents. So a 400% gain. Square is doing all the right things, has a really good commerce ecosystem. So that's one way,
here's the question.
one way you can play the... Yes.
On Square, how much room does it have to run, given we just showed a chart of this stock, which has been on its own run already?
Exactly. We have to look at the business model for Square. They have this ecosystem, and the ecosystem is really built on the entrepreneur, the business owner. We feel that this is a place that you really want to make a positive bet on the increasing business owners, because this allows Square to reach those customers. So we think that they have a long runway given their ecosystem. And they're doing something very unique in that they really work closely with their entrepreneurs. They actually have classes to really assist the entrepreneurs to be more successful. And this is really different from the typical bank interaction with entrepreneurs. So that's why I think Square is one of those companies that have a long runway based off their strategies.
Okay, what else do you like?
Yeah, so ultimately, we like Etsy. Becky was just talking about the working moms working from home. Well, Etsy is a platform, e-commerce platform that has, first of all, 90% of their sellers are working from home. Second, 80% of their sellers are women. So this company has done exceptionally well. Over the last year, EPS has gained over 247% from 2019 to now 2020. And Andrew, that runway, we feel that this type of e-commerce is the way to go, because you have a better connection now with the sellers and the buyers. Also, Etsy purchased Reverb, which is the musical instrument. Lastly, and you mentioned stimulus. Well, we feel that stimulus will happen. We don't know the exact numbers, but some things we like. CDW. CDW sells technology to local governments and schools. Well, what's going to happen with the stimulus package? You have money flowing to both the states and also money flowing to K through 12 and colleges. CDW stands to benefit from that, and they've been benefiting from that because more and more schools and governments have to depend on technology to deliver their educational platforms.
Okay, we got to leave it there. Davis, thank you. We will keep our eyes on all three of these stocks. All three of these stocks have moved already, and we will see whether they continue to move up, and we appreciate it. Thanks so much. Joe?
Thank you, Andrew, and happy birthday to you.
Oh, thank you.
It's only the beginning. Only the beginning. Coming up, that was only 1 hour. Well, these next 2 hours are going to really lay it on thick. Coming up, a huge lineup covering your way. Coming your way, covering the big stories of the day, including reaction to the Reddit hearings from former SEC Chair Jay Clayton, also a Citadel CEO Ken Griffin. Man of the hour coming up as we head to break. There's Arthur Brooks, Mark Bertolini, Joe Moglia. We'll get some picks from him. Maybe if he follows hoops that closely. Look at the S&P sectors that have lagged the most this week. Technology and healthcare, the two biggest losers. There you're watching Squawk Box on CNBC.
As the pandemic has unfolded, we've just seen this extra rapid pace of adoption of certain technology. Everybody had to think about grocery delivery, video conferencing, and telemedicine. E-commerce and video meetings are now part of the fabric of culture around the world. That's not going to change. At CNBC, we really remain committed to watching the data and bringing our readers and viewers the information that's most essential.
Stories and opportunities driving Wall Street and investors. Tyler Matheson, Melissa Lee, Kelly Evans, Power Lunch. Weeknights on CNBC.
The news cycle is racing along. We have to be checking every bit of it along the way, because one false narrative can change the course of how we respond to this pandemic. And we can't let that happen. we're going to do our dead level best to get it exactly right and never tell people how to think about it.
The GameStop saga taking center stage in Washington. We've got highlights from the hearing and reaction to what lawmakers learned. That's just minutes away. Power slowly returning to Texas, but the damage of this week's deep freeze could have a long-term impact on the nation's energy industry. We've got an update straight ahead. And with drugstores like CVS now getting access to vaccine doses, will it help the distribution bottleneck? We'll speak to former Aetna chairman and CEO Mark Bertolini. The second hour of Squawk Box begins right now.
Good morning and welcome back to Squawk Box right here on CNBC. I'm Andrew Ross Sorkin along with Becky Quick and Joe Kernan. Take a look at U.S. equity futures on this Friday morning, about 2.5 hours before the market opens. We will open higher, it looks right now, about 31 points higher on the Dow. S&P 500 up about 7.5 points, and the NASDAQ looking to open about 46 points higher. Becky?
Thanks, Andrew. Here's what's making headlines at this hour. Shares of Uber are falling in the pre-market trading after the UK's Supreme Court ruled that Uber's drivers are employees rather than freelance workers. That entitles them to full benefits. The court upheld an earlier ruling by an employment tribunal. This is the last ruling in those court systems, and that stock is off by about 2.5%. Roku shares are gaining ground this morning after the video streaming device maker reported an unexpected profit for the latest quarter. This happened as consumers stuck at home continued to seek out more video entertainment. Everybody's looking for things to do, looking for content. Right now, Roku shares up by about 3.4%. And Pfizer's COVID-19 vaccine was 85% effective after just the first dose, according to a study of Israeli healthcare workers that was published in the medical journal The Lancet. Pfizer's vaccine is designed to deliver maximum protection after 2 doses. But again, there are these questions being asked about whether the first doses should be given out to more people in order to get a broader number of people vaccinated. Joe?
Thanks, Beck. Yesterday's House Financial Services Committee hearing on the trading frenzy surrounding GameStop and other stocks taking center stage. Robinhood CEO spoke about his firm's role, while Citadel CEO Ken Griffin defended the Wall Street practice known as payment for order flow. Leslie Picker joins us now, and she's going to outline every single thing you need to know about yesterday's hearing. Is that correct, Leslie? Yes or no?
In
Is that
just
correct?
1 minute time.
Yes or no? Yes or no, Leslie? Are you going to do that?
It's actually a more complicated answer.
Yes or no?
It's a more complicated answer than that.
Yes or no? Yes
or no? Are you a cat, Joe? Are you a cat?
I am not a cat. If I'm anything, I'm a dog.
Okay, good.
And I don't mean it that way. I love dogs.
At least we've learned something this morning. Now, to your point, after yesterday's House Financial Services hearing, very long hearing, many are now asking, okay, so what comes next here? Chairwoman Maxine Waters noted there will be 2 follow-up hearings, one with market experts and investor advocates, another with regulators like the SEC and FINRA. The big question mark, though, is whether lawmakers will pursue additional regulation regulation based on what they learned yesterday. There was plenty of talk about things like conflicts of interest, the incentive structure on both the front and the back end of trading, payment for order flow, like Joe was just talking about, as well as whether the current market structure adequately protects retail investors. But for those who stayed to the very, very end, Representative Waters offered a pretty strong reflection on the testimony.
I'm more concerned than ever that retail investors are being fleeced and massive market makers like Citadel may pose a systemic threat to the entire system. The committee is going to continue to examine these issues.
Okay, so the word systemic threat, pretty strong words there. I'm hoping that Ken Griffin answers to those comments next hour when you all interview him. He did testify that his firm handles more than 40% of all retail volume. Griffin also received a large swath of questions about that payment for order flow or how market makers pay brokerage firms to handle trade execution. For his part, Griffin actually suggested more regulatory action that would enable public exchanges to better compete with off-exchange venues like Citadel Securities, guys.
Okay. Thank you, Leslie, for all of that. For reaction to yesterday's hearing, we are joined by Jay Clayton, former SEC chairman, CNBC contributor as of yesterday, Apollo's lead independent director. And I want to ask you about that in just a moment, Jay. But let's start with this hearing. And we're going to have Ken Griffin on a little bit later. So I'd love to get your thoughts on this issue of payment for order flow, which seemed to be so central to this hearing and to these issues that are being brought to bear. Do you think payment for order flow is a good thing or a bad thing?
Well, Joe will laugh at my first two answers. So first one is happy birthday. And then the second one is, it's more complicated than that, right? but is... Why is payment for order flow part of the system here, and why has it been allowed? And look, what we're trying to do is drive competition, transparency, and resiliency in this system. And one way to drive competition that the SEC has looked at and should continue to look at. And I thought this was a terrific hearing because it brought to bear a lot of these issues. It is through payment for order flow. And at the end of the day, does that practice drive better execution, lower overall cost for the retail investor is a good question. The answer has been that we think so. But as the ecosystem changes, and I think you're going to ask Ken this, what do we do to continue to increase competition, to put the exchanges on a better foot? We have to look at this practice as well, and I expect the SEC will do it, and I expect that Congress will continue to ask them to do it.
Jay, you said just now that you think that there is better pricing. I don't know if it's the prevailing wisdom, but the narrative is that because retail investors aren't paying commissions, they're paying in another way through payment for order flow, and therefore are getting worse execution. Do you think that's right or wrong?
Well, let's start with the premise that liquidity is not free. Okay, to trade, there has to be some kind of payment. It's not free, and it's not free for lots of reasons, including we have to build up an entire ecosystem that is resilient. One of the things that was focused on at yesterday's hearing is how resilient is the system? Are there systemic risks, et cetera? You have to have a resilient system that costs money. Liquidity isn't free. People take risks to provide liquidity. So there is some cost. The question is, how are we measuring that cost and where it gets paid? And are people aware of the cost that they are paying? They should be. They should be aware of the cost they're paying. They should be aware of how much payment for order flow may actually change their execution, if at all. Now, how we measure it today, and this came out in the hearing, how we measure it today is against, the term price improvement came out. And price improvement is how much better did you do than either the end of the bid-ask spread. And we measure that against that bid-ask spread. And that is published. I'm being a little bit technical here, but that is published on the lit exchanges, for 100 share lots. There's a lot that we should look at as to whether that is the right yardstick for measuring price improvement and best execution, including whether we continue to have 100-share lots or we go to smaller lots for higher price stocks. Now, I've just said a lot there, Andrew, but all of that came out during yesterday's hearing, and I expect Joe Muglia and Ken to comment on that and the types of improvements that we should be making to improve competition while maintaining resilience in the market.
Hey, Jay, it's Joe, and please do not give me just a yes or no answer. I want to hear what you really think in terms of nuances. So don't limit it to just yes or no. Last time you were on, we were sort of still in the middle of the frenzy, and we used the term pump and dump and just raised the. We used it just to say, is this similar? Is it akin? Is it a pump and dump 2.0? Is it a pump and dump with a social media component? Now we can look at a chart of GameStop, and you've seen it. I mean, does this, in your view, represent a modern day pump and dump using social media?
Wow, you know what? I will give you a yes or no answer. The quick answer to that is no. I don't think so. Based on what I've seen, I think the SEC is going to take a look at it. Whether there was any kind of coordinated behavior to manipulate or not, they will be looking at that. But as you look at that, the overall participation in this, it was fairly transparent what was going on here, Joe. And I think you saw that in yesterday's hearing. And actually, I must admit to being entertained by Mr. Kitty. You saw that people were very transparent about what they were doing and why they were doing it, which was fairly interesting.
You get on a chat room and you pick a stock and you get all of your friends all to act on it at the same time. And how is that different than what we would have seen with an iOmega or a Press Tech or any of the names from the past, or things that we saw Stratton Oakmont try to do from time? I don't see how it's different, Jay.
Well, look, I think in the abstract, you make a good argument that it's not different, and that a group of people decide that they like this, but whether they got all together and did it like the Stratton Oakmont did, knowing that knowing the end game here, I don't think so. I thought there was a great comment yesterday about markets being self-correcting, and let's not lose sight of the fact that there were retail investors here who lost money, and they lost a lot of money. When you see something like this, you should not be participating in it, as a retail investor, unless you understand the risks that you're taking and are able to lose the money that you're putting in. And in particular, Joe, I just want to point out, I thought something very good about yesterday that you were talking about was options and margin, and what type of qualifications that you need to buy stock on margin and to use options to effectively use leverage in your portfolio. You just hate to see that for any kind of retail investor that doesn't understand those risks.
Hey, Jay, one thing that I've been thinking a lot about and kind of going through again and again in my head is just these potential conflicts of interest. Every time Vlad talks about protecting his customers, you got to remember the retail investor is not his customer. They're not paying him anything. They're his users. His customers are the ones who are paying for the order flow, which gets me back to the order flow again. And I know it's complicated, but is the order flow worth more to these other firms than just the idea of being able to wrap it all up for volume and make some money off the top? Is there the potential for getting a look at what's happening with the retail flow that could help them with other trades? Do you think that conflict exists?
Look, I think you're framing the question the right way, which is we now have, and I want to say I'm happy to see more retail participation. I just talked about making sure that the retail participation is educated and in the right place. I'm happy to have more retail participation, but we have a new flow in the marketplace, and that is all of these retail orders. And payment for order flow for them clearly is something that's central to the Robinhood business model, and they've done very well with it. I think we should be looking at whether we can bring competition to that transparency to that so that cost is no more than it should be at the end of the day for the retail investor, if we're going to continue to allow payment for order flow.
Jay, do you think if we dug into the numbers, if Citadel made all of its numbers public and Robinhood made all of its numbers public, and you could actually demonstrably measure the pricing impact, that you would find that investors or retail investors were getting a great deal or were getting fleeced?
I think what you have to do, Andrew, here is measure this over time. And I think that if you ask people, if you look over the last decade, are retail investors getting better execution? Is the cost of liquidity lower? Undoubtedly, yes. But can it be improved? I think undoubtedly yes, because it has been improved, so much improved over time, and we need to keep asking questions like this to see if indeed we can bring down the cost of trading further. So the answer to your question is I'm sure there's room for improvement through different transparency, and I think Ken Griffin as much as said that yesterday.
Jay, before we let you go, you were appointed as the lead director at Apollo this after Leon Black stepping down as CEO, but he will remain chairman. And I'm hoping you could just speak for a second about the governance issues there, his decision to step down from the CEO role, but to remain at the company, and what that may mean or not.
Well, I'm excited they're committed to moving from a founder governance system to what I would say is a more traditional shareholder-oriented governance system. And I'm excited to be part of building out the board of directors and executing on those moves. So it's going to be very interesting. I'm looking forward to it. And back to civilian life.
Okay. Well, we'll talk hopefully more about all of this with you in the future. And I should also mention I'll be speaking with Jay again next Tuesday alongside Robinhood CEO Vlad Tenev at the Dealbook DC Policy Project event. And I'll also be speaking with Janet Yellen and Steve Ballmer, Ed Bastian, and so many others, Mitt Romney, which we'll all be highlighting right here on CNBC over the next couple of days, Monday and Tuesday. Becky?
Thanks, Andrew. When we come back, the deep freeze may be receding in Texas, but the damage has been done. We've got an update on when the lights and water will be back on in Texas. That's coming up next. Also, a reminder to stick with Squawk Box this morning. Citadel's Ken Griffin will be joining us live in the 8 o'clock hour to talk about yesterday's questioning at the hearing and much more. Before we head to the break, though, let's get a check on the markets this morning. Right now, it looks like the Dow's indicated up by about 52 weeks. Dow is slightly up for the week at this point, so this would push it over the finish line with that. S&P indicated up by about 10 points this morning. The NASDAQ indicated up by 57. Squawk Box will be right back.
Managing Asia, the man running Singapore's largest supermarket chain, FairPrice Group.
Before DORS gone orange, we could already see, the build-up of crowd at our stores. They were buying like there's no tomorrow. We are managing stockpile, covering a few key categories. We have had to review and rethink many of our strategies.
Sia Kian Peng, CEO of FairPrice Group, on the next Managing Asia.
Welcome to the closing bell.
It's the most important hour of the trading day.
We've got just about 36 minutes left to go in today's trade. We are seeing strength overall.
When stocks move, when volume spikes.
Is that suggesting that we think GDP is going to be strong next year?
Keeping you on the leading edge of what's driving the markets.
Many Americans are in desperate need of relief.
Minute by minute.
Partial recovery of what we lost yesterday.
Wilfred Frost, Sarah Eisen. Closing bell. Weeknights on CNBC.
Texas is looking forward to the weekend. Temperatures there expected to reach the 50s, hopefully, and 60s, but the damage has been done, and the story finally coming out about just how much worse it could have been. Hearts go out, Brian. I mean, on top of the pandemic and masks and quarantining and everything else, and then this. It's like Job or something for those poor people in that state.
And Hurricane Harvey and the year before that as well. If it's not floods, it's freezing. It's certainly been a tough time for our friends and all the friends and CBC viewers down in Texas. Now, listen, Joe, as bad as it was, I mean, and it was bad, okay? Millions of homes without power, 10+ million people without water, at least for a day or so. It could have been much worse. This is not my story. I want to be clear. This is Erin Douglas at Texas Tribune. Shout out to her. Great reporting on that. I tweeted out the story. Check it out, okay? That report in the Texas Tribune saying that ERCOT says that it was minutes or even seconds away from a more catastrophic meltdown of the entire grid that could have resulted in month or month-long blackouts, okay? According to the Texas Tribune, what happened is this. ERCOT noticed that power levels were falling rapidly at the same time that demand was soaring, right? Most people in Texas use electricity, not gas, for their heat. They're cranking the heat because it's freezing. That supply gap between demand and supply widened to dangerous levels. So in order to prevent something worse happening, ERCOT, the grid operators, had to start cutting back to industrial customers. When that didn't work, start rolling blackouts to provide or prevent a total meltdown, because surges, if it all goes from, if two power plants are sharing the load, one goes down, all the demand suddenly goes to others. It could result in explosions, fires, other damage like down lines, wires, whatever it might be. And if that would happen, it could have resulted, according to the article in the Tribune, in a month-long or longer blackouts or rolling blackouts, which is absolutely terrifying to think about. So as much heat as ERCOT got for their handling of this, it sort of suggested that as bad as it was, them doing some of these rolling blackouts, and as painful as it was for so many families, might have prevented an even greater crisis. Now you say Texas couldn't get help because, as we know, Texas mostly has its own grid, but also there is an ability to get some power, guys, from other places, states, and Mexico, but they were also getting crushed by the storm. They had 13 states and all lost power, so they had no power to share as well. So very, very close to something worse, as bad as it was. A lot of talk, Joe, about where this is going to go in the weeks, months, and years ahead, if anywhere differently, because it was a terrifying situation, and 21 people, as we know, lost their lives.
I just wonder what changes are planned, what's necessary. What do you think, Brian? What are they proposing?
Well, one thing Governor Abbott apparently is asking, or has asked, the state legislature to make a rule that requires the wind turbine companies to buy or upgrade to winterized turbines. They have heaters, they've got carbon fiber blades, de-icing mechanisms as well. That is one thing they may try to do, is require it, versus in the past been a lot of recommendations. Maybe the same goes with pipelines. What we've learned is the third huge freeze in 30 years. It's not often, but every 10 years you can't be losing power to a couple million people. We'll see if they make any of those changes.
Thanks, Brian. Andrew.
Thank you.
Okay, we've got a lot coming up. We're going to talk free and fair markets and the reaction to yesterday's hearings with Harvard's Arthur Brooks in just a little bit. And then we're going to speak to former Aetna CEO Mark Bertolini. Right back after this.
Time now for today's Aflac trivia question.
Okay, Google, I want to talk to CNBC about the news.
Topping our headlines this hour.
The Google Assistant's ready to chat. See what stocks are trading at.
The stock is trading at $41.
Market updates. Where's the Dow? A cool way to check CNBC now.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
is that of the 1.3 million Australians who either lost their jobs or saw their working hours reduced to zero, 90% of those are now back at work.
We are optimistic. The fiscal stimulus and investment will be boosting our demand.
We have already several quarters of contraction, so I hope that we could see some encouraging growth.
We are not going back to the pre-COVID world in terms of quality, while we may get back there in terms of quantity by the end of this year.
Foreign tourism will be coming a little bit late that we expected earlier.
A big part of resuming travel would be to get standardized procedures.
Life insurance in Asia continue to be strong, and then some of these structural trends have been accelerated.
Working from home has been so much accepted in Japan. Some industries are booming, so they can absorb jobless people.
It's a big morning on Squawk Box after yesterday's hearing. I want to get to Dom Chu, who's looking at some of the big surprises of the morning. Dom.
Happy birthday! Happy birthday!
Who knew? These are my kids. Hi, Henry, Max, and Sydney. And you're over there. This is unbelievable. Thank you for the birthday wishes. This is a true surprise. I did not know this was coming.
I made you a gift at school yesterday. I made you a gift yesterday at home.
Thank you, guys. I love you so much. That's so nice of you. And I'm going to kill the producers who are allowing this to happen, but I'm very appreciative. Thank you. Guys, what's funny is I can actually go see you in a minute, and I will. I don't know what to say. Thank you, thank you. You guys have been coming on over the years. This is like Joe's kids and Becky's kids over the years. This is, we're all growing up together. So thank you. It's funny because my mother sent me an email last night. She said, "Are the kids going to be on TV? Should I wake up and watch?" And I said, "No, I don't know anything about that. I don't think so." And she clearly knew more than I did. So
we kept it a secret because
it's all becoming clear to me. Are you in the same house?
We're not going on the show. Yeah. Yeah.
Yes,
I'm adding things up here.
They tricked you.
You're in the same house.
Good secret keeping, guys. Well done.
But what?
Well,
I think they
love
should
you
have
guys.
crashed the set. Crash.
They could have crashed the set.
Where you
are.
You
guys could have crashed the set.
Go down.
We didn't want
to
scare
Zoom
you.
and
Then it wouldn't be a surprise.
You guys did very well.
That's true. It wouldn't be a surprise. Well, you can still do it. We have time.
We're living in a new Zoom world. Who knew?
Yeah, but you're in the same. You're zooming in the same house. That's weird.
Get down there. Hold on. Here they come. Here they come. Guys, come on, real quick. Are they coming? I don't know.
God, they were like literally feet away.
No, they're not feet away.
No, they moved. They moved on.
Hold on. Here they come. Here, come on over.
Hello.
Okay, guys. The whole troop is here.
That's better.
That's
okay.
Better. That's much better.
Hi, Sydney.
Oh, wow.
Bye.
Sydney, you want to say hey?
Oh, it's nice to see you guys.
Henry, get in the camera. Okay, well, we're
Henry, Max,
we gotta
I see
go.
everybody.
We'll be back after this. Bye.
Divided by distance, united by business.
This is the new reality we're all
Helping you navigate the new normal. Squawk Box on CNBC.
She's a courageous corporate strategist.
She had a very high ambition and drive to succeed.
Fearless philanthropist.
To give such a transformative gift is incredible.
And Grammy-nominated musician.
Music is what I am. Everything else is what I do.
Defying all convention.
I've broken boundaries because I didn't know they existed.
The brave ones. Chandrika Tandon on CNBC.
Coming up on Monday, we have a very special interview for you. Probably the greatest rapper of all time, songwriter, record producer, businessman, hip-hop's first billionaire. He's got entertainment labels, clothing lines, alcohol brands, all kinds of things, including a music streaming service, Tidal. We're going to get to talk to Sean Jay-Z Carter. Make sure you tune in on Monday morning for that exclusive interview. Still to come this morning, Pfizer's COVID-19 vaccine was 85% effective after just the first dose, according to a study of Israeli healthcare workers that was published in the Lancet Medical Journal. Former Aetna chairman and CEO Mark Bertolini will join us to talk about vaccine distribution and clearing up the bottlenecks in the system. And later, Citadel founder and CEO Ken Griffin will join us in his first interview since yesterday's hearing on the GameStop saga. That's coming up in the next hour. Squawk Box will be right back.
The internet has become a critical need at this time. Demand for data services has really picked up, and the acceleration of digital adoption in this country has been tremendous. Our message is that Globe is here to stand with them so that we can take them through this crisis. That's why we take care not only of their internet or connectivity requirements, we also take a look at their physical and mental health. We've done a lot of partnerships so that there will be more support for our customers in making them aware how they can cope. Content is really important. Looking into the future, we're going to do a lot of co-creation. And it's an opportunity to showcase the different facets of our brand and even our sustainable practices, Globe of Good. And that there's more than just the commercial aspect to this business.
Missed the show? Don't sweat it. The Halftime Report now has a podcast. Market-moving interviews, call of the day, unusual activity, and of course, Ask Halftime. Look for us on Apple Podcast or your favorite podcasting app and subscribe to the Halftime Pod today.
So it's ironic that the people who are criticizing brokerage firms because they pause trading, which they sometimes have to do to comply with regulations, these same folks are now saying, we need to respond to this with more regulations. I would say if people don't like brokers occasionally having to pause trading, I'd suggest they look at the regulations that required it. At some point, we need to recognize that piling on more and more regulations only increases complexity and does not help investors.
That, if you don't know, is Congressman Barry Loudermilk. He's a Republican from Georgia. And it was at yesterday's hearing on the GameStop saga. Joining us to discuss whether there's a need for federal regulation, Arthur Brooks, AEI President Emeritus. He's also with Harvard University. He's also a contributing writer with The Atlantic and a host of the podcast, The Art of Happiness, with Arthur Brooks. Thanks for joining us, my friend. And before you became kind of the Archbishop of, like a secular Billy Graham. I'm trying to have a secular Billy Graham for all of us. What are you exactly now? But before all that, you wrote eloquently and thought very deeply about conservatism and capitalism. Not necessarily conservatism, but maybe more libertarian, more small government, personal freedom. All that brings, I guess, in your view, self-actualization and maximizing your potential. Have I got that right?
Yeah, you got that right. I mean, in point of fact, the only reason that I care about, I guess, conservative principles, but the things that the three of you have always talked about and care about together, is that globalization and free trade and the American-style free enterprise system has pulled 2 billion of our brothers and sisters out of poverty over the last few decades and can pull more billions out of poverty as well. So if you care about poverty and you care about dignity and you care about brotherhood and you care about love, then you actually need systems that are going to give people equal opportunity. And the free enterprise system is the best system that's ever done it and the best system that I think that ever will.
But we're going to talk GameStop, but in fact, it's so eye-opening, a lot of the things that you wrote, that a young Andrew Ross Sorkin, and I'm talking green behind the ears, and this is years ago, because it's his birthday today, Arthur. I know you know that. He's an old man now. But remember, I paid him $1 a page to read one of your books, just to expand things. And then he charged me for the index and the appendage and all those things. He charged me $1 for all those.
Because he's a capitalist, Andrew. I just admire that.
He is. He is, and he's kind of an elderly capitalist after today. But
well, he's still got his hair. With that kind of hair, I could be president. That's unbelievable.
Right. I know he's lucky. Both of us are envious of that, but you don't do anything about it. No, mine's real. Hey, Arthur, get to what is the lessons we learned about free markets, capitalism, all the things that you opine about. Watching that hearing yesterday and the whole saga, how do you view it, and what needs to be done, if anything?
Well, I see a lot of sort of irony and hypocrisy, particularly when I'm watching a congressional hearing about trying to protect the little guy from himself or herself. I mean, the idea that the democratization of the tools of capitalism and letting people make their own market decisions can lead to really bad outcomes. And I'll take them seriously when government stops selling lottery tickets that have an expected value of 40 cents on the dollar. It seems to me that these government officials don't like predation unless they're the predators against the little guy. So, I mean, I take it with a huge grain of salt, quite frankly.
The remedy would be what? I assume that you don't think we need to immediately start pulling the regulatory cards out and dealing them all over the place in terms of the financial markets. But was everything that happened okay?
Yeah, no. I mean, it's what you see is a whole lot of people actually posturing to show how much they care, and there's a whole lot that we don't know. So to begin with, I think it's a reasonable thing to say that until we understand the nature of whether markets were manipulated and what laws were broken, it's a pretty good idea to try to put new regulatory ideas on pause. But if you're actually posturing to show how much you care, of course, then you're going to get the cart before the horse, and that's exactly what was going on yesterday.
The way Wall Street is viewed, do we need to do anything with that, Arthur? Where did Wall Street go wrong? Where did capitalism, which Wall Street is kind of a proxy for, when did it go? Did it go off track, just PR-wise, or are there serious problems that engender a lot of populist feelings against the whole system?
Well, capitalism has to protect itself every generation because the free enterprise system brings incredible wealth and opportunity and growth and good lives to people, but it's counterintuitive. I mean, the whole idea that everybody can win is a very counterintuitive notion. It goes against literally how the human brain is wired. We think in terms of zero sum. And so the result of it is that we can't take it for granted that the free enterprise system is under attack in every generation for people who just don't believe it can be true. Now, Wall Street has never done itself very many favors. The insensitivity that it actually brings in the way that it talks about markets, the way that it talks about or the way that it appears to favor the big guy over the little guy. It needs to police itself much better, and not just in terms of communication. It needs to pay attention to the fact that day trading is a really dumb thing to do because you're basically sitting down at a poker game with expert poker players and you're about to lose all your money. It's the best way to take a bunch of money and turn it into a little bit of money. And so at least moral suasion and more transparency in the idea of telling people more that this is a bad idea. That's in Wall Street's interest to actually do that so that we don't keep running into these populist problems. So
the fast traders and the algorithmic traders, the arbitrageurs, the short sellers that meet at the Yellowstone Club and decide to gang up on a stock. Is all that okay? Should it be regulated? Is it the what? No what?
No, I don't. No, it's not okay. I mean, the manipulation of markets and the manipulation of stocks, what that's trying to do is to create asymmetric information, which is a market failure. And we do, in point of fact, have a lot of regulations against that. They're just not very clear, and they're not very well enforced, and they're not very well understood, as a matter of fact. So what we need to do is to make sure that that kind of market manipulation is clearly prohibited, and there's enough transparency in the regulations that we can enforce them. But having more hearings for more, piling on new regulations when we don't even enforce old regulations, that's exactly the way that public policy tends to get made when we're in theater, as opposed to actually trying to protect people from market failures.
We talked, we had John Hope Bryant on, and there may be a little bit of a gap between, what you need to know to do this effectively and what a lot of people do know. And there's nothing that retail traders hate more than being, the perception that they're being talked down to. Right. But the democratization via Robinhood and all these platforms is great. But is there a way to, I don't know, that Graham and Dodd, sort of maybe a more long-term perspective can be emphasized so that, we start dealing with, people trying to save for the future, for their family, for retirement, and not gamify everything with a GameStop sort of a scheme?
I'm not sure that we can, and the cure might be worse than the disease, Joe. I mean, the whole idea of saying, look, gamifying is a bad thing to do. Everybody knows it's a dumb thing to do. It's a great way to lose your money. But in the same way, people make all kinds of decisions that are not intelligent necessarily, and the freedom that people actually have has value per se. I mean, giving people the freedom to make their mistakes, that can be important as well. Protecting people constantly against themselves and their own worst impulses. What should Wall Street do? Wall Street should be more transparent about talking about the facts, about how bad this can be for you, as opposed to setting up platforms where people can more efficiently lose their money. But at the same time, making something, giving somebody advice is very different than making something illegal. Because freedom per se is actually one of the most sanctified values that we have in our society. So my view is that this should be a much more of a voluntary, transparency-oriented communications endeavor. And we should be moving away from trying to lard on new regulations to protect people from themselves, even when they make these mistakes.
Hey, Arthur, you've also a lot talked about the dignity of work, it's sort of in a philosophical way, and how that's happiness. You see people that win the lottery and they're not happy. You see people that have a job and make a X amount of money and they're happy. I mean, some of this gamification might be coming from all the money sloshing around, whether it's stimulus, whether it's the Fed, whatever it is. If we crossed over the point of too much enabling with stimulus, and are we in danger of doing even more?
Well, we're in danger anytime that we move away from a system in which people are earning their success. Now, I understand the philosophy behind the stimulus very, very well, but once we actually start seeing empirical evidence that people are day trading using funds that are coming from the government itself, and then the representatives of the government criticizing the day trading. I mean, once again, the government is creating a self-licking ice cream cone of regulation. It's a real I'm going to give you money. Money's going into your savings. You're going to day trade with that money. You're going to lose the money. We're going to feel bad about it and hold hearings about regulating it so you can't do it anymore. This is pretty ridiculous stuff. I mean, the truth of the matter is, what do people want? It's pretty simple. People want dignity. People want dignity that comes from earning their success and serving other people. That's what you get through honest work. You don't get it through lottery tickets. You don't get it through inheritances. You don't get it through government stimulus checks. You get it from honest, ordinary, decent work. And that should be the ultimate goal of what public policymakers should be talking about.
Right. I don't know. I think we need to cancel that bullfight shot behind you just on humane. That's a risk for you. If you're comfortable with it, all right. But it just occurred to me that that bull is probably not going to end up doing too well at the end of that situation.
That bull may have won that fight. I'm married to a Spaniard, so it's okay.
Okay. Okay, then that's right. And in Barcelona and the French horn and all that in that other life where you did a lot of this a lot of this contemplating, obviously. Always love having you on, Arthur. And
thanks, Joe.
Any book that you've written, people can get a lot out of it.
Thanks, Joe.
Thanks for
I
being
appreciate
with us
it.
this morning. And Andrew, the birthday boy, got a lot out of the book when he read, especially the appendix, Andrew, and all the index pages and the dollar page.
Oh,
Me too.
It's a good book. Even better when you get paid to read it. When we come back, former Aetna CEO Mark Bertolini joins us to give us his take on the Biden administration's vaccine rollout plan next. And then later, Citadel's Ken Griffin's going to discuss yesterday's questioning at the GameStop hearing and so much more. Squawk returns right after this.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Most countries will experience recessionary-like conditions. Is it necessary for another 1.9 trillion to be directed at the economy?
We do need some more fiscal stimulus to continue to bridge the gap, to continue to allow us to move through this tunnel and get to the other side.
It is still about crossing that bridge to the recovery, but where the journey seems to be a little bit delayed, but should not be derailed.
We want to accelerate on the vaccine because we are fully aware that there is a direct link between vaccine and economic recovery.
We're starting to see some cracks here, and the EU is just the latest example.
People are focused on right now, when are we going to get our vaccines? This next generation, which we are seeing, and I think those will be flowing quickly around the world.
The challenge will be not a global distribution. The challenge always is finally the last mile.
It's one of the world's largest accommodation search platforms. Trivago CEO Axel Heffer talks COVID's impact.
It's a very difficult point in time right now. In most countries, there are tight restrictions.
Recovery.
We definitely expect domestic to be the majority of the market. It will take some time to rebuild that confidence in travel overall.
And the future of travel.
We are using structured data to provide you with inspiration of where to travel.
Don't miss the CNBC Conversation.
Welcome back, everybody. The Biden administration announced plans this week to double the number of vaccines that are being shipped directly to pharmacies from 1 million to 2 million doses a week, with a goal of reaching 40,000 pharmacies nationwide. For more on this, let's welcome Mark Bertolini. He's the former Aetna CEO and chairman. And Mark, this is a plan that we've been talking about for a while. The idea that if you really want to get into the neighborhoods where a lot of people are, or the communities where a lot of people are, you have to go directly to these retail pharmacies, which, by the way, happen to be pretty familiar with how to vaccinate people. What do you think of the plan so far?
I think the focus on supply and getting it out to communities is a big step forward. I think that is sort of a prerequisite for building a better system downstream, which I still think we need to do. As of yesterday, we had 59 million doses administered, but that's only 80% of the supply out in the market. So that means 14 million people haven't been vaccinated. And I think that's the next step. But I think this is a great first step, particularly in response to the new strains coming at us.
I saw those numbers too. The idea that that more than 70 million doses have been shipped to the states, but only about 58 or 59 million have actually made it into the arms of people. What do you think the holdup is there? Is that waiting, saving those second doses for people when they come back? I didn't quite understand it.
But it's a conversation that we had the last time I was on, Becky, is that we don't have a single platform to monitor this. So supply is getting to the communities where the reservation systems, the appointment systems, and the logging systems aren't connected to the supply as tightly as they should be. Some stores are better than others. But we've had, as people try to hit these online reservation systems, they're failing. We have stores that only let you reserve 2 or 3 days ahead. We have sites that are shutting down for the time being until there's more supply available. And so when you have this sort of dispersion of supply of reservation capability and technology that is not stable enough to get all Americans in the system, the supply gets stuck. And so throwing more supply at it will be difficult.
Yeah, it's not just the supply problems and the system problems. You mentioned that all of this is done with technology. And I have to say, the target audience for this right now, those age 65 and up, and you know, over this past week I was trying to book reservations for my mother-in-law who's in her 70s and some of her 80-year-old neighbors. I mean, 80-plus-year-old neighbors. It's not easy for them to try and maneuver some of those systems as well, which just makes you wonder what happens to people who don't have kids or grandkids to help them out with this.
They're stuck. They're getting neighbors and they're getting friends, and we've been helping folks out here as well to try and get into the system. It's unfortunate. This is an opportunity where, for example, Salesforce in California is managing that system and distribution and is helping to connect reservation appointments. And you can see California is way ahead of most any state in administering vaccines to the population. So it's this idea of understanding where you need the supply, how to set up the appointments. And then I think another important factor, Becky, that a lot of people aren't talking about is the supply of people to do it. On a number of sites here in New York, they're asking people, do you have medical capability? Could you sign up to come and help inoculate people?
So what's the fix? Again, Mark, these are all kind of long-term fixes and things that aren't going to be probably able to be papered over with in the next month or two.
I think some of the interesting projects going on here in New York City. So the Armory up in Washington Heights now has 700 vaccine stations, people lining up, going through. I think we need to do more of that. I don't think the pharmacies in and of themselves will be enough. I think you see hospital and physician groups providing vaccines, but it's only for their patients. We need to have mass vaccination. We need to have big facilities.
That's been part of the problem, I think.
Right.
You know, the hospitals that have had access to this, doctors groups that have had access to this, have restricted it to only their patients, which creates, you know, its own sort of pecking order for who can get access to these things.
It does. And then these reservation systems, again, they're all different. You try them multiple. I mean, you can sign up for appointments in as many places as you can get online and find one, which tends to jam up the system as well. So there's no coordination. But I think this is something that you can teach National Guardsmen. You can bring in nursing students. Teaching people to give inoculations is not that difficult. And if we do that and set up these mass vaccination centers, we can get the supply into people's arms. Because I think adding double the supply when we don't have the appointment availability, we don't have the technology to be able to get people in to get their shots, really creates a bigger problem in the longer run.
When you start asking people when things are going to start looking much, much better, getting more of this rolled out, Anthony Fauci may say June, July, August. Dr. Scott Gottlieb has told us maybe April. What's your best guess?
From the standpoint of availability, I think it's going to be the latter part of the second quarter. But I think from the standpoint of 75% of the American population inoculated, we're looking at 9 months to a year based on these statistics, if things don't change at the level of distribution and providing shots.
Mark, it's good to see you. Thanks for your time this morning.
Good to see you, Becky. Happy birthday, Andrew.
Thanks.
That's a good one. Coming, we got another hour. 65 minutes, in fact. Coming up our exclusive interview with Citadel's Ken Griffin after yesterday's hearing on the Hill. That's still to come. And as we head to a break, check out the futures ahead of the last trading day of the week. Squawk Box coming right back.
Divided by distance, united by business.
This is the new reality we're all
Helping you navigate the new normal. Squawk Box on CNBC.
So when I look at our online sales at $700 million, that's not dissimilar to the size of Coke. And so really comfortable with how we're going to market in that online space. The lowest cost of doing business in our industry. You know, you think about double the sales, you know, the JV business actually has double the sales per square metre of many of our competitors. So we're incredibly efficient in store, but also we recognise that customers want a different shopping journey. Some are online, some are in stores.
Good morning. Treasury Secretary Janet Yellen vigorously selling President Biden's nearly $2 trillion COVID relief package. Yellen says the risk of short-changing a stimulus bill is higher than the risks that come with spending too much. And a Capitol Hill reckoning for Robinhood as we hear from key players in the Reddit rally of the past few weeks. This hour, reaction to yesterday's high-profile hearing from former TD Ameritrade Chairman Joe Moglia and Ken Griffin himself, the founder and CEO of Citadel. The final hour of Squawk Box begins right now.
Good morning and welcome to Squawk Box here on CNBC. I'm Joe Kernan along with Becky Quick and Andrew Ross Sorkin. U.S. equity futures are up. It's significant. I guess not quite 100 points, 85 points on the Dow. Not getting back what we gave back yesterday, not completely, but we've been close. We've been up triple digits. The NASDAQ indicated up about 77 or so. The S&P up 16. And that's Treasury yields. That has us at about 1.3%, holding on to some of the highest yields we've seen in a fair amount of time, 1.313. Here's some of today's top stories. Speaking of Treasury yields, Treasury Secretary Janet Yellen making the case for going big on the next round of government stimulus to help fight the economic effects of the coronavirus. Yellen spoke exclusively with CNBC's Sarah Eisen.
15 million Americans behind on their rent, 24 million adults and 12 million children who don't have enough to eat, small businesses failing. I think the price of doing too little is much higher than the price of doing something big. We think that the benefits will far outweigh the costs in the longer run.
Yellen said the president's nearly $2 trillion stimulus proposal could help get the U.S. back to full employment in a year. Uber losing a critical overseas court case, the Supreme Court of the United Kingdom ruling that a group of about 24 drivers are entitled to workers' rights like a minimum wage. That could have much wider implication for Uber's gig worker business model. In a statement, Uber said it respects the court's decision, which focused on a small number of drivers who used its app years ago. And President Biden is expected to announce a $4 billion commitment to the international COVID vaccination efforts. Later today, Biden will take part in his first meeting with G7 leaders since being inaugurated. He's also expected to fly to Michigan to tour a manufacturing plant making Pfizer's coronavirus vaccine. Becky.
Thanks, Joe. Let's get to that other major story on investors' minds. Yesterday's congressional hearing on the recent social media-driven market volatility in stocks like GameStop. Robinhood CEO Vlad Tenev found himself on the defensive. Lawmakers focused on investing in the platform's decisions during the height of the trading frenzy, including Robinhood's decision to restrict users from buying shares of GameStop. Here's Tenev responding to criticism he's received.
Look, I'm sorry for what happened. I apologize, and I'm not going to say that Robinhood did everything perfect and that we haven't made mistakes in the past. But what I commit to is making sure that we improve from this, we learn from it, and we don't make the same mistakes in the future. And Robinhood as an organization will learn from this and improve to make sure it doesn't happen again. And I'll make sure of that.
Joining us now is a brokerage industry insider, Joe Moglia, the former chairman and CEO of TD Ameritrade. And Joe, I'm guessing, like everybody else, you were watching these hearings pretty closely yesterday.
Yeah, I was, Becky. Do you want me to comment on that?
I do. What was your biggest takeaway? What did you learn?
I think in general, first of all, we got to recognize it's only round one. There's going to be a lot more of this. And I think with regards to what happened at Robinhood, I think Vlad actually did a very good job of, while he was a little nervous, explaining how the halt took place. And he mentioned just a minute ago that he apologized for the inconvenience, significant inconvenience to his client base. But also he acknowledged the fact that that Robinhood was at real risk. I think you look at the other side that was really under scrutiny would have been what's going on with regard to Ken Griffin. And I know he's going to come on later on, but he got banged on both sides, right? The market maker as well as the hedge fund. But I think he did a good job of kind of explaining that. I thought he did an excellent job being very succinct, explaining payment for order flow. Based on what everybody said, and there was no evidence to the contrary, there was no collusion or conflict of interest. And then at the end of the day, I think the committee did a good job getting in front of its constituents. But the home run for the day, I think what happened with regard to Reddit and Gil, because they had more people watching them, and I'm sure that's a buzz in the social media world.
Yeah. It was entertaining, to say the very least, and educational, too. Joe, one question on the payment for order flow. I mean, that's a question that's come up again and again. We had Jay Clayton, the former SEC chairman, with us earlier this morning, and he said, look, it's been legal for years, for decades even. It's legal, he thinks, for now, although he said the SEC will probably consider that pretty closely. And I guess that kind of gets down to this idea of just how valuable those flows are. I mean, is this a situation where it's valuable to a company to be able to get access to that because, like Walmart, if you have big enough volume, you can make money off of it? Or is it valuable because you can get a look at what retail investors are doing right now and somehow perhaps get in front of that? I mean, you know the ins and outs of this better than just about anybody.
Well, I think in general, Becky, really what happens, like in slow motion, the investor winds up doing a trade. The trade winds up going to the broker. The broker, in effect, takes that to the market maker. In return for that, there's payment for order flow that the market maker winds up paying to the broker. Now, with that comes best execution. Remember, the customer is getting the best possible execution in that moment of time in the entire marketplace. And also with that comes price improvement, as well as the flow that goes back, that winds up going back to the broker. So the individual winds up with best execution, normally price improvement. They get that for free, and then the broker winds up getting a piece of the payment for order flow.
So no conflict of interest as far as you're concerned on this?
No, I don't think there is. I mean, to put it in perspective, so I think one of the stats at Schwab, 92% of their client base gets price improvement. I know when I was at Ameritrade, the differential between what we received in terms of order flow and what we gave the clients in terms of price improvement was 2.5 to 1. So we're really doing a great job, I think, in terms of taking care of the clients. The retail investor has never, ever had a better environment than what we have now. And we've done a good job supporting that. And I recognize people don't necessarily understand it. And when you have something like happened the other day, a major event, everything comes under scrutiny. But at the end of the day, all of this has really worked out pretty well.
You alluded to what Vlad had said, Vlad Tenev said yesterday, just acknowledging how close to the brink they came, how there was a moment where they didn't have the liquidity. Fortunately, they were able to get that liquidity. When you hear something like that, what do you think in hindsight? How big of a problem would that have been if they didn't get it?
If they didn't get it, there's a chance they could have gone out of business. They got 13 million clients. They would have lost the access altogether. I'm sure they're all paying attention to this without question. But frankly, if I'm Vlad, I think I've got to put all my energy into diversify. I got to diversify. I got to fortify. I got to diversify. I got to find a different revenue stream. I have to do that. So should I look at digital banks, an ETF organization, a robo-advisor business? The other thing I think I'd look at, the day trader is different from the active trader. Two different things, but the core competencies at Robinhood are transaction processing. So there's no reason why they can't go more upscale with that. Take a little while to do that, but I think they can do that. The other thing, they got to fortify the balance sheet. So they got to be able to get more cash that they can count on. So they've got to look at the possibility of going public, whether that's through a normal IPO or a SPAC, or potentially being acquired themselves. But they've got to spend all their time looking at that now, and I'm positive they are.
That's a very interesting point. The idea that you think they either need to go public quickly through a SPAC or an IPO, or potentially get bought up by somebody else. When you talk about diversifying their payments or the income that they're getting, so that it's not just this payment of order flow, is that something they could do by themselves, or would that require them to make acquisitions?
Well, no, I think with regard, if they're going to look at a digital bank, if they're going to look at an ETF type business, if they're going to look at a robo-advised type business, I would think they should be able to do that themselves. But now here's where I don't know. And with regard to whether they go public or be acquired, I don't know if they've got to do any of these things right away, but they have to be devoting all their energy to making decisions as to what they need to do here, and then start to execute a plan. So they got to be sophisticated enough to really figure out what they've got to do and the contingencies behind that. Then they've got to be wise enough to simplify that so they can execute it quickly. Now, how quickly, they would have a better idea than I would, Becky, but they've got to do that.
Joe, let's talk about the overall industry and the impact that could be there from any potential regulation, because there has been a lot of talk about all of these different issues. Free trades are available because of the payment for order flow. That's the only way anybody's able to do it right now. If the SEC were to crack down on that, what would it mean for the industry? And what other potential regulatory moves do you think would mean big change for the industry?
Okay, let's begin with the payment for order flow issue. Remember, in the front end, everything was very, very simple, right? You enter a trade, it winds up getting executed instantaneously. You get price improvement, you got the best execution in the marketplace. You get that for free. But there's a back end to that. And behind all this is a gargantuan infrastructure that costs billions and billions and billions and billions of dollars. It's that infrastructure and order routing that allows the price improvement, the best execution, and doing it for free for the customer to actually take place. Somebody's got to pay for that. Now, that gets taken care of through the payment for order flow. You take that away, who's going to pay for that? Billions and billions and billions of dollars. Somewhere the costs are going to go up. So the way it works right now, really, it's worked well, since I began in Ameritrade in 2001. It's worked well. I think it's fair to relook at it again, but that's probably not something anybody wants to play with.
So what other potential regulation do you think could be something that would be concerning for the industry?
Well, I think the big thing now is what's going on with the shorts. I think it's fair to look at that. Everybody's talking about settlement T+1, but I think the other piece of that is should you put a cap on the percentage of a short that a company can be? Would it make sense to take a look at the actual holding period with regard to what's going on as far as the individual client goes? And at the end of the day, I think there are a handful of things. What I think we got to be careful of, this was a major event. It was a one-day event. It's getting a tremendous amount of inquiry, press, drama, etc. The regulators will look into this, and if something bad really happened, we'll find out. But right now, we don't know that. We haven't seen that. And I think we want to be really careful. I know Congress cares about the individual investor and what's free markets, but it's worked well. It's working well. What happened was not systemic. And I think we've got to do a good job of making sure we don't overreact to this because we don't want to screw up a system that actually works very well.
What about just questions of transparency?
I think transparency is supposed to be disclosed in the agreement that the individual signs. Having said that, that's one piece in a big thing that I'm not sure everybody even reads. I think we could do a better job of explaining, just teaching, how payment for order flow actually does work. I think we can do that, but I think we're pretty transparent across the board. But again, can we do a little bit better job explaining it simply and easily, like you're talking to an 8th grader? Well, I think we can do a better job of that. Yeah.
There were a lot of questions from Congress yesterday about protecting the retail investor, and that's certainly high on the minds of the SEC, too. What could they do to better protect the retail investor without, keeping them from being able to have the freedom to do some of these things? How do you protect them but not stop them? I
think, Becky, that the one thing they can, again, don't mess up the system. Do what you need to do, but don't mess it up. The one thing I really believe that they can do, and they got to take a look at, and that is, there are 3 types of investors, 3 segments. You got the long-term investor. Then you got the active trader. It's not a day trader. Then you got the day trader. The active trader and the long-term investor really has some they get great education. They have great risk management tools. They have a lot of stuff. The day trader doesn't necessarily have that. Now, Vlad was talking about that they've got an online library. Well, that's great, but again, I think you've got to. That's not enough. I think where Congress could help if they really pushed the education of the day trader. For example, the market's going up. Now, let's suppose you bought GameStop at 5, or it gets to 10. Gets to 50, gets to 20. You got to triple, and you're supposed to take something off the table then? No, I'm not supposed to do that. I'm going to wait till it hits 400. So there's got to be an education. So suppose we taught the client that as the market moves up, you take half of what you invested off the table. Now you cannot lose money. Can't lose money, and you move forward from that. What can we teach there's a benefit and a negative. There's 2 sides to leverage. I think there are things like that the online brokerage business can really help. Robinhood can help with their day trading, and the millennials, I think they can really do that. And then the other piece of this is, to what extent is social media? The Reddits of the world, the Gills of the world are supposed to take some responsibility for this as well. So they could put on a great trade. But then how do you manage the risk with regard to that trade? I think that's part of their responsibility. At the end of the day, the individual's got to take responsibility for themselves. But there's another side to this. Like once the trade's done, or once the trade's on, then how do you manage the risk after that? And I don't think we do a great job with that with the day trader. I think we do a great job of that with the active trader and the long-term investor. That's something I think Congress could push.
Joe, thanks for being with us today. It's good to see you.
Good to see you, Becky. Thank you. And of course, if I don't say happy birthday, Andrew, I'm going to feel bad. So happy birthday, Andrew. Thank you, Becky.
There you go.
Thanks,
Joe.
Thank you. Coming up when we return, how fast can Texas get its lights and heat back on for everyone following that rare winter blast that stunned the state? We're going to speak to a former advisor to the Federal Energy Regulatory Commission. Plus, stay tuned for our exclusive interview with Citadel's Ken Griffin, his first since getting grilled by Congress in the GameStop hearing yesterday. Squawk returns right after this.
Interactive Brokers charges 1.59% for a $100,000 margin loan. Do you know how much your broker charges? Upwards from 6.82% at Fidelity or Schwab to as high as 7.45 to 7.75% at E-Trade or Ameritrade. Move your account to Interactive Brokers and save at least $5,200 or much more if you're trading big bucks.
Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
We're ushering in the year of the ox. After an unprecedented year of turmoil, we'll look at what's ahead.
The U.S. is in recovery. The rest of the world is starting to catch up.
As China marks a major milestone.
The CCP goes into its 100th anniversary feeling very confident.
And will travel finally get back to normal?
In a normal year, you will see hundreds of million, maybe 200 million people out there on the move. But this year, probably only at 50%.
All that and more in our special year of the ox, Plowing On.
Welcome back to Squawk Box. I'm Dominic Chu. Our Sectonomics spotlight for this month focuses on the consumer staples sector, a real underperformer over the last 12 months versus the broader market. The sector's only up about 2% versus the S&P 500's 15 to 16% rise. But one of the main reasons why people focus on consumer staples from an investment standpoint has to do with dividends. Now, take a look at this. This is interesting. Consumer staples right now with the dividend yield in the red line, you can see they're closer to around maybe 2.3, 2.4%. Over the course of the last 10 or so years, it's kind of within the range of dividend yields that you can see there, on the lower end, but still within the range. Meanwhile, look at the blue line, which is the S&P 500. It's closer to around 1.5% yields now that we're at record highs for the S&P. By the way, you got to go all the way back to the early 2000s to see a dividend yield that low. So could consumer staples dividends once again become attractive given the market's overall rise? Well, take a look at this. We wanted to take a look at the highest paying dividend stocks in the sector that have also had positive price appreciation over the medium to long term. Take a look at Kraft Heinz, a 4.1% yield there. The J.M. Smucker Company, 3.1% yields. Archer Daniels Midland, 2.7%. Colgate-Palmolive, 2.2%, and Walmart at 1.6%. By the way, all of those higher than the current 1.3% yield on 10-year Treasury notes. Something to keep an eye on there for sure. Sectonomics, consumer staples. We'll have more throughout the course of the day. Keep it right here because Squawk Box will be right back after this commercial break.
I want people to feel like they just learned something. I want them to feel like they understand something about their lives better than they did an hour earlier. We will sort through what's true and what isn't, and we'll give it to you straight, in context and with perspective. We will not waste your time, and we'll earn your trust. And I want them to feel like that was an hour well spent.
Welcome back to Squawk Box this morning. Treasury Secretary Janet Yellen making a push for a big stimulus package. Here's what she said on CNBC.
We think it's very important to have a big package addresses the pain this has caused. 15 million Americans behind on their rent, 24 million adults and 12 million children who don't have enough to eat, small businesses failing. I think the price of doing too little is much higher than the price of doing something big. We think that the benefits will far outweigh the costs in the longer run.
And you can see more of that interview with Sarah Eisen right now on CNBC.com. Meantime, take a quick look at the futures. Dow up about 86 points. NASDAQ looking to open higher, about 80 points higher. S&P 500 up about 15 points. Meantime, Pfizer proposing a non-Arctic storage option for its vaccine. It submitted new data to the FDA showing the vaccine can be stored for 2 weeks at temperatures found in typical pharmacy cold storage. If approved, it would make the shot a lot easier to transport and use. Joe?
Thanks, Andrew. Power coming back online for many in Texas after that winter storm that swept the south, but millions have been ordered to boil tap water before drinking it. Our next guest is both a Texas resident and an energy expert. Allison Silverstein is an independent energy consultant and former strategic advisor to the Federal Energy Regulatory Commission. She joins us to talk about what went wrong with Texas power systems, how to fix them. You're in Austin, and you lucked out, Allison, because you were on the same power line as a hospital, so you've got like 12 people living in a house with you right now, and animals.
Pretty close. The animals feel like a couple people apiece, so yes, it's been crowded.
I know how that works. Allison, we want to try to figure out what went wrong, and actually, you wrote a long piece back in, I think, May of 2020 about ERCOT and whether it could handle what was coming up. And I think at that time they were most worried about, or people were worried about, heat and air conditioning issues. It wasn't necessarily looking at it from this side of things. But where was the weak link in the whole chain, in your view?
Well, I think subject to, there is a lot more data than analysis that needs to be collected and worked through. But based on preliminary examination, it looks to me as though there were 5 major causes of this particular blackout event. One of them was, of course, that this was an unprecedented storm in terms of cold, long duration, really high moisture, and that knocked out eventually 40,000 megawatts of Texas electric generation capacity. It took out over 40% of Texas's thermal generation fleet alone, 40%, and that's of natural gas, coal, and nuclear generation. And when they started, the grid operators started losing that amount of generation, they had no choice but to cut load to keep the entire grid of the remainder of the grid afloat and avoid a really catastrophic situation. There was all of this happened because of insufficient power plant winterization. This was a guideline; it wasn't mandatory. There was a huge chunk of the natural gas supply for Texas power plants that froze up, both at the wellhead level at production and in pipelines. So gas plants couldn't get the fuel that they needed to run. ERCOT under forecast customer demand by 20%, which means that they didn't have enough generation ready to serve customer demand that kept rising as the night got colder and colder. And last, ERCOT's a standalone grid, so they were unable to alleviate these shortages by importing electricity from outside from the rest of Texas. And that's a wonderful idea if you like avoiding federal regulation, but it's a terrible idea if you like protecting reliability against disasters like this.
Yeah, that last point, we should talk about some more. So the rationale was to avoid regulation, hence they'd probably call it deregulation, but it leaves you in the position of being stuck with what you have and not being able to ask for help when you need it.
Correct. And I have been both a Texas state regulator and a federal regulator. And I can tell you that the fun of being a Texas regulator is that you are in your own small patch the king, but it means you've got nowhere to go for help. And there are at least 4.5 million Texans who've been sitting in the dark and the cold for several days who are not particularly happy with the outcomes of Texas regulation at this time and don't know the difference between state and federal regulation other than that they're not real happy with what they've got. And add to that the 20 million Texans or more who are going to have to be boiling water or don't have any water to boil at all or any clean water. And it's pretty clear that what we have done overall is not what people are super happy with. But let's be clear, regulation was only one of many issues that caused this situation. It wasn't, you can't just say Texas regulatory status and Texas's standalone market. The way we set things up from an institutional construct didn't work. You can say all regulators should have done things like make effective winterization for winter cold and long summer heat waves mandatory. Weatherization is the kind of reliability thing that we should have been doing at every level as a mandatory measure, not as a best practice.
Well, you pointed out that I forget what type of energy you called it, but the more conventional energy, natural gas and others that you talked about, were affected by the cold. Just like, initially certain people, maybe the governor, maybe, people that aren't big Green New Deal proponents said, well, the windmills froze and the sun went down or went away. So you didn't have solar or wind. That wasn't true. But because we now know that the conventional stuff was affected by the cold as well. But what about renewables and the future that we're looking at? Will we be ready for adverse weather events if we're much more dependent on this new age renewable energy?
Of course we will. And the thing is, what grid reliability requires that you understand the resources that you have and you design a system to suit them. And our problem is we designed the grid and the generation of today to fit Ozzie and Harriet weather of the past. But we are facing Mad Max in terms of weather conditions. We are already there, and issues associated with climate change are making extreme weather of every kind. Winter storms, summer heat waves, droughts, floods, hurricanes, everything imaginable is getting worse and more frequent because of climate change. And What that means is we need to design the electric system in a way that suits the resources that are now more cost effective, which is wind and solar. We can't do it overnight, and we don't need to do it overnight, but we need to do it quickly. And one of the most important things we can do to make that system work is start changing the way we don't need to shut down nuclear and gas thermal plants overnight, but we sure do need to winterize them better. We also need to rethink the way we do. We need way more energy storage distributed and supporting wind and solar. We need infinitely better energy efficiency, starting as an equity issue with low income and multifamily housing, because they're the ones who we seem to keep taking the brunt of rotating outages on either the summer or winter. And we can make a grid much more stable with more efficiency.
But I mean, there have been cold spells before in Texas. This was similar to one back at, how long ago was it? About 35 years ago, right? I mean, it's
2011.
What about
but the point is
1990
yeah.
as well. So you know, I mean, it's a kind of a big leap to go to.
But we obviously didn't learn the lessons. We did not implement all of the lessons like winterization.
We didn't hear about a polar vortex. Used to just be cold air from the Arctic. Now it's a polar vortex caused by the warming. So I need to see the peer-reviewed science on the the warming causing the cold. Anyway, Allison.
So do I. But the point is
the atmosphere
that
is
the weather,
unsettled,
every kind of weather is getting worse. Right. And so we need to plan. We need to plan a system that suits much more kinds of really horrible weather. And part of improving reliability in a different system is more transmission. Thank you. Bye.
Okay. Thank you, Allison. We appreciate it. Becky.
When we come back, an exclusive interview with Citadel founder and CEO Ken Griffin. We'll go in depth on his responses to Congress yesterday in that sometimes heated hearing on social media-driven market volatility. Also a programming note. Tonight, don't miss a Fast Money special report on the new American investor. It starts at 6 p.m. Eastern Time. Stay tuned. You're watching Squawk Box, and this is CNBC.
The countdown to the open of the U.S. markets is sponsored by IG.
I wouldn't describe Hong Kong as a sticking point between U.S. and China. Sometimes Hong Kong has been used as a pawn by the U.S. administration. With the new U.S. administration, I hope that they will give us a fair hearing as far as the national security law is concerned.
We're not a protectionist country. Rather, China is trying to become a leader of a new round of globalization.
The pressure on Australia, the boycotts that we're going through at the moment, these are 180 degrees at odds with everything Xi Jinping solemnly told the Davos virtual conference.
It will take some time. I don't think there's, we're going back to where, we were before the Trump administration.
I think still in the early days of the Biden administration, but so far we have seen some companies that are listed in the U.S. returning to Asia, to our market.
On the next Managing Asia, the man running Singapore's largest supermarket chain, FairPrice Group.
Before those gone orange, we could already see, the build-up of crowd at our stores. They were buying like there's no tomorrow. We are managing stockpile, covering a few key categories. We have had to review and rethink many of our strategies.
Sia Kian Peng, CEO of FairPrice Group, on the next Managing Asia.
Brian Sullivan.
Good morning.
Worldwide Exchange on CNBC.
Check out the futures on this Friday morning. Take a look right now. You'll see Dow futures indicated up by about 85 points. That has the Dow on track to close higher for another week. S&P 500 up by about 16 this morning, and then the NASDAQ right now indicated up by about 85 points after closing down by more than 0.7% yesterday. Joe?
All right, up next, an interview you don't want to miss. Citadel founder and CEO Ken Griffin on GameStop, Robinhood, and what he's taking away from a high-profile hearing in Congress yesterday. Stay tuned. You're watching Squawk Box on CNBC.
Real money.
Heat map right now, pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
Welcome to the closing bell.
It's the most important hour of the trading day.
We've got just about 36 minutes left to go in today's trade. We are seeing strength overall.
When stocks move, when volume spikes.
Is that suggesting that we think GDP is going to be strong next year?
Keeping you on the leading edge of what's driving the markets.
Many Americans are in desperate need of relief.
Minute by minute.
Partial recovery of what we lost yesterday.
Wilfred Frost, Sarah Eisen. Closing bell. Weeknights on CNBC.
Loss for Uber overnight. The UK Supreme Court ruled that drivers must be classified as workers entitled to a minimum wage and vacation time. That ruling is expected to set a precedent for gig workers across that country. Guys, I have seen the early response from Uber. Right now, the stock's down by about 1.75%, and I believe they say they understand that this ruling was based on some of its workers who were using an app several years ago. So it sounds to me like the way they're going to try and maneuver this is that it doesn't apply to their workers today, and that this is outdated stuff based on workers who used to be doing it a different way using the app. I don't know, but I did see the stock pick up a little bit when they came out with those comments.
No doubt at all. Yep. And mark your calendar for the next big Capitol Hill grill session. The CEOs of Facebook, Twitter, and Google will appear before the House Energy and Commerce Committee on March 25th. The committee will question the CEOs about false claims that proliferated on social media platforms about the COVID-19 vaccine and election fraud. Andrew.
Meantime, Roku shares, they are higher this morning. Earnings at 49 cents per share, shattering analyst estimates of 6-cent loss. Revenue also beating forecasts and current quarter guidance above expectations. Most of the revenue gain came from Roku's licensing and advertising business, and it's just been a remarkable story to watch over all of these years. I remember when they had their IPO and they came on the show and they were just a little box attached to a screen, and I'm not sure everyone appreciated what could possibly happen in terms of this mega advertising business they've developed. Becky?
Yeah. In the meantime, Dropbox reported adjusted earnings of 28 cents a share. That beat the street's expectations, but that did not include a one-time charge of nearly $400 million related to the shift to remote work. Dropbox has a large office space footprint in San Francisco. It will keep some of that space for what they call collaboration and look into subleasing some of the rest of the space. That impairment charge resulted in a quarterly loss of nearly $346 million. The stock down by just over 4%. Andrew?
Okay. We've got a big interview coming up ahead. Citadel's Ken Griffin will be live with us, talk about yesterday's high-profile hearing in Congress. Stay tuned. Squawk returns with Ken Griffin after this.
She's a courageous corporate strategist.
She had a very high ambition and drive to succeed.
Fearless philanthropist.
To give such a transformative gift is incredible.
And Grammy-nominated musician.
Music is what I am. Everything else is what I do.
Defying all convention.
I've broken boundaries because I didn't know they existed.
The brave ones. Chandrika Tandon on CNBC.
The stories and opportunities driving Wall Street and investors. Tyler Matheson, Melissa Lee, Kelly Evans. Power Lunch. Weeknights on CNBC.
A big interview coming up on Squawk Box on Monday morning. Don't miss our live conversation with Sean Carter, Jay-Z. Of course, he is rapper, songwriter, record producer, hip-hop's first billionaire, and also a businessman with lots of different investments. We'll get to talk to him about many of those things coming up on Monday morning. Don't miss it. Andrew?
Thanks, Becky. I'm looking forward to that, a big interview. In the meantime, another big interview right now in a House Financial Services Committee hearing that captured the attention of Wall Street and Main Street. The heads of Robinhood, Reddit, Melvin Capital, and our next guest were grilled over the GameStop saga and how they've handled the Reddit rally. Joining us right now is Ken Griffin. He's the founder and CEO of Citadel, and we're thrilled to have him on the program this morning. Lots of questions. I know you answered a lot of them yesterday, but hopefully we can get through a couple of them today. Thank you for joining us. The big question, and here's where I want to start if we could, Ken, seems to be the debate still around this idea of payment for order flow. The idea that effectively your firm pays Robinhood, it's actually where they get a majority of their revenue from, to execute trades. And therefore, the public perception is that you wouldn't be doing that if there wasn't a benefit to you at the expense of the retail investor. Can you explain the economics of payment for order flow from your vantage point?
Certainly. And Andrew, thank you for having me here today, and happy birthday. It's 29 this year, is that right?
A little bit older.
All right, you'll catch me eventually.
15 years. Thank you.
So it's a pleasure to be here. Yesterday was an important hearing in that I was hoping, going to find some understanding of what happened in GameStop and the other meme stocks over the course of the last couple of weeks. We spent a huge amount of time on a long-standing commercial practice referred to as payment for order flow. In the United States, retail brokerage firms are permitted to collect payment from order flow from market centers to whom they send orders. Now, over the course of the last 20 years, as the CEO of Robinhood testified, the retail brokerage firms have become extremely focused on putting various market makers in competition to execute their orders. They will set a payment for order flow rate, say, you pay us X amount per share, and they charge, generally speaking, the same rate to each market maker. And then we're going to route the order to the market maker that provides us with the best execution. Now, the upshot of this is that the retail investor has a better execution than they can on exchange across the orders that we execute for them. And for the retail brokerage firms, they have an important source of revenue that helps to fuel their business model. And one of the key driving changes of the last few years has been Robinhood's push to zero commissions that has spread across the industry for the benefit of all investors. Now, as I testified yesterday, there are reasons that payment for order flow exists. First and foremost is that exchanges are simply not as competitive as we can be off exchange in the processing of retail-sized orders. One of the reasons for this is a regulatory mandate that exchanges have to trade in 1 cent wide increments. We can trade tighter than a penny and share the value that we are still able to capture with the retail investor and with Robinhood and other retail brokers in the form of payment for order flow. So as I said yesterday, one of the ways that we can reduce the amount of payment for order flow is by permitting exchanges to be more competitive. That would change the industry in an important way going forward if this is an area of undue concern. What I will say is that last year, collectively, the market makers delivered about $3.7 billion of price improvement to retail investors. And through the payment for order flow, go ahead, Andrew.
Well, let me just ask you a question about this, though. And I want to raise a letter, which I know you're familiar with, that was written by your general counsel, your former general counsel, I should say, back in 2004. And maybe I imagine your thinking has evolved on this. But back then, he wrote, Citadel Group urges the commission, this was a letter to the SEC, to ban payment for order flow. Payment for order flow is a practice that on its face is at odds with a broker-dealer's obligation to its customers. We do not believe that a broker-dealer that accepts payment for order flow and does not pass on such payments to its customers, either directly or through reduced execution fees or commissions, can consistently fulfill its best execution obligations. And I think... And
Andrew, do me a favor. Read
go ahead.
The front of that letter. What is this letter in reference to?
This letter was in reference to payment for order flow rulings around best execution at that time.
No, in the U.S. options market. And that's an incredibly important distinction. In the U.S. options market, every single options trade must be executed on exchange. And the context of this letter has been the introduction of the very negatively impacting price improvement auctions, which discourage market makers from putting their best foot forward each and every day in the U.S. options market until they receive an order from a retail brokerage firm that they then take into a price improvement auction. And so what's interesting is, back at the time that this letter was written, we were witnessing a dramatic transformation of the U.S. options market, one that has been incredibly good overall for investors, but one that has been, in some sense, taken somewhat off track by the introduction of price improvement auctions. That's why when you type in a given symbol on your Bloomberg or on the internet and break a price for an option, the market could be 10, 15 cents wide. Right. It's because of the existence of the price improvement auctions. Now, for equities trading on exchange, The issue here is that the exchanges cannot be as competitive as we can be off exchange. And in equities, unlike options, we are able to trade off exchange. That's a very important distinction.
So the other big issue, though, that investors, and there's a public perception, is that you get to see the flows, that you get to see information, and that even if you're not front-running your investors, which is illegal, that the data unto itself has value. How do you use that information?
So I think there's been a number of misperceptions about the data that we receive from the retail brokerage community. In fact, a prominent U.S. senator asked us specifically about what personal identifying information do we receive from retail investors. The answer is none. We receive an order, and as the party that has to execute that order, what we look at the moment of receipt is what are the various options that we have to achieve the best execution for that order. And you're exactly right. We are not permitted to trade in front of that order. Any execution that we can achieve in the context of the market for fulfilling that order, we must provide back to the retail investor, sometimes even with a price improvement that we add on at the moment of execution. So the big picture is this conspiracy theory that we somehow or another are like some of the big tech giants that have access to personal identifying information is just flat out false. We have a price, quantity, a limit. That's what comes to us in an order from a retail broker.
Right. Let me ask you a maybe more meta question about all of this, which is, do you believe that the markets unto themselves are completely fair? And when I say fair, do you believe that my mother has the same opportunity to make money in the market as you do?
So it all comes down to a matter of horizon and strategy. It's like asking, if I went and played golf this weekend with Tiger Woods, would I win? Of course not. But there are various ways to compete with Tiger Woods off a golf course and do very well. I'm not going to play him on his game, on his course. Your grandmother might be very aware of a sea change in technology or otherwise that will impact our economy. She might look at the car you drive 5 years and go, and you bought a Tesla. And I think EVs are the future of America, and I'm going to buy Tesla stock. And if she'd bought Tesla stock 5 years ago, she would have made a lot more money than we made at Citadel. So I never underestimate the skill of the American retail investor at understanding emerging trends where real wealth is created and their ability to take advantage of that wealth transformation.
One of the big issues that this GameStop mania brought to bear is the issue of shorting, and in particular the issue of short selling beyond the float, beyond where you have situations where a stock is being shorted more than 100% of the shares that are available. Can you explain to the public how that could happen and whether you think it's right?
So it's a great question, and one that has quite a bit of misinformation. When you short a stock, you have to borrow it from somebody else. And that's typically from a pension plan or an endowment that holds the stock at a custody bank. As the short seller, you then sell that share of stock that you just borrowed into the market. If the share is bought by another institution, that institution is, again, in a position to lend that share back out. Now, why do institutions lend the shares? They can earn a very, very high rate of return on lending a security like GameStop in the middle of the recent events. You know, there were days when borrowing GameStop would cost a short seller an annualized fee of somewhere between 25 and 50%. That's real money to whether it's an ETF holder or a pension plan with respect to lending those shares.
And let me ask you a separate question that maybe relates to the larger picture of Citadel right now, which is you control, and you talked about it yesterday, more than 50% of the retail volume. Is that good for the markets when you think about competition?
So we control, and we don't control, let's just be clear. We execute about 40% of all the retail order flow in the United States every day. And we do it because we offer the best execution quality to American retail investors of any of our competitors. If they decide that by legislation we should eliminate competition as the basis for which business is done in America, then clearly we'd be in a position to do less business. But we are always advocates for markets that have a level playing field, that are transparent, and where the winners and losers are determined on the basis of their ability to compete. We think it's such a world that our team that works incredibly hard. I mean, my guys put in just absolutely insane hours over the course of the last 2 weeks to make sure that we were resilient and stable in the height of the trading frenzy. Right. We think in a world where competition dictates how business is done, that we're well positioned to do well for our customers and to do well for our shareholders.
What do you think the implications are of the social media enabled, what you're seeing happen in the Reddit community, and what it could do to short selling and the like? For example, do you think that there will be a lot less short selling in the future?
There's no doubt in the foreseeable future, the amount of short selling will be reduced by the events of the course of the last couple of weeks. There's just no doubt. What I will say is that it's unclear the power of the Reddit community. That will play out over time as we see them converge around other securities, other situations, and the price impact that they have as a community. I think the GameStop situation is incredibly unique in that it was such a heavily shorted stock, and there were some real potential drivers for change. As you know, the founder of Chewy recently joined the board. He had a fantastic reputation in building Chewy. There's an opportunity for change at GameStop that will unfold over the months and years to come. Right. I think it's a very unique situation, and I'd be very hesitant to draw any significant conclusions from the events of the last few weeks in GameStop.
Given all the conspiracy theories, though, that were raised on social media and the implications of that, I'm curious, in retrospect, you obviously made a big investment in Melvin in the middle of this, Melvin Capital. Do you think that was a mistake?
No, I think Gabe Plotkin is one of the finest investors of his generation.
But given what the public perception became around this idea that Citadel was behind Plotkin on one side, behind Robinhood on the other, in retrospect, do you think it created the perception of a conflict?
If I had to run my business to the possibility of an insane conspiracy theory emerging at any point in time, I would have no business.
Before I let you go, I do have to ask you one question that's maybe a little bit off topic, but it's something we've been talking about virtually every day on this program for the last several months, and that is, as an investor, Bitcoin. How do you think about Bitcoin today? Are you invested in Bitcoin?
I just don't spend much time thinking about cryptocurrencies.
Really?
No, I don't. I don't see the economic underpinning of cryptocurrencies. I understand how to value a stock, net present value of earnings. I understand how to think about currency exchange rates around the world. I don't know how to think about what is effectively a digital token.
It's a longer conversation, Ken. I want to appreciate and thank you for being here today, especially after you got grilled yesterday. And thank you for taking our questions this morning. And I hope you'll come on back and we can do this again for some more time. So thank you.
Andrew, absolutely. Thank you so very much.
Appreciate it. See you, Ken. Thanks. That does it for us this morning. Make sure you join us next week. Squawk on the Street begins right now.
Good Friday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with David Faber and Leslie Picker. Kramer has the morning off. We're coming off the first three-day losing streak for the S&P of the year. Dow, those on track for a weekly gain. 10-year yield still elevated above 131. Oil, though, back below 60 as the Texas grid operator says emergency conditions may end today. Our roadmap begins with Yellen's push for stimulus as the Treasury Secretary warns of risks ahead without significant relief.
Then called a short squeeze as the extreme weather adds to the production issue of semiconductor chips.
And later, a regretful Robinhood will break down what actually came out of yesterday's GameStop hearing. Carl.
Guys, we're going to unpack all of that. But first, we're going to start with what Yellen told our Sarah Eisen on Closing Bell yesterday about the stimulus, about the risk of doing too much versus too little. Here's what she said yesterday on Closing Bell.
We're hoping to see progress over the next couple of weeks in enacting that package into law. President Biden has had discussions with members of Congress on both sides of the aisle, would ideally like to see a bipartisan support for a package that we think is really what we need to deal with the pandemic and to get beyond it, get our economy back on its feet, and help all the people who've been so badly harmed by the pandemic and the economic havoc it's caused.
A great interview with Sarah, David.
Yeah.
And we've talked about the implications of that kind of stimulus, both intended and unintended consequences. I don't know if you've seen some of the Q1 estimates to GDP, but Atlanta Fed's now at 9.5. Goldman just went to 6. Morgan Stanley went from 3.6 to 7.5. So, I mean, whether you believe it's going to cool off in the back half of the year, first half of the year looks hot.
Yeah, it does. And then, you know, even some of those 22 numbers are quite strong. And that continues to be kind of the question. Will there be a real follow through? But, you know, Carl, I've been mentioning this during the course of our broadcast recently. I'll probably continue to. I mean, the conversations that I have with asset allocators, many of them hedge fund managers, usually include 2 topics. One, SPACs. Do you have one? Why don't you have one? I got to get one. I got to start one. I haven't started one. Oh, have you heard about mine? Can I book my guest on? We're de-SPACing next week. And then the other subject, of course, is are we going to run really hot? And what's going to happen to the market? Are we going to put a lot more money in a lot of people's checking accounts that's going to end up in the market? Is there going to simply be even more purchases, Leslie, of goods and services? Services in particular, of course, because that has been a lagging part of the economy, given people in certain places have continued to be locked down, or not locked down, but not doing what they typically would. And that's the question. And what will it look like in terms of the reflection both for economic growth and back here for what it means for the overall stock market and these pockets of speculation that we've already seen and drawn attention to?
Yeah, Yellen addressed the inflation question, saying that she wasn't too worried about it and believes that the Fed has the tools to handle rampant inflation if it does rear its ugly head, especially given that it's run so low for so many years now. And of course, she would be in the position to know what tools the Fed has at its disposal, considering she, was the chair there for quite some time. Interesting that she is, also tying potential tax increases to an infrastructure bill. That's something that people were concerned about, especially as they look at stimulus and what it does for the budget deficit, the potential for tax increases, which she said would be gradual in nature, Carl. So, no real details on what form those tax increases could come in, but that's another thing to be looking for and potentially could have implications on some of this overheating that we're seeing as well with regard to the economy.
Yeah, also hard when you try to pigeon either a Treasury Secretary or a Fed chair on individual asset classes.
I think we pinned that on somebody in her staff who maybe had lost some money in some small cap biotechs. we never really, I don't know that we were certain as to whether Yellen signed off fully on that commentary, but I do remember that. Carl, quite well. You know, it's interesting listening to Griffin just saying no thanks on Bitcoin, Leslie. When Andrew actually asked him to engage on it, he gave a 3-word answer, essentially saying, I just don't pay, well, maybe it's more than 3 words, but it wasn't many more. It doesn't pay really attention to it. Obviously, the market continues to, and it's been a continuing story for us as we watch it cross the 50,000 mark only a few days back.
Yeah, and nearing that $1 trillion market cap level. I mean, it seems like only yesterday we were talking about, Apple hitting $1 trillion market cap, Amazon, Microsoft, Bitcoin now. And also, we are starting to see, certain hesitancies. Obviously, Griffith, the most recent one, but also there was a note from JP Morgan this morning addressing Bitcoin, calling it the economic sideshow, saying that it really wasn't a good uncorrelated hedge to equities. That said, there was this ETF that debuted in Toronto yesterday, 10 million shares that had exposure to cryptocurrency, skyrocketed on its debut. Certainly seems to be very few hurdles from this investor skepticism, albeit kind of sparse as it may be at this time, Carl.
Yeah. Guys, of course, the street's still digesting everything that we got out of the House Financial Services hearing yesterday, to the degree to which we learned anything new. But there were some interesting exchanges, especially with Vlad Tenev of Robinhood. Listen to this.
At that exact moment, did you have the liquidity for $3 billion? 5:11 a.m.
At that moment, we would not have been able to post the $3 billion in collateral.
Leslie, I've been dying to know what lessons you drew from any of the Q&A.
Yeah, I think that exchange right there was the most revealing, because we have seen a little bit of this back and forth from Tenev over the past few weeks about what his company was really going through during January 28th that led them to the decision to restrict trading in certain securities. So was there a liquidity problem? Was there not a liquidity problem? He kind of has gone back and forth over what exactly was going on. Of course, they were ultimately able to raise $3.4 billion in venture capital. They were able to restrict buying of certain securities, which limited their volatility profile, requiring them to post less collateral to their clearinghouses. But he admitted in that exchange right there that, yes, at that point in time, we had a big problem. And what's important about that is not just that it's a Robinhood story and you know, this will go away as some kind of blip, but it exposes potential vulnerabilities in the system. It exposes potential risks in the system. You know, I remember that morning I was talking to hedge fund managers across the street, and they were saying, you know, if Robinhood has a liquidity problem, that's a big issue for the broader market as well. So this is something that would affect everybody. And I'm really looking forward to speaking with Representative Gonzalez next hour about this very exchange and, you know, what it means to him and the rest of the lawmakers with regard to, you know, potential regulation needed. You know, because unlike FDIC insured deposits, these are not, they don't have the same kind of protection right now. So if Robinhood were liquidated, that would be a big problem for its 13 million customers, David.
Yeah, I don't think they fully understood the risks inherent in their business, I think, Leslie. And, you know, the first lesson, of course, when you have a liquidity problem is never admit you have a liquidity problem. Right. That's, you know, that's 1, 2, and 3 in the list. Don't ever admit it, because when you do, then you do. Then you got an even bigger problem. And so you could expect that Mr. Tenev would have, you know, danced whatever dance he needed to avoid that question at the time in question. But there's no doubt they did.
Right.
There's no doubt they did. They had not anticipated, of course, as few could have, what went on during the course of those few days. And they clearly needed a lot of money, and they needed it fast. Thankfully, they were able to get it.
Yeah. He called it a 1 in 1.35 million event. So a 5 Sigma event, something that was rare, unexpected. I don't know, David. I don't know how statistically rare something like this is, how likely it is to happen again. You know, nothing has structurally changed that could prevent, you know, a group of traders from causing volatility in some illiquid names.
I know. Listen, I feel like I've had a fairly long career at this point, Carl, but I feel like I've lived through a lot of those 1 in 1.5 million events. I mean, long-term capital, those geniuses, remember them with all their Nobel Prizes? That also was like, well, whatever, I don't know how to express it, but never could happen. And, of course, it did. I mean, we can go down the list. These things happen a lot more often than you think, given the odds. Yeah.
No, we are living in the age of black swans, David. That's well said. To the degree that there's going to be follow-up hearings, of course, on policy and regulatory follow-ups, we'll keep an eye out. By the way, Griffin's interview, although full of very truncated answers with Andrew, was pretty good. He did talk about this notion and this allegation that hedge funds somehow had influence over the restrictions of trades on Robinhood. Here's what Griffin said.
The big picture is this conspiracy theory that we somehow or another are like some of the big tech giants that have access to personal identifying information is just flat out false. We have a price, quantity, a limit. That's what comes to us in an order from a retail broker.
All right. So, Leslie, how much skepticism is that going to be met with?
I mean, I think it will be met with skepticism, but I think this idea of data collection is what brought the whole payment for order flow controversy to the fore in the first place. People realize that, oh, if we're trading for free, someone must be paying for it. They later learned that it was Citadel Securities and other market makers who have this whole process called payment for order flow, and people started analogizing that to the big tech giants and saying, what do they do with our data? What do they do with our information? I don't want these big Wall Street firms having my information and doing something nefarious with it. You know, it's obviously a different business than what, you know, big tech companies do with regard to targeted advertising and other things of that nature. You know, the information, the data that they are collecting is just based on trading, and they make money on the spread. They're not selling your data elsewhere. They're not, you know, using it in other ways. It's the money making occurs based on executing that trade at a certain price. So that's interesting, point number one. Another thing that came out yesterday in the hearing was this idea that Melvin Capital, which of course has become, you know, targeted on these Wall Street Bets forums, is kind of the poster child of the hedge fund industry, being on the other side of that GameStop trade. They suffered 53% losses as a result. Gabe Plotkin, though, noted that at this time they now have data scientists in-house who are now combing through data on Reddit forums. So we've kind of gone full circle. They clearly don't want to make that mistake again. So they are very closely monitoring what is said, not just about the firm, which there still is quite a bit said about Melvin Capital, but just also about various stocks and what kinds of vulnerabilities they might have to the next GameStop, perhaps.
Yeah, I thought it was interesting, Carl. In Sorkin's interview, Carl, Riffin did question how long that trend will continue. How long will this Reddit play, so to speak, actually be in play? And he didn't, as none of us do, he didn't really know, but he certainly indicated it's a significant one right now.
Yeah, I tweeted a job posting yesterday from a quant fund that is has an opening for what they're calling a sentiment trader, pays $200K, where you'll, quote, spend most of your time on Reddit, on Discord chats and Twitter to feel the pulse of tens of millions of retail traders. So I don't know if that's going to be a thing, David. It seems a little bit of an outlier, but clearly they're going to have to recalculate their exposure and I guess their reaction to whatever retail may hand them.
Yeah, very interesting. I know. And again, the question is, how long will this trend continue? Will it only be, frankly, exacerbated by the fact that, again, back to the potential $1.9 trillion bill working its way out of the House and the Senate? Will it be, you know, when people have $1,400 checks? Now, many of them need the money to pay for food, but there is this idea that some of it will end up, as Goldman Sachs indicated earlier this week, Carl, in savings and or in the market. And so, you know, how long will this be with us is one question. At some point, one would imagine they'll come up with an AI that will take the place of the person who's trying to figure out sentiment.
Right. As well as TV anchors and everybody else.
Oh, yeah.
Guys, we'll take a break here. We're going to dive into what's happening in Texas today and what may happen over the weekend, the implications for not just chip shortages, but auto production, food supply, and a lot more. We'll get into that when we come back. We're back in a minute.
With a bang, energy and seismic or small.
Business.
If you can keep your head when all about you are losing theirs, if you can meet with triumph and disaster and treat those two imposters just the same, the world is yours to trade and invest. See it, IG it.
The defense has picked up 8 points. Let's come back because it's a do-or-die raid, and it is done and done.
With Srikanth Jadhav perhaps, but Visham Devadiga has been the choice, and he has struggled.
Kabaddi is the second most watched sport in India and is even growing internationally. So what's all the buzz about? How do you play it?
kabaddi is played on a 13 by 10 metre court and is separated into two halves by a midline. The game is played between two teams made up of 7 players each. The teams alternate between raiding and defending. The raider's objective is to go to the other half of the court, tap one or more of the defenders and return safely within 30 seconds.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
The semiconductor industry now facing another challenge related to that shortage, and that's the weather. Our Josh Lipton has more on that. Morning, Josh.
So, Carl, just when they are needed the most, chip plants are now getting shut down. That's due to these severe winter storms we're seeing in Texas, which have left so many suffering, and they are impacting business, too. Now, forcing chip makers around Austin to suspend operations. For example, NXP, which makes chips for cars, says it halted manufacturing at its 2 Austin facilities. Company says once utility services are restored, its team can evaluate when full production resumes. Samsung, one of the biggest chip makers, is feeling the bite as well. It had to gradually halt operations in Austin after being ordered to do so by local authorities. Analysts estimate that the plants represent about 30% of Samsung's overall production capacity. Infineon, also impacted, now idling its Austin plant. Company spokesperson saying the company is evaluating the impact and following local guidelines on reopening. Remember, all this is happening during the most serious chip shortage in years. It's impacting production on everything from computers to cars. Chris Caso at Raymond James says these shutdowns could exacerbate the problem. That is not good news for chip customers like the automakers, but it could be good, he argues, for the chip makers themselves. Shortages push out demand. They don't destroy it. In other words, these chip makers are going to still ship everything they can make and maybe even see their margins expand because they're going to have to allocate scarce supply to their highest margin customers. Chris's top picks right now, he tells me NXP and Microchip, Micron in memory, and Qualcomm in handsets. Carl, back to you.
That's a great setup, Josh. Thanks, our Josh Lipton. It does remind me, by the way, Leslie, you talked about this on the show yesterday. Wells today takes Western Dig from $65 to an $85 target, but it just sort of feeds the overall narrative, and that is that we're going to be talking about scarcity in general on a host of products all year long.
Absolutely. I mean, when we look at just what, 4 days worth of a situation like this where so much of the supply chain has been disrupted, look at what's going on with vaccine distribution in Texas right now. It's not just limited to chips, but the whole economy in the state is basically turned to a halt. And there was that really interesting article in the Texas Tribune. I think it came out yesterday afternoon where they said that the system was within seconds or even minutes of having a complete failure for months on end. Can you imagine what that would mean for the state's economy, especially in a pandemic where people are so reliant on not just power to stay warm and do their basic jobs and lives, but their jobs are taking place so much more online. Their ability to connect with, family and friends is so much more online. And so the thought of the state of Texas not having power for months on end in the middle of a pandemic, it's pretty scary when you think about it.
Yeah, and of course, we're going to keep an eye. This story that Josh was outlining so well for us about chips is not going anywhere. We talked yesterday to Vincent Roche, CEO of Analog Devices. They're going to meet their guidance, but, and perhaps they can exceed it, but in part they are reliant on other wafers coming in that they then do things with. And it's going to be a story, as he said, that we're going to be dealing with these shortages throughout the rest of the year. Obviously, we see it, Carl, perhaps manifest most in the auto industry. We're talking about Ford and GM, for example, but it will be sort of throughout. And then we come back to this idea of a national champion. I look at Intel there and what that will mean as the U.S. government tries to sort of figure out a policy there to make sure that we have adequate supplies domestically as well of chip-making ability.
Do you think that M&A solves the problem at all?
Unclear. Unclear at this point whether that would be the case. When it comes to M&A, we obviously are looking at NVIDIA, which is in a deal to acquire ARM. That certainly has some potential issues. Qualcomm has tried, Broadcom. It's possible, Leslie. But again, then you'd have the U.S. government sort of weighing in a significant way from an antitrust perspective. On the other side, Carl, though, being a national defense perspective as well, given the two are tightly linked when it comes to chip making.
Yeah, that sort of folds into the president, of course, speaking to the G7 actually right about now, and his comments are expected to emphasize less of a, quote, America First policy like his predecessors and more of a multinational cooperation policy. We'll see what readout we get from that. We'll take a break, guys. Plenty of vaccine news to get to. This Israeli study on Pfizer, a couple news bits on J&J, and some interesting upgrades and downgrades, including a double upgrade of KB Home out of Goldman to buy. We're back in a minute.
Divided by distance, united by business.
This is the new reality we're all
Helping you navigate the new normal. Squawk Box on CNBC.
For retail, actually, we don't want to get into long leases at the moment because, we don't want to lock ourselves up. I think this is definitely the bottom of the market. With the fourth wave ended, social distancing measure is lifted, I think, I'm hoping that the worst is over for retail.
It's one of the world's largest accommodation search platforms. Trivago CEO Axel Heffer talks COVID's impact.
It's a very difficult point in time right now. In most countries, there are tight restrictions.
Recovery.
We definitely expect domestic to be the majority of the market. It will take some time to rebuild that confidence in travel overall.
And the future of travel.
We are using structured data to provide you with inspiration of where to travel.
Don't miss the CNBC Conversation.
We were just talking about companies exposed to semis. There's AMAT this morning, going to open up almost 6%. 139 beats 128. Revenue ahead, pretty good guide. KeyBank goes to 144. Cowen goes to 145. Should be interesting. More Squawk on the Street, and the opening bell continues in just a moment.
At C3.ai, we're solving previously unsolvable problems. Inventory optimization, predictive maintenance, anti-money laundering, operational readiness, precision healthcare, energy management. C3.ai is AI built to transform your business at its core. C3.ai, this is Enterprise AI.
When the future first arrives, we often don't recognize it. Interactive Brokers founder Thomas Petterfy brought the future to the floor of the American Stock Exchange in 1983. The company had fabricated Wall Street's first mobile computer, and it changed finance forever. Today, Interactive Brokers continues to push finance forward by building the latest technology you need to increase your success. Move your account to Interactive Brokers.
The initial conservative is going to take around 15 months for Indonesia, but the president really asking us to accelerate within 12 months.
The target is to vaccinate 80% of our population to achieve the herd immunity.
So by the end of this year, 40 or 50% will be covered by the vaccine.
Why only 55%? Because that doesn't sound like herd immunity.
We have around 40 million who are below 18. Medical authorities do not recommend them to be vaccinated.
We hope to get most of our people vaccinated by the third or the fourth quarter of this year. If we get the vaccines faster, we'll be able to roll out the program faster.
The vaccine, I think, is a turning point, but don't underestimate testing. I think if we can get testing to 45 seconds, 30 seconds, that will also be a groundbreaker.
Keep up with the crisis. Squawk on the Street on CNBC.
Deere's going to open close to 318 this morning. Was a $100 stock in March of last year on earnings. 387 crushes 214. Revenue ahead. They do raise their guide. David, you know, we've talked about Deere over the years mostly as an ag play and kind of moved sideways during the trade war with China. But if infrastructure happens, we'll talk a lot more about its smaller but still sizable construction business.
I'm sure we will. And Cat has moved along with it as well. I'll send it back to you, Carl, because I think, if I recall, there was a time when you covered this company, wasn't there? And perhaps you can give me a better sense as to, you know, what the economy we're in right now, and it seems to be playing to its strength. Obviously, farmers have been quite strong as well.
Yeah, I mean, I don't want to tell you when I covered them because kids, there are people alive now who weren't alive then. But yeah, I mean, we've moved past a period, David, where we're talking about farm income being supported by government outlays and basically socialism for the farm belt to a period where you got grains and soybeans all with strong pricing power, farmers trying, you know, having paid off some debt and now saying maybe it's time to upgrade the tractor.
Yeah. Carl, I think what you meant to say is there were people who are adults now who weren't alive when you were covering.
Yeah, exactly right.
And he's young, by the way.
No, that's going to be an interesting story.
Yeah, it will be. But that move, I mean, look at that move. You know, Leslie, again, there's many stocks that we can put up with similar charts that this time last year, or let's talk a month from now, a year, 11 months ago, you would never have anticipated the moves that they've had.
No, I mean, Deere has certainly been a beneficiary of some stockpiling that's been going on that's helped boost the prices of a lot of commodities that help their downstream customers. And therefore, as Carl was mentioning, they were able to use that additional revenue and come from a position of strength where they can pay off some debt, they can upgrade their machinery, and that, of course, helps Deere.
Yep, we'll see how that feeds into the overall tape this morning as we get the opening bell and the S&P there at the bottom of your screen. As we said, we're coming off 3 straight losses for the S&P, which we've not done since December. But the Dow, largely because of their exposure perhaps to more financials, is still on track for a weekly gain. David, we haven't yet mentioned some of the vaccine news, but this Israeli study on the Pfizer vaccine that basically argues 85% efficacy after 1 dose, but after about 15 to 28 days is pretty encouraging. And by the way, Pfizer also now submitting some new data to the FDA on on temperatures that would be more like standard refrigeration, at least for a couple of weeks, which would definitely help logistics.
All of that would, right? Being able to move it more easily, obviously not requires quite as much refrigeration, and that 85% number is something worth noting, as you already have, Carl, because it may mean that we change the protocols to some extent, or not as concerned with people getting their second dose immediately, and therefore being able to inoculate more people more quickly and bring it to an end, Leslie, or at least get to that so-called level of herd immunity. I'll leave it to all the epidemiologists out there to take it from there, but it's certainly potentially positive now.
Yeah. Especially if you're going to need a booster shot to kind of take on some of these variants anyway. You know, again, not an epidemiologist, certainly not an expert here, but it sounds like encouraging news on that front. I don't know if you guys saw this Bloomberg story that noted that there's a vaccine surge coming. They looked through a variety of comments from the drug makers and the government and studied some of the supply deals, and they found that the U.S. government is currently constrained to about 10 to 15 million doses per week right now, and that figure could go up to 20 million in March, more than 25 million in April and May, and 30 million a week in June. So by summer, that would be almost or more than 4 times the amount of shots going into arms per day that we're seeing today. So also encouraging news, at least on the supply front, you know, potentially a light at the end of the tunnel. I don't know what that means for the 3 of us and others who are still waiting their vaccine, but, you know, a slew of relatively encouraging news on the vaccine front today, Carl.
Yeah, I know yesterday JPM had a note out, guys, just on Israel, not looking at any global picture, but given 40% of Israelis have been vaccinated at this point, their baseline scenario at JPM for Israel is that new infections and deaths go to 0 by the middle of the year, which kind of sounds too good to be true, and there's lots of caveats about why the U.S. may not be quite a perfect analog, but that would be obviously amazing if they could essentially wipe this out for all intents and purposes by the middle of summer. Speaking of all the reopening stuff, David, I don't know if you noticed UAL announcing new service from Boston to London. Six Flags today with a note out saying they're going to hire to have all their parks and water parks open by the summertime. So that reopening plays definitely evident today.
No doubt. And I think that there are many investors right now who are wondering just how much demand there will be for airlines, for seats on airplanes, Carl, when we do get to full reopening, and perhaps, you know, by the summer that will be the case. One would imagine there is a great deal of pent-up demand to go places, and so we could see a real spike and perhaps an ability of the carriers to raise prices significantly given the demand that they may see. At least that is one thesis that's out there. Again, we'll see how it plays out, but you can see the stocks are responding quite positively this morning, at least, as you said, to various news, and at least UAL increasing flights and or destinations. Where are we? 9:33. I think I only mentioned SPACs once. You know, on the when the ringing the bell there was Butterfly. That was Jonathan Rothberg, who's joined us a couple of times. SPACs have been very good to him, of course, and Butterfly has been one of them, which has been very good overall. Did want to get to our weekly SPAC roundup if we can. And Leslie, I'm glad you're here because you've been following this story, this trend very closely. I wasn't kidding earlier when I said there's 2 things hedge fund managers want to talk about. It really is. It's basically the economy, what's going to mean for the overall market, and their SPACs, or their lack of a SPAC, or their plan to have a SPAC. Many of them, frankly, making more money from their SPACs and or investing in them than they have from running their hedge funds. You know, one hedge fund manager saying to me, nobody wants to put money in a long-short hedge fund, but they're going to give me plenty of money for my SPAC.
It's true.
The numbers this week, let's give them to you, 16. So it's down from last week. Again, these are from our friends at SPAC Analytics. 16 raised $3.4 billion. But here's the real interesting number. 160 SPACs have already gone public this year, right? So what are we, 6 weeks into the year, something like that? And 143 have filed. So with the SEC to go public and have yet to do so. So you can see we are quickly approaching over 300. And then the question will become, Leslie, what do they all look for? What do they all go after? Are they chasing after similar names? Or do we get, in terms of quality, lower and lower on that? We've already seen so many of these companies that are really development stage still. They're taking what would otherwise be kind of mid to late stage venture capital money. Instead, they're taking it from the SPAC and going public. And we talk about them. We've had them on TV, and many of them look very promising, but the question becomes how many will actually follow through to real profitability when they're talking about multiples on numbers that are 5 or 6 years out. And there's, just to put it in perspective, where we are this year versus last year already.
Oh my gosh, yeah, we are definitely on pace to surpass last year's just monstrous year in SPACs. But you bring up the point of, how it impacts the hedge fund and private equity industry, this idea that people really do see an easier path to making a lot of money by going the SPAC route versus by going the traditional private equity venture capital hedge fund route. The question I have is, how does a SPAC, and David, you might know the answer to this, how does a SPAC impact their LPs? Do the LPs, I know it differs largely based on the SPAC and the way it's set up,
right?
But do LPs in said hedge fund or in said private equity firm also see the upside, or is it just the managers of the SPAC that are seeing the huge dollar signs by doing this? I'm just trying to wrap my head around, obviously the manager of the SPAC benefits, but is there also
right? I don't believe so. I don't believe so. But it's a good question. But I think it is a separate entity run by the hedge fund manager based on their expertise in picking stocks and therefore their ability to potentially pick targets for said SPAC that they are sponsoring.
Yeah.
And let's not forget, hedge funds obviously benefiting, as are many investors here, just from buying on the initial public offering of the SPACs. Sometimes they get redeemed, but they still own the warrants. They arbitrage that. They're also, the SPACs, Carl, are just going up as we show our SPAC post-deal. I'm glad we got that. So that's after the deal announcement, right? On their way to de-SPACing, as Butterfly did. That's why they were ringing the bell. Now they're just a regular public company. We can't say they're a SPAC anymore. They fall out of this. And then we've got the index that just shows we went public as a SPAC. There's Butterfly, which has been an incredible performer. We went public as a SPAC, but we have yet to do our deal. And that's even more significant in a way as you take a look at it, because look where that's trading. Just showing, Carl, the overall enthusiasm for these. And it's not going to stop. And in fact, it's going to keep growing. I talk to bankers now, M&A bankers who are quite busy with deals, but frankly also spend an awful lot of time talking about SPACs and the possibility that we're going to start to see corporations as the main sponsor. Simon Property did something, but this is something that become a lot more commonplace as well. Not to mention companies using SPACs to dispose of divisions that they no longer want, instead of spinning them directly or doing something else, going the SPAC route, Carl. We'll keep talking about it because it is an important trend that is going to, I think, be with us for quite some time.
Yeah, taking advantage of where sentiment is right now, David. By the way, it sort of reminds me on a similar vein of companies. We mentioned Chegg and Zillow yesterday taking the opportunity at these market levels to issue some new shares. Twilio did announce $1 billion in new shares. I saw some reports on pricing somewhere around $425, I think. But that's going to be, I think, a $65 billion market cap on Twilio, having come off of earnings earlier in the week. So it just all feeds to what you're saying, David, and that is that people are looking for opportunities in an era where yield is a little bit tougher to find. I did want to get you, I wish Jim were here, David, because this Goldman call on KBH, the idea that a home builder at this point is worthy of an upgrade, it feels like it's a little bit long in the tooth, given what rates have done. And in fact, some of the home builders have come in a bit, KB included, but they go from sell to buy. We look for an outperform over the next 12 months. They're talking COVID secular shifts, demographic secular shifts, and then just demand. They go from 32 to 51.
Well, they were on the wrong side of this stock, I guess, for a while, Carl. Now that's interesting. Now they're on the right side, I guess. Although the one-year performance, as you see there, is not particularly strong. About a $4 billion market cap on KBH. Interesting call. I did want to also move quickly onto a name that we have talked a great deal about lately. That's Palantir. It's been down sharply after earnings. The lockup expiration having just passed, and you did have some sellers. You saw the weakness in Palantir shares yesterday, but today reversing and reversing significantly. Did note, as we all take a look at Kathy Wood's nightly rundown of what they bought and sold at ARK Investments, and they did add, what was it, 5.2 million shares So a fairly significant dollar-wise as well of Palantir. Maybe that's helping, but that stock is rebounding. Again, there were a bunch of sellers yesterday getting ready for or taking advantage of the expiration of the lockup. And, you know, there's still going to be questions in this market, Leslie, as well, just about multiples. I come back to that Goldman report saying a 30+% top-line grower is deserving of a 44 multiple to sales on 21 sales. They were speaking specifically of Palantir, Goldman, when they did upgrade the stock earlier this week. I don't know. And meanwhile, I take a look at the likes of a Viacom, which just kept going up and up and up and up. I keep pointing it out because it's extraordinary. And the fact is that it's now trading at a higher multiple on 23 numbers than Facebook. Not talking Palantir anymore. I'm talking Viacom and Facebook, but still, just to give you a sense of what's going on in this market.
Yeah, I just took a look at the orders by Fidelity customers, which shows gives you a sense of at least that pocket of the retail community and how they're trading today. Palantir, #1, most active, followed by Apple, Riot Blockchain, Tesla, which is usually among the top 5, and Churchill Capital, CCIV, which is another Michael Klein SPAC that everybody is very excited about, a potential merger there. So definitely caught the interest of the Wall Street Bets community. Really during the hearing yesterday, people were talking about that, Carl.
Yes. Yeah, GME had some pops intraday based on what was being said on that virtual hearing. Guys, we do have Caterpillar leading the Dow. That's an all-time high on Cat, probably off of the Deere news. Let's get to Bob Pisani. Hi, Bob.
Good morning, guys. Of course, Janet Yellen talking stimulus. That kind of helps the market a little. And it also helps that semis have been turning around. We had a rough week, a really rough week and a half on semiconductors, but I think Applied Materials is really helping. Take a look at the sectors. There you see, you haven't seen semis as a leader in a while, folks, and that's a good sign. We need technology to lead. It's been very flattish in the last week and a half. Apple is down again today and again this week. So tech's got to step up here. Banks doing a little bit better. Industrials, here's the reopening trade. Energy, a little bit on the flat side. They're a little weaker. You know, oil's down. U.S. is reopening talks with Iran there. Just want to mention Applied Material because it's moving the semiconductor space. We're at a historic high. I think 118 was the old historic high for Applied Materials. But the important thing here is just an incredible earnings report. Beat, raised in the quarter, a strong outlook. The semiconductors are on fire because demand is exploding across the 3 areas that really matter to them. And Gary Dickerson, the CEO of Applied Materials, was talking about this morning. Cloud services, data center, they expect demand to grow 15% this year. Automotive, because chips are all over cars these days, demand up 15%. 5G handsets, they're expecting double-digit gains. So demand is exploding right across the board. The other great earnings report today was Deere. I know Carl mentioned it. Huge beat. The beat was 80% above the street estimates. That's amazing. And they had big boost in the full year guidance. And here you look at their construction business. It's going to be, was up 21%. The small agriculture, there's the farm equipment stuff, up 27%. And they have another division. They reordered this a little bit. Precision, that was up 20. Everything's up 20% overall. And this is before COVID. This is the quarter that was already over. So Deere is also, of course, at a historic, I think 317 was the old historic high. You see, we're sitting well above that right now. Finally, just want to mention the whole Robin thing and the key takeaway. And here's what really matters. The most important thing was that payment for order flow generally works if you get best execution. That word is going to get a lot of attention in the next few weeks. It generally involves best price, but also can involve price improvement. You heard Ken Griffin talking about this a lot. Price improvement. What does it involve? Well, it's competitive. Brokers like Schwab, they have these routing wheels that send the orders to the market makers with the best price improvement. So Citadel, Virtus, Susquehanna, they all compete to provide that best execution, best pricing, price improvement. And if they don't, they get less orders from the brokerage. So it's the brokerages that actually are out there making sure they do it because they want to show their customers and their regulators that they are indeed providing best execution. So watch that word. People are going to hold them to that. And I think, guys, here, the key is that market makers like Citadel are able to provide price improvement for a couple of reasons. Number one, they internalize. They fill these orders from their own stock. They don't go out to exchanges where they'll have to pay rebates. That helps them. And number two, Ken Griffin emphasized this. They're able to bid in sub-penny increments. The stock exchange can only bid in 1 penny intervals between the bid and the ask. The non-exchanges they can do sub-pennying, and that enables to provide very, very modest price improvement below a penny that actually gets them that order flow. That's an advantage that they really have right now, and even Ken Griffin admitted that he'd like to see a more level playing field to a certain extent with the rest of the exchanges. Carl, back to you.
All right, Bob, we'll see you in a little while. Bob Pisani, there's a lot to watch on the rate front and the currency front today as well. Let's get to Rick.
Yes, Carl. And before we even get to the charts, let's look at what's going on with our February preliminary read on the market, MARKIT, manufacturing, composites, and service PMIs, and they are hitting the wires. 58.5 is on the manufacturing PMI. That is interesting because it backs away a bit from the cycle high, recent cycle high of 59.2. If we look at the composite at 58.8, that usurped its cycle high, COVID cycle high, by 1/10 from 58.7, which was the cycle high. And finally, we'll finish up with the service composite PMI. This is the largest swath of the U.S. economy. And at 58.9, it usurps the 58.4. That was the final read, the high post-COVID, and that was in November. So definitely some improvement there, but remember, these are preliminary. Now let's get to the charts. And you know what? A week to date tells you a lot of information on 10-year note yields. Of course, we are now up 10 basis points on 10s, 10 basis points on 30s for the week. These are substantial moves. But if you think they're only in the U.S., you're wrong. It's all high-quality sovereign debt. If you look at what's going on with regard to 10-year boons, here's a one-year chart, here's a one-year chart of our 10s. You can see the move, one-year highs plus. Look at boons for a one-year perspective. Not quite at the one-year mark, but we're definitely testing some key levels. And in this case, that minus 27, and we want to pay attention to that. And finally, a 1 year of the UK gilt, their sovereign, at 68 basis points. You can clearly see the run-up, and it will continue, in my opinion, as we continue to make progress, of course, against COVID. And you see these large stimulus plans being floated, not only in the U.S., but other large economies as well. Carl, back to you.
All right, Rick. Thanks. Rick Santelli. We'll see you in a little while. Keep your eye on Dropbox today. Shares are down a touch despite a beat on the top and the bottom line. More paid users, better than expected revenue per user. They did guide a little light on full-year revenue. Do have some price target increases, though. JPM goes from 29 to 34. Stock's down, though. We're back in a moment. It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
I'm not quite sure at this stage. I mean, we certainly want to get back to a 70% payout ratio as quickly as we can, but we just do want to be have confidence in see more stability and confidence in our future revenue before we do that. So I think going to 60% now is a good sign that we have a good level of confidence. We'd like there to be a bit more. So it may be the full year, but it could be later than that too, just depending on how this half pans out.
We're ushering in the year of the ox. After an unprecedented year of turmoil, we'll look at what's ahead.
The U.S. is in recovery. The rest of the world is starting to catch up.
As China marks a major milestone.
The CCP goes into its 100th anniversary feeling very confident.
And will travel finally get back to normal?
In a normal year, you will see hundreds of millions, maybe 200 million people out there on the move. But this year, probably only at 50%.
All that and more in our special year of the ox, Plowing On.
Disney's an interesting story this morning, still up 4% for the year, but Down Detector with some reports this morning that downloads or streaming of the new episode of WandaVision caused some technical difficulties for Disney+. Talk about a first world problem, but Disney hanging on to 184. More Squawk on the Street continues in just a moment.
Daybreak in the US.
Trade nerves all around. Tech stocks down again today.
Start on top of the news. Brian Sullivan, Worldwide Exchange on CNBC.
Most countries will experience recessionary-like conditions. Is it necessary for another 1.9 trillion to be directed at the economy?
We do need some more fiscal stimulus to continue to bridge the gap, to continue to allow us to move through this tunnel and get to the other side.
It is still about crossing that bridge to the recovery, but where the journey seems to be a little bit delayed, but should not be derailed.
We want to accelerate on the vaccine because we are fully aware that there is a direct link between vaccine and economic recovery.
We're starting to see some cracks here, and the EU is just the latest example.
People are focused on right now, when are we going to get our vaccines? This next generation, which we are seeing, and I think those will be flowing quickly around the world.
The challenge will be not a global distribution. The challenge always is finally the last mile.
Your grandma isn't the only one having trouble getting the vaccine. Bertha Coombs explains as we close out the hour. Bertha, what's going on with corporations?
You know, Leslie, large employers of essential workers feel an urgency to get their employees vaccinated, but like the rest of us, they're struggling to get their shots. Tyson started vaccinations for workers in Illinois, Virginia, and Missouri yesterday, but they got a total of just 1,000 doses for the 3 plants. Up until now, they've gotten maybe 25 to 50 doses at a time for nurses and staff over 65, but with 120,000 workers across 24 states, they're really taking every dose they can get.
We're not turning down any opportunity to obtain vaccine for our team members.
Yeah, opportunities are few and far between, though. Tyson and other meat packing firms have come under fire for widespread outbreaks early in the pandemic. Managers at its Iowa plant fired after betting on how many workers would get sick. It's prompted a congressional probe. But in the last year, they've instituted testing and other safety measures with their occupational health provider. And they've been using the time to educate workers about the vaccine. But the missing piece is supply.
We're coming to these jurisdictions asking for, 1,000 or 1,500 doses. They don't know going in sometimes how much they'll have to actually allocate to us. And so that's part of the challenge, is really not having that line of sight.
Tough for local officials when they've got Walmart, Amazon, and other employers asking for big allotments as well. In the meantime, Tyson is giving workers 4 hours of paid time off if they can get appointments to get their shots off-site. Carl?
You know, Bertha, it raises an interesting question. You know, there's certain livestock where you process by automation, but when it comes to chicken, it's very hard to process by machine those smaller animals, and that's why you have to have workers end up being close together at the facility.
Yeah, they do, and they've done some partitions with plastic sheeting, and obviously they have masking and they have testing, but ultimately the best thing is going to be for people to be vaccinated. The one thing that helps is with this time, they've really been able to get more people convinced that they should get the vaccine, but the more people who get it, that is really the best evidence that it's safe, and they are just waiting, like everybody else, for more supply to come online.
Right. Bertha Coombs. Thanks, Bertha. We'll talk to you in a little bit. Bertha Coombs, thank you. Dow's up 51 points on this Friday. More Squawk on the Street continues in a minute.
Travel brands need to keep a very tight balance between being visible and not forgotten, but at the same time being empathetic and really being responsive in the environment that they find themselves in. Certainly as South African tourism, we've really kind of taken an approach that says we want to make sure that we're visible in our important markets, but at the same time really handing power back to the consumer. When they're ready to travel, South Africa will be waiting for them. Communication, communication, communication. You over-communicate. Even when you've got nothing new or have any new information, you got to be present out there. You've got to lead the conversation. You have to give comfort both to the trade, the sector itself, and also to the consumer. That's how you build confidence. You also build confidence by informing and educating the consumer. Because an educated traveler becomes one that is informed. They know exactly what to expect, and more importantly, they know what to demand from the destination once they get there.
On the next Managing Asia, the man running Singapore's largest supermarket chain, FairPrice Group.
Before those gone orange, we could already see, the build-up of crowd at our stores. They were buying like there's no tomorrow. We're managing stockpile, covering a few key categories. We have had to review and rethink many of our strategies.
Sia Kian Peng, CEO of FairPrice Group, on the next Managing Asia.
Tyler Matheson, Melissa Lee, Kelly Evans, Our Lunch on CNBC.
Good Friday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with David Faber and Leslie Picker. Morgan has the morning off. Markets hanging on to some gains here this morning as we watch continued signs of relief in Texas, Yellen's push for stimulus, and some pretty decent vaccine news. We are getting existing home sales, and for that, we'll turn to Diana Olick. Hi, Diana.
Hi, Carl. Yeah, existing home sales in January rose 0.6% to a seasonally adjusted annualized rate of 6.69 million units. That's up 23.7% year over year and the second highest sales pace since 2006. That's a beat. The street was looking for a slight drop. The supply continues to be the problem. 1.04 million homes for sale. That is a 1.9 month supply, down 26% year over year, and that's pushing prices higher. Median price of an existing home sold $303,900, up 14.1% year over year to an all-time high for January. Things are selling very differently, though, depending on price point. Homes priced below $100,000, down 28%. Million-dollar homes, sales up 77%. And finally, the days on market, very fast, just 21 days to sell a home. That's down from over 40 days 1 year ago. Carl, back to you.
Unbelievable picture in the middle of winter, too, Diana. Thank you, Diana Olick, with signs out of existing. Market's still trying to get some takeaways from yesterday's House Financial Services hearing about GameStop. Joining us this morning to talk more about that is Fred Tomczyk, former CEO of TD Ameritrade and a current BOE Global Markets board member. Fred, it's great to have you back. Good morning.
Good morning, and thanks for having me, Carl.
I'm dying to know what takeaways you had. I know in general you're anxious to get this out of the political sphere and move it into the hands of regulators where hopefully there'll be a judicious take. What did you learn yesterday?
Well, you know, when you look at, I listened to the hearings yesterday, so much of it was rhetoric and sort of, I'll call it conspiracy theories that people were espousing or talking about. And we seem to have lost the root cause of what's caused the issue here today, which is when Robinhood restricted trading on certain stocks. And at the root of that, you have to go back to the settlement system and the two-day credit. The 2 days of credit that causes that risk, which causes the increased collateral. And then meanwhile, we've gone off onto tangents around payment for order flow, shorting, and conflicts of interest, which are all things that have been around for decades, are heavily regulated, and we seem to have drifted back there as opposed to getting to the root cause and the fact-based analysis of what actually happened.
So if we zero in on, say, the settlement period, are you optimistic for changes on that front, and do you feel like the infrastructure is there to handle it?
Well, keep in mind that 4 years ago, we went from T+3 to T+2. At the time when I was still at Ameritrade, you know, we would have preferred to go to T+1, but the industry agreed to go to T+2 instead. You know, I think all these things, why I want to get it out of the political sphere and into the regulatory sphere, is you get people that really understand how these markets work and have the ability to implement new regulations that actually can move this forward. You know, if we move to T+1 or even T+0, that will take time because you have to get every player in the industry to move along with it. But I do think with technology today, it's the right move.
You know, speaking of technology, Fred, of course, the ability to conduct a trade now immediately on your phone, this so-called gamification, in a sense, of trading. What are your thoughts about that? Is it here with us to stay, and what risks does it present?
Well, I do think it's here to stay. I think, you know, for as long as I've been involved with this industry, we've always tried to level the playing field between retail and institutional and make it easier for people to trade whenever they want, however they want. And so, you know, the gamification is another sort of part of that evolution, as is social media, which is, you know, giving people information and ideas about what to trade and what to invest in. So they're definitely here to stay. It probably should be a review of gamification and social media in terms of, you know, what, if anything, regulators should do in that sphere. But the reality is, it is here to stay, and we're going to have to get used to it.
Fred, I think one of the key concerns about the potential gamification and, you know, addiction, which was another topic that lawmakers brought up yesterday, is this idea that it's so easy now to trade options. Easy meaning no friction with commission-free options trading. Easy not meaning that it's possible to have significant losses there. How do you kind of distinguish the ease in which retail investors can trade stocks and other types of kind of more traditional securities with those of derivatives?
No, well, it is easy to trade a stock. To trade a derivative is not as easy as everyone's making it out. I won't speak for Robinhood because I don't know what they do, but I know when I was at TD Ameritrade, you had to qualify to trade options, and then there was different levels of types of option trades you could do, but you had to demonstrate that you knew what you were doing and you had some education and training to move up that ladder. So there was friction, at least from my perspective, at least at TD Ameritrade, in terms of option trading, particularly when you have a trade where there's unlimited downside. You really got to be careful with that and restrict people to make sure they know what they're doing before they place those types of trades.
Yeah, but Fred, it's not clear that that's the case any longer, is it? I mean, we look at options volume. It doesn't take long to look at them and realize something has changed pretty significantly.
Oh, there's no question it's changed, David. I can remember at TD Ameritrade it being about 2% of our trading volume, whereas, when I left TD Ameritrade, which was 4 years ago, it was about a third of our trading volume. And the reality is what we saw there was the root of options is in risk and premium, as opposed to extreme betting. When people are buying call options, yes, they're betting a stock goes up, but a lot of the most common option trades are selling covered calls or buying cash covered puts, where you're collecting premium saying, I will buy that stock at that price or I'll sell that stock at that price. And those are the most common types of option trades.
Hey, finally, Fred, last month or two, all we've heard about are risks to the retail investor and painful lessons and broken trades. I think in general, your point is that the retail investors never had it better. Is that true?
I think that's very true. If you go back in any fact-based analysis through history here, the last 10 or 20 years, when you think about what the retail investor has today, they have free trading, free research, free investor education, and they have faster and better trade execution than ever. The playing field between the retail and the institutional investor is more level than I've ever seen it. The ironic part, when you stand back and look at all this, is the party that seems to have lost the most in this whole GameStop trading wasn't actually a hedge fund. It wasn't a retail investor, and many retail investors did very well. So in my mind, they've done very well, and they've never had it better based on smart regulation and the use of technology today.
Fred, that's a great way to button up what we heard yesterday, and obviously we're not done talking about it by a long shot. But thank you. Have a great weekend.
You too, Carl. Thank you.
Well, we are continuing to monitor the crisis in Texas. The grid failure leaving millions without power in freezing conditions in what is the state's worst blackout in decades. While power has now been restored for many, in fact most, clean drinking water still remains an issue. Government officials are asking residents to boil any water before drinking it. Governor Abbott speaking yesterday about how to avoid similar events from happening again.
I'm asking the legislature to mandate the winterization of generators and the power system. Second, I'm calling for the funding needed to ensure that this winterization and modernization occurs.
This morning, crude oil and natural gas prices are somewhat mixed. Of course, we'll continue to focus on those commodities and bring you any updates on the situation in Texas as it comes in. Leslie.
Yeah, still such a harrowing story down there. After the break, Treasury Secretary Janet Yellen making a major push for stimulus, what it could mean for the job recovery next. Plus, congressional leaders grilling the CEO of Robinhood on the Hill.
There were a series of steps that the Robinhood Securities team took to
reclaim the whole time, sir. At that exact moment, did you have the liquidity for $3 billion? 5:11 a.m.
At that moment, we would not have been able to post the $3 billion in collateral.
Representative Anthony Gonzalez will join us. Squawk on the Street. We'll be right back.
The countdown to the close of the European markets is sponsored by IG.
When can we expect some of these bottlenecks to be ironed out? How long is this supply shortage going to persist for?
So the manufacturing process is quite a complex process, and it takes quite some time to get new tools into the fab and to qualify it. So therefore, from that perspective, we need to assume that this situation will take several more months until we can see a relaxation in the overall supply chain.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC. Divided by distance, united by business.
This is the new reality we're all in.
Helping you navigate the new normal. Squawk Box on CNBC.
Package, the parts that are permanent will be paid for in order to not raise long-term deficits. But we're still working on the details of the package.
That was the Treasury Secretary Janet Yellen on Closing Bell yesterday, talking about the latest on infrastructure spending and potentially as well dealing with climate change. Let's bring in Pulitzer Prize-winning columnist for the New York Times, Jim Stewart. Jim, good to see you. I want to actually start. You too. It's been a while. I want to start with you on the $1.9 trillion relief package before we get to infrastructure. What is your sense there in terms of the impact it's going to have both on economic growth and perhaps even more importantly on the stock market?
Well, I think the question is there greater risk in overspending than in underspending is pretty clear. I mean, what's the risk of too big a stimulus? Maybe higher interest rates down the road, maybe a little inflation. But as Yellen pointed out, we have the tools to deal with this. The risk of underspending is further and greater unemployment, a downward spiral in the economy, possibly a recession. That is much harder to get out of. So I think her point about the risk is pretty indisputable. The point more, and of course, this is very good for the stock market. And I mean, just look at current levels, at which I think largely are anticipating a significant stimulus. That is very bullish. And ironically, the people who own stocks and are benefiting from this tend to be the ones that have not been hurt so much by the pandemic. Specific elements that are aimed at helping people hurt by the pandemic, I think, it's a very blunt instrument. It's not very closely tailored to help those particular people. And I think that is something that has troubled some of the critics of it. But nevertheless, if what you're trying to do is keep the economy thriving, it's not going to be perfect.
Yeah. And to be followed, as we heard from the Treasury Secretary, perhaps by a lot of spending on infrastructure. Now, that's something we've talked a lot about through the years. Jim, I know you think that that's something, and many agree on both sides of the aisle, that's needed. But throwing that much money after $1.9 trillion, do we run the risk of overheating this economy?
Well, I am a fan of infrastructure spending because I see that as an investment in the future of this country. I mean, when you improve the transportation infrastructure, you are helping every single person and business that takes advantage of that over time. And it will repay itself in economic growth, higher unemployment, and eventually higher stock prices. It also is another form of stimulus. I mean, I much prefer that to just handing out $1,400 willy-nilly to people, because that is not really an investment, except to the extent it helps prop up the economy. Will it overheat? I tend to agree with Yellen. Let's see what happens. I mean, we have been in a very unusual and long period of extremely low interest rates. The borrowing costs for the U.S. government are as low as they have ever been or probably ever going to be. So if we're going to tackle this problem, now seems like a really good time to do it. And if we start to see inflation creeping back, and I'm not saying it's gone away, I mean, there are conditions in which it will return. We do have better tools and I think better understanding of that, and the Fed can jump on that when we see evidence of that. And that, of course, would mean pushing up interest rates, and that will eventually be a threat to very high stock prices.
You know, Jim, it sounds like the playbook out of Treasury and the Fed is that there will be signs of rising inflation. We're starting to see it now, and things like Texas don't help. But that it will be transitory, and the back half of the year, maybe you realize that it was more of a head fake. Does that seem like a reasonable playbook to you?
I think it is reasonable. I mean, much of the current spending in the the 1.9 trillion bill is a one-time shot, and it will be it's like a boa constrictor swallowing a mouse. It will work its way through the system. The infrastructure spending is permanent, but it is going to be spread over a fairly long period of time. It's not like whatever the number on there, say it's $1 trillion, it's not going to just drop into the economy all at once. I mean, some of these are not shovel ready. It's going to take years for this to work its way through. So that will be something to keep an eye on longer term. But I think the immediate inflationary impact of the 1.9 trillion bill will in fact be short-lived.
Speaking of one of the longer-term goals that's currently working its way through, at least the House bill at this time, is that of an increase in the minimum wage to $15 an hour. What do you make of including that as part of the stimulus plan?
Well, I don't think it should be part of the stimulus plan, frankly, because it's not a stimulus. It has nothing to do with the pandemic. I mean, whether there should be a higher minimum wage or not is a question that predated the pandemic, and it's going to post-date the pandemic. And I think everyone who studied the issue knows there's a pretty simple trade-off. Yes, isn't it nice that you can, raise wages for a segment of the population that isn't earning a high hourly rate? But the downside of that is the government's own, economic organizations have pointed out is you're going to lose millions of jobs. And you're going to lose them right now in the very small businesses like restaurants and bars that have been hardest hit by the pandemic. So I personally just don't understand why the minimum wage has to be tethered to a pandemic relief program. Why not save this for another day? Why not have a spirited debate about this? Why not really delve into the underlying economics of it? Hear from the people that are going to be most affected, like including the population that earns the minimum wage, many of whom are students or live at home. And I mean, it's a very complicated issue, and I think it deserves its own separate measure. And I've heard Biden more or less say the same thing.
Jim, as you're talking, so some of these reports are coming in from J.P. Morgan, and it's sort of an echo of what we've heard for weeks now, and that is that the consumer balance sheet is flush, their debt service ratios are low, their housing values are going to the moon. And then this one line stands out to me, Jim. We expect consumers to blow out expectations based on the pandemic effectively ending in 40 to 70 days. I know, I mean, that's an incredibly hard call to make, but do you blanch when you see it?
I'm a little wary of that. I mean, when you talk about risk to the market, one of the things I'm certainly keeping an eye on is the vaccine rollout and the spread of these variants. And I don't see any cause, for panic or concern, but those are very important issues for the future of the economy where things, let's face it, could go wrong. The rollout has been pretty rocky. We do have the variants spreading in this country. And I just got the vaccine, which I'm really happy about. But I was given a lecture that, you can't really change your behavior because there are still risks out there. Well, everybody I know is changing their behavior. They're throwing caution to the winds. They've had it with, the quarantining and the distancing. And so I'm just keeping an eye. I look every day at the infection rate just to see how it's looking. It's still pretty high, although it's getting a lot better. I do think that's something for investors to keep an eye on because it is a downside risk to the market. I wouldn't want to say this is going to be over in 70 days.
Although I cannot wait to eat inside a restaurant.
You and me both.
Oh, man. I know. Finally, Jim, it's a topic we talk about all the time, and we don't have a lot of time for it right now. But, you heard Yellen talking about infrastructure and climate. I mean, how are we going to pay for it? Higher taxes? What would you want to see if you could at least advise in terms of what should be done for tax policy in terms of trying to pay for some of this?
Well, I've said many times I'm a big advocate of tax reform, and I think you can do some tax reform that would raise some marginal revenue. But overall, I've been kind of pleased that the Biden administration has not made raising taxes a high priority at the moment, because if what they're trying to do is stimulate, here they're putting all this money out as stimulus, you don't want to raise taxes at the same time. I mean, let's see how the stimulus works. Let's see what the economy is doing. If it really is going to be growing and, doing really well and the pandemic is behind us, I think that's the time to talk about, number one, tax reform, and number two, raising some additional revenues if that's what's needed.
Yeah. Well, it will be a conversation for another day, no doubt. Jim, thank you.
Sure. Good to be here.
Take a look at our ETF spotlight this morning. We're looking at the VanEck Vector Agribusiness ETF, ticker MOO, up about 30% for the year, getting a boost this morning from its top holding, and that would be Deere, the equipment maker, crushing estimates for EPS and revenue, increasing its full-year guidance. Shares, as you heard earlier, record high at 331, and Caterpillar benefiting from a bit of a halo. We'll be right back.
I wouldn't describe Hong Kong as a sticking point between U.S. and China. Sometimes Hong Kong has been used as a pawn by the U.S. administration. With the new U.S. administration, I hope that they will give us a fair hearing as far as the national security law is concerned.
We're not a protectionist country. Rather, China is trying to become a leader of a new round of globalization.
The pressure on Australia, the boycotts that we're going through at the moment, these are 180 degrees at odds with everything Xi Jinping solemnly told the Davos virtual conference.
It will take some time. I don't think there's, we're going back to where, we were before the Trump administration.
I think still in the early days of the Biden administration, but so far we have seen some companies that are listed in the U.S. returning to Asia, to our market.
She's a courageous corporate strategist.
She had a very high ambition and drive to succeed.
Fearless philanthropist.
To give such a transformative gift is incredible.
And Grammy-nominated musician.
Music is what I am. Everything else is what I do.
Defying all convention.
I've broken boundaries because I didn't know they existed.
The Brave Ones. Chandrika Tandon on CNBC.
We bring you the latest on the Robinhood saga. Representative Anthony Gonzalez joins us following his questioning of CEO Vlad Tenev in yesterday's hearing. We're back in a moment.
NatWest has reported a full-year pre-tax loss of £351 million. The British lender also confirmed it will exit the Irish market after more than 100 years of operations.
It was a really challenging year, but we really believe it was the year that as a group we really stepped up. It's disappointing to deliver a loss, obviously, but when you look at the operating profit pre-impairment we were up 4%, and that, I think, in this environment was a really good outcome.
Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
Welcome back. I'm Rahel Solomon, and here is your CNBC COVID update at this hour. Britain's decision to delay second vaccine shots to speed up delivery of initial doses is now getting some support from a peer-reviewed study out of Israel. It finds that just the first shot of the Pfizer-BioNTech vaccine is 85% effective at preventing symptomatic COVID, although the company says that one dose is just 52% effective. A small study involved mostly young people, making it harder to draw any firm conclusions. And another Israeli study says that Pfizer's vaccine also substantially reduces transmission, protecting people who come in contact with the recipient. And all of this comes after data suggesting that Pfizer's vaccine may not be as potent against the South African variant.
The thing that really worries me most is that people are going to lose confidence in the vaccine at this point. We haven't seen any evidence that the new variants actually affect the level of protection from the vaccine. So it's important that people get immunized.
And as snow in Memphis hampers operations at FedEx's main hub, the company says that it's now routing vaccine shipments through Indianapolis, that's its second largest hub, along with regional sites in New Jersey and California. Carl, I'll send it back to you.
All right, Rahel, thank you very much. Of course, yesterday you saw lawmakers trying to get to the bottom of the Robinhood, Reddit, GameStop part of the market, talking about the overall gamification of investing. Take a listen.
Citadel is one of the winners. They make a lot of money. They're the casino in this story, and the casino tends to win over time.
Is individual retail participation in the marketplace gambling, casino gambling, or using funny money?
No, I believe that investing is investing.
The vast majority of retail participation are people saving to meet their dreams.
It's an opportunity for investors to participate in the market just as institutionals participate.
Contessa Brewer actually covers gaming for us and joins us with more. Hey, Contessa.
Hi there, Carl. Yeah, well, look, for starters, you have lawmakers who are asking people who have a vested interest in avoiding the kind of bad rap and onerous regulation of gambling. I asked experts in gaming, for starters, an expert in behavioral addiction, and I asked him about all the bells and the whistles and the notifications.
Whether it's on the stock market, hedge funds, derivatives or whatever, is that this is actually a form of gambling. Now, what you've just described is something like gambling, where it's on your smartphone and you could be rewarded every minute seeing your stock go up or stock go down.
Now, look, investment platforms could snatch a page from the playbook of highly regulated gaming companies. First, put all that data they're collecting on customers to good use. Develop predictive analytics to identify markers of harm. That is, if someone who's invested hundreds of dollars is suddenly investing thousands, or someone who's new suddenly is engaging in high-risk options activity, you have to identify that as a marker of harm. 2, informed user choice. This is not just the warnings about high-risk activity, but specific feedback about the investments being made and, for instance, how it might compare to other users. It means using information that's already being collected to push users to decision-making that is advantageous for them. What the casino industry has found is that eliminating the addictive, destructive aspects creates long-term sustainable customers, not those who flame out. And in fact, one more note here, Entain, the company that partners with MGM Resorts on BetMGM, is launching a similar initiative for video gaming and esports, and for much the same reason. In the long run, they say it boosts the bottom line and it helps forestall costly regulation from the government. Guys?
Contessa, that's so fascinating. Thank you for bringing that to us. With Robinhood in particular, one of the things that it pioneered was this idea, and you touched upon this, of, bringing these kind of animated emojis and different icons into various trading aspects. By doing away with those, would that solve some of the concerns that it's creating addictive behavior, or does it simply need more friction in the system to be able to trade?
So the behavioral addiction psychologist that I talked to said, look, there has never been an addictive lottery. Why? Because you have to wait for days to get the answer to whether you win or lose. He goes, but I could create an addictive lottery. In fact, they have it in Keno, where if you are looking for that automatic input. So he says look, if you don't award free stock for signing up, surely that would help. But he says that's not the problem. The real problem, whether it's gambling, video gaming, or investing, is when it starts interfering with your life, when it starts interfering with your finances, if it interferes with your relationships, like all addictions. This is when it's considered a problem. And that investment community, if they want to forestall this really onerous, costly regulation that you can see now the lawmakers are considering, that they might want to go ahead and try to forestall it by using what these gambling companies have done to create services that really can predict those who might be harmed.
Interesting. A lot of the witnesses testified yesterday that they already have to abide by some pretty significant regulation. Contessa, thank you so much. Speaking of that hearing, in the House Financial Services meeting yesterday on GameStop, Ohio Congressman Anthony Gonzalez asked Robinhood CEO Vlad Tenev, could the company have covered its deposit deficit of $3 billion when clearinghouse requirements came in the early morning hours of January 28th?
At that exact moment, did you have the liquidity for $3 billion? 5:11 a.m.
At that moment, we would not have been able to post the $3 billion in collateral.
Joining us now is Congressman Anthony Gonzalez. Congressman, thank you so much for being here. Your line of questioning really pinned down Tenev on this whole idea of what happened on January 28th, whether the company faced a liquidity crisis. At the end of the exchange, where you talked also about the fact that if they did face a liquidity crisis, they would basically be forced to liquidate as a result of missing that capital call. And you said, and I quote, "We can't live in a world that my constituents could have their accounts liquidated." So given what you heard yesterday, are you concerned about the risk in the brokerage industry right now?
So first off, thank you for having me. And I think that was the crux of the question, right? You're trying to build up just what's the so what for my constituents and the everyday investor. And the so what is, if Robinhood would not have been able to make the capital call ultimately, which they had to do by throttling their users, we could have had a catastrophe, certainly at the Robinhood level. But I think others have come on and spoke, including the Interactive Broker CEO, that it could have had ripple effects throughout the economy. And so we're on a fact-finding mission, and I think we need to keep it there. But we really need to understand what all could have transpired for not just the Robinhood customers, but for the broader financial system in a world where there was a forced liquidation event.
So now TENF says that if there were shorter settlement periods for various securities, right now it takes 2 days to settle a trade. If that were reduced to 1 day or even instantaneously, that he wouldn't have had that problem because he wouldn't have had to post collateral in order to make sure that he could effectuate those trades. Do you buy that argument? And do you think it's possible to reduce the amount of time it takes to settle trades given what technology we have available right now?
Well, if you speak to those in the industry, they will tell you that we could go from a T+2 to a T+1 world, where basically, instead of it taking 2 days to settle, it would only take 1. That would reduce the amount of capital that would be required as collateral. It wouldn't have taken care of the full $3 billion. I don't think that's correct. But there is a lot of hesitancy around running or going down from T+2 to instantaneous for a variety of reasons, and concerns that would actually harm liquidity in the long run. And so I think we need to look at shortening the window for sure, absolutely, and set T+0 as sort of the destination. But we may have to make an interim stop at T+1 in the meantime.
Congressman, is it possible this was just specific, though, to Robinhood and its business model? It's a fairly young company, to say the least, not perhaps as experienced with risk management as certainly others that have been doing this for quite some time. Is this possible it's just a one-off that will not occur again as a result of them learning their lesson?
Well, I think you have to ask yourself, what was the mechanism that led to this? And the mechanism appears to be some of the GameStops and the meme stocks getting pumped through social media and a lot of activity taking place. There's nothing about what has transpired since then that would prevent another run on a stock like that. And so I don't know that the risk has been eliminated. I hope that Robinhood has learned their lesson, certainly. But, again, it wasn't just Robinhood who had to cease trading. And so we saw this across multiple brokerages. And again, let's open up the hood a little bit and understand this better before we rush in and put any sort of regulations or anything like that. But we do need to understand what happened.
Sure. Another reason I would assume you had the hearings as well is just to sort of get a sense for whether there is a more level playing field in terms of the retail investor, many of your constituents. We've had plenty of guests, including the former CEO of Ameritrade who joined us earlier, saying this is the best time to be a retail investor. You have access to information you could only have dreamed about having access to even a few short years ago. You have the ability to trade freely, to execute well. Would you agree with that?
In the public markets, it's better to be a retail investor today than it was 10 years ago, certainly. But I think what the Robinhood situation showed is that there is still a ways to go on that. But also, I think we need to be honest about the fact that a ton of the value creation happening right now in our economy is happening in the private markets, which are completely frozen out to the vast majority of retail investors because of the accredited investor definition and things like that. And so not only do I want to expand access to great investment opportunities in the public markets, which is very important, but I want to level the playing field for retail investors across this country in the private markets as well, and provide vehicles for them to get in and participate on that side of the value creation engine, which right now is completely shut out to most people unless you're either one, very, very wealthy, or two, went to the right set of business schools and worked at Goldman or something like that. So not to attack any one firm, but that's sort of the situation that we have today. And we need to find ways to expand that access while still protecting the stability of the system and making sure that the investment universe is suitable for everybody.
Now, Congressman, I know you said that you're currently in a fact-finding stage right now of the whole situation. But, unlike a bank, if it's liquidated, its deposits are, usually FDIC insured, that's not really the case for brokerage firms and the accounts they're in. Do you think there should be additional regulation that would protect the assets that are held within these firms at the risk of potential liquidation? Is that something that you would be considering?
Again, I'll sort of lean on what I said earlier, which is we have to make sure that this never happens to my constituents or anybody across the country, right? I mean, to think that you could go to bed one night, you spent your whole life building your nest egg, protecting your assets, and you wake up and because your broker-dealer can't make a deposit, which is completely out of your head in normal instances, all of a sudden your portfolio is liquidated. That would be a disaster, and it's horribly unfair, and there'd be very little recourse. for the individual investor. And so we need to open up the hood and take a look at it. And again, I think that the two places to look, the settlement period would help. So if we shorten that settlement period and the industry seems to rally around that concept, I think that would be a very good idea. And then beyond that, I think we need to be very thoughtful about how we move forward in that space.
Yeah, thanks to your questioning. In hindsight, we know it could have been a whole heck of a lot worse. Thank you, Congressman, for joining us today.
Thank you.
Well, as we head to break, take a look at shares of Novavax. It's up sharply this morning after the drug maker struck a deal with global vaccine alliance Gavi to supply over 1 billion doses of its COVID drugs for international vaccination efforts. We'll be right back.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
For retail, actually, we don't want to get into long leases at the moment because, we don't want to lock ourselves up. I think this is definitely the bottom of the market. With the fourth wave ended, social distancing measure is lifted, I think, I'm hoping that the worst is over for retail.
It's one of the world's largest accommodation search platforms. Trivago CEO Axel Heffer talks COVID's impact.
It's a very difficult point in time right now. In most countries, there are tight restrictions.
Recovery.
We definitely expect domestic to be the majority of the market. It will take some time to rebuild that confidence in travel overall.
And the future of travel.
We are using structured data to provide you with inspiration of where to travel.
Don't miss the CNBC Conversation.
Want to pay for your neighbor's mortgage that has an extra bathroom and can't pay their bills? Raise their hand. How about we all... President Obama, are you listening?
How about we all stop paying our mortgage? It's a moral hazard. This is like mob rule here. I'm getting scared.
We're thinking of having a Chicago Tea Party in July. All you capitalists that want to show up to Lake Michigan, I'm going to start organizing.
That was our Rick Santelli 12 years ago today. Speaking of which, let's get over to the CME. Hey, Rick.
Hi, Carl. Wow. 12 years has certainly flown by. Listen, I need to weigh in on that a little bit. Thank you for showing that. I don't think I would have mentioned it, but I'm very proud. Just remember, I never had anything to do with the Tea Party after I lit the match, and I didn't light the match intentionally. I just kind of lost it for a day. Americans like to follow rules. And if they don't like rules, you really need to follow the rules to change the rules. And no matter what you think of the Tea Party movement, as you think back, it was very peaceful, very orderly, and what they did actually had a plan and resulted in progress from a political standpoint, which was their goal. They had a turnover in the House that was the biggest turnover at the time, 2010, in 64 years, going back to 1946, giving them the biggest majority in 64 years. So there are ways to change things you don't like in America, and I think sometimes we lose sight of that. We don't want to cancel people, we want to raise people. Anyway, enough said. Let's get back on getting real on interest rates. Now, let's show some charts, because right now, in real time, things are happening. So let's look at an intraday of 10s and an intraday of 30s. They're both guns hot. They are both trading, as you see on this week-to-date chart for each, above what had been the intraday high levels, whether it was 133 in 10s or that 211 to 213 area, depending on closer intraday in 30s. Now, if you really want to look at what's going on, now let's even move to some bigger areas regarding 10s and 30s. And what you can see there is on the bigger charts that we are certainly making the type of progress on rates that we need to pay attention to. So let's get to it. Safety versus return. Okay? When we get real on rates, that's what it's about, safety versus return. In the old days, you'd say maybe risk versus reward. But here's the problem. That safety issue became not necessarily a duration argument, meaning avoid the bigger moves on longer maturities. It became, listen, put my money in the Treasury complex or in sovereign debt complex because I just want to get back my principal. You know, there's a lot of risk going on here. This part of the money is for being safe. Well, get back principal then morphed into getting back most of the principal because interest rates around the globe started to go negative. And now we're in an inflation cycle where people are worried about it. So if you believe inflation's 1.5%, 1.75%, 2%, you're going to be looking at rates as they get close. And things are going to start to really pop when they move into real territory, depending. But even more, it creates an inflation loop. Let's say you think maybe temporary, but you see even bigger jumps in inflation. That causes more nervousness and long dated and really does bring up that duration argument where you only want to hold paper that's shorter before it matures. Now, finally, the Treasury is giving a huge gift to the Fed, and hardly anybody has been talking about it. It's hundreds and hundreds of billions of dollars, and it's going to start real soon. It was announced around the February funding. So basically, Treasury is going to empty out their balance sheet, which really ballooned trying to deal with COVID. Remember some of the Mnuchin's policies. And those hundreds of billions are going to start moving off the general account into the Fed's balance sheet and most likely into the markets. And that is something you'll want to pay attention to. Carl, back to you.
All right, Rick, thank you for that. Rick Santelli. Got a lot of earnings movers to get to this morning. Keep your eye on AMAT, some upbeat guidance, TripAdvisor, some pent-up demand signs. Then there's the other side as well. Dropbox down on a pretty soft guide. Rackspace is down on a full-year forecast that did fall short. Go to CNBC.com for more on today's movers. We're back in a moment.
The declarations that I made yesterday one in which of equality. We will get to 50-50 gender equality by 2022. We created a breakthrough program, benefits program for parental leave, where 8 weeks mothers, fathers,
In honor of Black History Month, CNBC is highlighting voices that are making an impact, and that includes a spotlight on Goldman Sachs' 10,000 Small Businesses Initiative. We're joined this morning by Asai Pompey, the partner and global head of corporate engagement and president of the Goldman Sachs Foundation, and Fifi Bell-Clanton is co-owner of the Krabby Shack and an alum of Goldman's 10,000 Small Businesses program. Welcome to both of you. It's great to have you.
Great to see you.
Asai, we all know Goldman's been pretty aggressive in helping to address inequality in business. The initiative's not new, but can you talk about what it does and the kind of progress you've seen?
Absolutely. Our 10,000 Small Business program we launched almost a decade ago. Really our commitment to helping small businesses across the country. Over the last decade, we've reached 10,000 small businesses. And as you know, our CEO in December announced another $250 million to get to another 10,000 small businesses. You know, our hope is that these small businesses not only survive, but thrive and ultimately become large businesses. But they're certainly facing any number of challenges, whether it's related to capital, related to their network, or related to really keeping their businesses strong and going.
Are you having, before we get to Fifi, I'm curious if you're being overwhelmed with candidates or if it's a bit of a dig, and what's more important, the access to hard dollars or some of the softer externalities like Rolodexes and people that you might meet?
The demand for the program is significant and only growing. In terms of what's needed, it's both, right? You know, the social capital that it takes to really grow a business. Our business owners tell us, you know, what they need most is that network to be able to grow and expand their business. But they also need the capital. You and I know that it takes money to make money, to be able to launch that new product, to hire that social media influencer who's going to get your name out there. And so they need that capital in order to grow their business.
Curious, you know, what is the status of your business right now amid the pandemic and everything else that's going on? And was there anything that you learned or that you were able to take away from that Goldman Sachs initiative that helped you better weather some of these harder times?
You know, our small businesses right now have been extraordinarily resilient. Business owners like Fifi have, you know, become creative in terms of pivoting their businesses to meet the time. We're seeing trends in terms of them being more tech-enabled, more digital, doing more export. One of our business owners was doing large catering corporate events. Well, that's certainly dried up. And now he's doing micro weddings. And so we're really seeing businesses shift and also planning for a post-pandemic world in terms of diversifying their business stream and their platform across the board. In terms of, you know, surprises that we found in terms of looking at our data, one actually relates to Black business owners. In particular, we looked at the longitudinal data and we found that Black female business owners were the most educated subgroup in the entire population, a whopping 86% of them having at least a bachelor's degree. But as they entered our program, they also had the lowest median revenue, roughly earning 47 cents on the dollar compared to their white male peers. And so while we're facing the same storms, we're not all in the same boat.
Fifi, I'd love to get your take on that.
Well, you know, we struggled in the beginning. We had we quickly realized that we needed to pivot. But we quickly, you know, implemented a growth plan that I created with the Goldman Sachs 10,000 Small Businesses. And now we're shipping our food nationwide, which was just what we needed. Some of the other challenges we've had was, you know, with the ever-changing regulations and the cost that it entails to keep our restaurants and bars afloat. You know, for example, with the outdoor seating structures, I mean, they're expensive. Right now, I have 3 tables. I'm allowed 3 tables in my store, and that's certainly not sustainable for us.
What does the next? I don't know. I'm trying to think about how much runway visibility we have right now, given all the uncertainties. But for Krabby Shack and your business, do you have a plan for the next year? And does it seem optimistic?
Absolutely. We absolutely plan on continuing to ship nationally. We are headed in the direction of retail. We would like to put our goods inside big name supermarkets. We also want to continue to sort of segue into licensing smaller business models, such as smaller business models where we can sell our food on a smaller scale.
Yeah, food service has been challenged, but also has unleashed this whole period. Fifi, as you know, has unleashed so much creativity and thinking of business models differently than we have in the past. Our thoughts are with you, and our best wishes for Krabby Shack and your business, Fifi Bill Clinton, and of course, Asahi Pompey of Goldman. Our thanks to you for all that you guys do. It's great to see you.
Thank you. Good to see you too.
Thank you so much.
On this Friday, we will wrap up Squawk on the Street and kick off Squawk Alley after a short break.
Daybreak in the US.
Frayed nerves all around. Tech stocks down again today.
Start on top of the news. Brian Sullivan, Worldwide Exchange on CNBC.
I'm not quite sure at this stage. I mean, we certainly want to get back to a 70% payout ratio as quickly as we can, but we just do want to be have confidence in see more stability and confidence in our future revenue before we do that. So I think going to 60% now is a good sign that we have a good level of confidence. We'd like there to be a bit more. So it may be the full year, but it could be later than that too, just depending on how this half pans out.
We're ushering in the year of the ox. After an unprecedented year of turmoil, we'll look at what's ahead.
The U.S. is in recovery. The rest of the world is starting to catch up.
As China marks a major milestone.
The CCP goes into its 100th anniversary feeling very confident.
And will travel finally get back to normal?
In a normal year, you will see hundreds of million, maybe 200 million people out there on the move. But this year, probably only at 50%.
All that and more in our special year of the ox, Plowing On.
Good morning. It is 10 a.m. at GameStop headquarters in Grapevine, Texas. It's 11 a.m. on Wall Street, and Squawk Alley is live.
Happy Friday. Welcome to Squawk Alley. I'm John Fort with Carl Quintanilla and Julia Borston. This hour, consumer apps have drawn tons of attention over the past year, whether it's in investing, social media, or audio. Now there are shakeups across the board. Vlad the Apologizer, more on the Robinhood CEO's regretful tone in yesterday's GameStop hearing. Facebook versus the former British Empire. We'll look at what to make of Australia's strong stance on social and Canada joining in. And we'll talk about Bitcoin hitting $1 trillion market cap. Take a tour inside Clubhouse with Joanna Stern, but we're going to start with a look at the new retail investor as Palantir becomes the latest stock to surge thanks to Reddit. Robert Frank has more. Robert.
Good morning, John. More than 10 million Americans opened new investments accounts last year. That's the largest in recent history. And a new study shines a light on who they are and how they actually trade. Now, the study was by the FINRA Education Foundation and the University of Chicago. They looked at people who had opened investments accounts for the first time in 2020. Now, most were between 30 and 59 years old, so they're slightly older than that 20-something day trader we hear so much about. They're also much more racially diverse. A third are African American or Latino, and African Americans' share of new investors is actually double that of existing investors. Now, the new investor is also a very small investor. Most had account balances of less than $2,000, and a third had balances of less than $500. Their main reason to start investing was retirement, and they were motivated to start investing by low minimum investing amounts. So the rise of no minimum or low minimum accounts may be more important to this new investor than all the free trading that we talk so much about. Now, most are not active day traders. About 90% of them trade less than 3 times a month. In fact, the new investor is less likely to actively trade than existing investors, but they also need a lot more financial education. When they were asked 5 questions about investing, they scored an average of 1.4. That's nearly half the score of existing investors, and most of their investing advice comes from friends, family, and colleagues. John, they did not ask about subreddit groups as a source of investing advice, but so we don't know where that ranks.
Yeah, I also wonder about cryptocurrencies there, Robert. Thanks. And, you know, Julia, in a way, this sounds to me like that same group of investors that we tend to see coming into the market at the late stage of a bull market. And to me, the question is always, how do we help them to have a good experience, the right resources to continue their education about the market? So it isn't a thing where they pile in when things have already run up and then, they go away and don't get the benefits of being in the market long term.
Well, John, it seems like there are 2 different pieces of this puzzle, and they're almost on opposing sides. And we heard about this a lot yesterday. On one hand, you want to protect the retail investor, make sure that they don't get involved in anything they can't handle, anything they don't understand. And that's a lot about transparency. And on the other hand, you want to give the retail investor access, and you want to have the retail investor be able to compete on an even playing field. But, Carl, it seems like while both of those pieces are important, it's going to be hard to have both of them in play at the same time.
Yeah, it's going to be very interesting, John. The point's been made on our air, including by the former CEO of TD Ameritrade, that at least from an education standpoint, right, from an information standpoint, there's never been a better time to be a retail investor. But the flip side, as we've seen on so many fronts, is that the amount of disinformation is also high, and people are going to have to learn how to separate the wheat from the chaff.
Yeah, that's true. But I have to also think we don't always do the best job at speaking to people in plain English. I mean, it's one thing to say there's never been more calculus textbooks out there, but are we addressing people with the nuts and bolts math that they need to get through life? Anyway, let's turn to Facebook and the news blackout in Australia, with lawmakers in the UK and Canada slamming the social network over the decision. Joining us now is Joanna Stern, senior personal technology reporter at the Wall Street Journal, a CNBC contributor. Joanna, seems like the British Empire is upset about this one, but one has to wonder. I mean, maybe America's next. We used to be part of the empire.
Yeah, I mean, I've heard a lot of people saying, well, this is just Australia. This is just Australia. I mean, I think the biggest thing we can take from this is that this is going to have governments all over the world looking at this battle between big tech companies and the media companies and how it all shakes out. And we're seeing already what some of the tech companies are willing to do, where they're willing to bend and break, where they're not. And we're seeing already, talk of it in Canada, the lawmakers there want to start to push for paying for news. So, yeah, the biggest mistake I think we can think of right now is just this is a localized thing.
So there was this long-standing position on the internet that information wants to be free, links, there's no real value in that. But I think we've learned over time, whether it's at Google, where the whole foundation of their value chain is in links and being able to rank them, or it's at Facebook, where you're getting a look at a thumbnail image, you're getting a headline from a reputable organization. Once that's circulating on Facebook, no question that news content has value. So maybe it's worth asking, why don't they want to pay even for circulating a link?
Yeah, I mean, I think actually what we're seeing in Australia, the blackout, I mean, what is Facebook without news, right? It's what it was originally. I mean, the thing is called the news feed. So if you don't have news there, you basically just got what Facebook was originally. And I think just, you can look at a lot of the issues around social media that we've seen in the last number of years, and it sort of leads to a lot of this. I mean, one, the business model, the ad-supported business model of these is part of this, right? The reluctance, there are in some cases rev shares between the media companies or Facebook and the media companies, but in most cases there aren't, right? There's just the links. And the big question around this is, what constitutes content? Is it a link? Is it a summary? Is it a full article? And we have examples on the other side, right, of a full article, a full piece of content. And when you see the big tech companies paying for that, you've got Apple paying publishers and Apple News for content.
It's really interesting, Joanna, when you look at the contrast between the way Facebook is handling this and the way Google handled it. Google making a deal with News Corp, Google clearly wanting to get these negotiations handled before this Australia law goes into effect. And I also want to note that now, just today, there was a report that Facebook and Google could lose bargaining power because there's a bill in the works to help news outlets negotiate together. With Google taking this approach, with news outlets maybe getting collective bargaining power, how did this all play out ultimately?
I wish I knew. I think the News Corp Google deal is unique in some sense. I mean, if I knew, I probably wouldn't be sitting here. I'd be in some boardroom making the deals. But I think the News Corp and the Google deal is unique in a sense that it's a little bit of a shift in product. I mean, they're going to launch this, I believe it's called, it's called Google News Showcase. And it's sort of a shift in product. It's not just going to be Google News, but a display of premium news. And that's what a big part of this deal is about, that they're going to pay News Corp to promote that content in there. And there's a share in there. Again, not too dissimilar to what we've seen with other news and tech partnerships. So I think we're going to see more of that, more of these big tech companies creating news products, premium news products, where they can justify, we're going to pay for this type of content, but we're not going to pay for a small blogger who has a website, right? And the small blogger who has a website makes the argument, hey, you know what? I get so much traffic. You give me so many referrals that it actually doesn't matter. I'm okay with that. And I think they're going to try to level the playing field that way.
Joanna, I wonder if it sounds almost like the discussion revolving around paying or getting a share of app revenue, and that is, yeah, we're going to throw you a couple of peanuts, but we're going to keep the lion's share for ourselves. I mean, do you see those two policy shifts happening along parallel tracks?
I do, but I think like one of the big things that, again, I bring it back to the ad-supported revenue model, right? This is part of that, right? We've seen other media companies right now, or smaller media companies like Substack, like Patreon. They're developing different business models about that content, the share between the company and the creator. So I think that there's just going to be a rethink here about what that all looks like.
Speaking of creators and platforms, you went on Clubhouse to check it out as Facebook, Twitter, and others follow on this audio craze. Joanna, I wonder, as a reviewer and somebody who's looked at technology, consumer technology closely, what you think this represents. I think it could be the evolution of the podcast, where you get more knowledge about your audience. It's actually more interactive, and there might be more business models you could build on top of this.
Yeah, I think, look, we don't quite know yet. And I want to say, like, I made this big point in the column and in the video and the podcast. I did so many ways of telling the story because it's audio. I made this big point that I do think a lot of this is pandemic fueled. The fact that we're all sitting at our phones right now looking for something to listen to and watch. We don't necessarily want to have that camera on. So it's allowing people to create and experiment with this sort of podcasting format, this talk radio format. The question of like where the line between podcast and this falls, I don't think we quite know yet, but I agree with you. I think we end up in a space where you can use this to promote, but also you can use this to create shows. And the company and the founders have been pretty clear about how they want to build their business model, which is a subscription creator first sort of thing where they share, you get a subscription or you pay for tickets to your event and the company takes a part and you take a part.
Traditionally, at this stage, companies are concerned about volume, about buzz, about the marketing, and just growing scale. But we've seen over time that some of the most critical decisions that these founders make at this stage is about principle. And I wonder if you think it's going to be critical for these platforms, Clubhouse right now being the primary one, to establish real identity, to establish kind of fair payment systems, to establish rules around what's said in what kinds of forums and how they're labeled, how they're policed or not?
Yeah, one thing I've gotten a sense of from the founders, they speak on the app pretty frequently, is that is the focus right now. I don't get the sense that sort of the tech backend is as big of a focus as the creators and the ecosystem and what this place is. And so it actually comes back to our first part of this conversation, which is these are tech platforms, but primarily content is king. And what happens with the content and what content, who gets paid for the content, and how do these companies make the content? And I think what's interesting now about a new startup, a new social media startup, is they are able to learn from a decades or it's basically a decade or longer worth of history of the misfalls of Facebook, the misfalls of Google, the issues that we've seen around so many of these issues. So I do hope that is the focus, though there are some technical issues that the company tells me they are working on as well.
Well, Joanna, Clubhouse can learn from Facebook and Twitter's mistakes, but now Facebook and Twitter can learn from Clubhouse. You know, Twitter has Spaces. Facebook is working on its own version. And I'm wondering, A, whether you think those giants getting into this social audio space could really pose a threat to Clubhouse, and B, if social audio could become a real moneymaker for other platforms.
Yeah, it's clone central. It's going to be, it's just, we just know what's going to happen. The playbook, right? We saw Snapchat stories, and then everyone had stories, including LinkedIn. And we saw TikTok, and now we've seen Instagram Reels. I mean, there's no doubt now that when there's some new hot thing, some new way of presenting content on a social media site, that Facebook is going to jump in, and Twitter. And so Twitter's got Spaces. Honestly, it's a clone. It's very, very similar. It works similarly. I like using both of them. I don't necessarily have a preference because they do work so similarly. I think in terms of where this is all going and if they're going to be big money makers, I think it again comes back to a different sort of model. If you've got these creators and you've got a podcast or a show, do you charge for an event? A lot of these are like live conferences. Can you charge people to say, come to this or subscribe to our 6 events, and you share that revenue? And so I think it's something new.
Well, Joanna, what did we learn from previous kind of social trendy copying fests, whether it's live video, which seems to have kind of died out to an extent, or it's things like stories, which everybody has adopted, but I don't know if they're just still driving the same kind of engagement, or if now they want to move on to audio because it's always on to the next thing.
Right. I mean, when you think about Facebook, again, coming back to our original part of the conversation here, it's time spent, right? They want people to be on their apps, on their platforms for longer, again, advertising. So audio, great. You're going to have more time spent in there. In fact, it's going to be more time because you're listening and you can put your phone down. And one of the points I made in the column is this is like ambient social media. We've never been able to always be on social media because we've got to look at our phones. Here, you don't have to look at your phone, right? You leave your phone in the car, in the cup holder. You leave it on while you're in your pocket when you're walking the dog. You may leave it on the other side of the bathroom. I'm not going to confess to that. Okay, fine, I confess to that. So it's another way to always be immersed in these platforms.
Well, I mean, at least you don't have to touch it if it's on the other side. Joanna, thank you.
I'm not saying anything. I'm not going to say where I left the phone in the bathroom.
Never escape social media now. Watch Roku shares down just fractionally, and that's despite a beat and a surprise profit. Roku shares off nearly 1%. The 58% surge in revenue, not enough to keep the stock in the green, at least this morning. But we got to note, Roku shares are still at more than 75% just in the last 3 months. There's a lot more Squawk Alley straight ahead. Stay with us.
Joanna Matheson, Melissa Lee, Kelly Evans. Power Lunch on CNBC.
Is that of the 1.3 million Australians who either lost their jobs or saw their working hours reduced to zero, 90% of those are now back at work.
We are optimistic. The fiscal stimulus and investment will be boosting our demand.
We have already several quarters of contraction, so I hope that we could see some encouraging growth.
We are not going back to the pre-COVID world in terms of quality, while we may get back there in terms of quantity by the end of this year.
Foreign tourism will be coming a little bit late that we expected earlier.
A big part of resuming travel would be to get standardized procedures.
Life insurance in Asia continue to be strong, and then some of these structural trends have been accelerated.
Working from home has been so much accepted in Japan. Some industries are booming, so they can absorb jobless people.
Okay, if you're counting so far this year, there have already been 160 SPAC IPOs. That's on pace to exceed the number we had last year, obviously. And an instrument that our next guest is increasingly bullish on, Mark May, Stifel's head of Internet and Digital Media, joins us to explain. Mark, always good to have you. Happy Friday.
Hey, Carl. Happy Friday. Thanks for having me back.
You're calling it SPAC IPOs one of the best wells of new idea generation. Explain why.
Well, I'll tell you, part of it is simple, Carl. That's what we're hearing from large, long-only investors in the street. So that's where we're taking our cues. So when I talk to, obviously, my formal life on the sell side, I've got a lot of contacts, institutional investors, portfolio managers, and that's what we're hearing from them, is that in today's market, their best ideas are coming through the new issue market. And as you just mentioned, SPACs, but not just the front end, but more importantly, the back end, the companies going public through the SPAC. That's where they're telling us they're getting some of their best new ideas right now.
So how are you advising investors, or I guess even our viewers, to keep an eye and take advantage of this wave, but also keep one eye on the long-term sustainable business models that we'll see on the back end?
Right. So for the bulk of investors, look, I advise them to mainly participate on the back end, right? The merger agreement with a target is announced. There's a merger agreement that's filed, and you dig in and do your research. At the end of the day, Carl, we think a lot about on the back end companies, using this route to go public, a lot like an IPO. And the bar is high for us in terms of the quality of companies that we're going to be taking public through the SPAC, process, through that product. And I think for investors, they need to have that same sort of, eye and diligence and work that they do with any investment that they make. So go through the filings, learn the business, and decide if you think it's a good investment or not. It's really not a lot different than an IPO for, I'd say, the bulk of investors that are out there.
But Mark, I wonder, as there have been so many SPACs that have entered the market just in the past couple of months, as they are all looking for deals in roughly the same size, how does that change the price? Is that going to drive up the prices of these potential SPAC deal targets because everyone's looking for them?
Well, you're right. There is a supply-demand imbalance in terms of the number of SPACs looking for targets and the number of targets looking to go public. So the primary thing that we see that causing is not so much the valuation, because look, at the end of the day, they have to price these things for institutional investors to invest them either in the pipe or in the open market. Primarily what we're seeing is it's causing the SPAC sponsors to have to be much more competitive in the terms that they're offering targets, because I'm sure you've heard of the term SPAC offs. There are a lot of SPACs vying for, these targets. And so what really ends up happening is part of the merger agreement, which is the M&A, element of this transaction. Those terms are coming down in the favor of the targets. And what does that mean? It means that now the dilution that you take on by going public through a SPAC is really not all that different than the dilution that you take on through a traditional IPO. And then the company we're dual tracking more and more of these processes, IPO and SPAC. And we're able then to focus more on the benefits of SPACs. And there are many.
Okay, so let's get into that. We were in the weeds there for a minute. Maybe we can go a little bit bigger picture. I mean, are SPACs addressing that earlier stage part of the market where we weren't getting a lot of IPOs for a long time? What are the revenue and market cap profiles so far of the SPACs that you've been looking at once they do get that acquisition target and are off to the races?
Yep. John, I think you touch on one of kind of two types of companies that I'm generalizing that make good SPAC candidates. One is their earlier stage, or there's something else that's happening at the company. Maybe they're merging with another business, but both of those scenarios point to the need to have to look out in the future. And the SPAC product, unlike the IPO product, allows companies to publish their forecasts and walk investors through how their comfort level and the assumptions into those forecasts. So that does allow some earlier stage companies or companies that are going through certain changes, say like COVID, where maybe COVID's had an impact on their business, like in the travel industry or something like that, allows them to talk about their go-forward business. The other are companies that are in industries that are not well known by investors. So I recently was part of a team that helped a large cannabis tech company go public. Companies called WM Holdings or Weedmaps went public through Silver Spike Acquisition Corp. Many of the investors that came into that deal had never invested in a cannabis company before. So having that extra time that the SPAC process allows to educate investors is another scenario that we see working well for this product.
Hey, Mark, I wonder finally, how much of this interest do you think is being fed by long-term frustration over the inability or just the scarcity of fresh IPO shares, watching big names run up on day one and not being able to take advantage of that initial lift?
Yeah, I don't think that that's so much driving it as there are two things that are driving, I think, the surge in the SPAC market. One is the markets overall are obviously at record highs, right? So there are more and more targets that are looking to go to an exit through the public markets. So SPAC sponsors and the investors in those SPACs know that on the back end there are a lot more targets now than there were before. So I think that that's one. But look, I think on the target side, they are looking for new and creative ways, right? Direct listings don't work for everyone because you need to raise capital. SPAC addresses some of those issues that you bring up, Carl, but with the benefit of being able to raise a pipe with committed capital that helps to the performance of these SPAC transactions post-merger.
Right. Well, clearly, anyone who thought it was going to be a passing fad, Mark, is having to rapidly recalculate, and obviously, with your help, pretty good research lately. It's great to see you. Have a good weekend.
All right. Thanks, guys.
Mark
Have a good one.
Watch shares of Palantir this morning. It's up big as the chatter inside Reddit and Wall Street Bets finds its next target. It's worth noting that the stock fell significantly in the last two trading sessions after reported earnings, but it is up about 15% today. Former FDIC Chair Sheila Bair weighs in on the GameStop hearing next. Stay with us.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
I'm Jemima Versace, and these are the stories you should be checking out on CNBC.com. President Biden's return to the Iran nuclear deal is looking uncertain as the two countries remain in standoff over a lack of progress. Biden's team wants to see changes before it lifts the sanctions, but Iran wants Washington to make the first move. That story's on the website now. U.S. Treasury Secretary Janet Yellen has urged lawmakers to pass President Biden's $1.9 trillion stimulus package, telling CNBC in an exclusive interview it's the only remedy for the worst setback in decades. Head online for the full story. And is there life on Mars? NASA begins a new chapter of space exploration by successfully landing its Perseverance rover on the surface of the red planet. The six-wheeled robot will be looking for evidence of past life. Check out that and more on CNBC.com. And remember, you can follow us on Twitter at CNBCI.
On the next Managing Asia, the man running Singapore's largest supermarket chain, FairPrice Group.
Before those gone orange, we could already see, the build-up of crowd at our stores. They were buying like there's no tomorrow. We are managing stockpile, covering a few key categories. We have had to review and rethink many of our strategies.
Sia Kian Peng, CEO of FairPrice Group, on the next Managing Asia.
Welcome back. I'm Rahel Solomon, and here is your CNBC News Update at this hour. The Texas power grid is set to come out of emergency conditions later today. This as statewide outages fall below 200,000. The focus of the crisis now shifts towards distributing bottled water to the 7 million people still under orders to boil tap water. And in Washington, 6 Capitol Hill police officers have been suspended with pay, and another 35 are under investigation in connection with the deadly attack on the Capitol on January 6th. And how about this one? Researchers have taken a step towards protecting species in danger of extinction. Take a look. This black-footed ferret is cloned from an animal that died more than 30 years ago. It's the first time an endangered species has been cloned. Elizabeth Ann is her name, and she will be raised with other black-footed ferrets at a breeding facility in Colorado. That is our CNBC News Update at this hour. John, she's kind of cute, don't you think? Elizabeth Ann.
Yeah, I hope that story ends well. You never know with cloning. All right. All month long here on CNBC and Squawk Alley, we are observing Black History Month. Here's BET co-founder and CNBC contributor Robert Johnson sharing how successful people can help close the racial wealth gap.
The viewers who watch CNBC represent some of the most powerful business people in this country. I urge everyone to look at Black opportunity the same way that they looked at opportunity for themselves. We're going to give you equal opportunity that we had. We're going to give you access to capital that we had. And we're going to ensure that you have a chance and a fair shot at participating in the American dream.
Later this hour, we're going to chat with the CEO of Tequitable, a company that works to create a safe, inclusive, and equitable workplace. But in the meantime, read more on Robert Johnson's story at cnbc.com/investinYou. I'm going to take a quick break. Don't go anywhere.
Divided by distance, united by business.
This is the new reality we're all
Helping you navigate the new normal. Squawk Box on CNBC.
When can we expect some of these bottlenecks to be ironed out? How long is this supply shortage going to persist for?
So the manufacturing process is quite a complex process, and it takes quite some time to get new tools into the fabs and to qualify it. So therefore, from that perspective, we need to assume that this situation will take several more months until we can see a relaxation in the overall supply chain.
Dow's getting a bit of an intraday lift here from all the classics. Financials, energy, industrials, and materials all up better than 1%. So, John, that's Dow record high, JP Morgan record high, Caterpillar record high, Bitcoin record high today.
Yeah, we are still on that record high streak for so many things, Carl. Meanwhile, Robinhood, on the other hand, is being vilified. Market makers questioned and stock gamification scrutinized in hearings yesterday, but no consensus view emerged from the House Financial Services GameStop hearing. What's the likely roadmap then for reforms? For more on that, we're joined by former FDIC chair and Volcker Alliance founding director, Sheila Bair. Sheila, happy Friday. It's great to have you.
Thanks.
Well, it's unclear maybe what exactly comes of this, but what are the top things that you think should?
Right. Well, I would prioritize really shortening the settlement cycle from 2 days. I mean, the core of the problem, at least with the disruption and the havoc created when Robinhood had to suspend trading, was a margin call from the NSCC, the centralized the entity that does centralized clearing for equity transactions. So there's a 2-day float. So it's 2 days between when you actually do the trade and when you actually get your stock or get your money. And that creates a risk for the centralized counterparty, in this case, the NSCC. And they have to make margin calls when stocks get really volatile. The risk of one or other side of that trade defaulting increases. So if we went to real-time settlement, you wouldn't have this problem. The technology is there over time, I think, to get there. But shortening that settlement cycle, I think, is very important. Even shortening it from 2 days to 1 day would help a lot with this centralized counterparty exposure that we have that can lead to these destabilizing margin calls. We also probably need more transparency around the margin itself. There's not much transparency about what the margin requirements at an SEC are. That is probably something the SEC needs to look at as well.
Now, bigger picture, what do you think of what Robinhood really is and what it's doing?
Yeah,
sort of gamifying trading for retail investors, making options trading and trading on margin more fun?
Yeah.
There's confetti. Is that good? Is that bad? Does it matter?
It reminds me of the, to paraphrase Casablanca, we're all shocked the gambling is going on our equity markets. But that's really, it makes it a game. It's speculatively, it's risky. You've got new novice traders coming in, probably not understanding the risks that they're taking. Active short-term trading, time and time again, that's not the way you make money. The way you make money is to thoughtfully invest long-term, put your money there, and keep it there. If you want to get the benefits of this still booming equity market, we're seeing new highs today. Take a page book from Jack Bogle, do a long-term, broadly indexed fund, and watch it grow. This kind of short-term trading may be fun, but it's dangerous, it's risky, and there are always smarter guys on the other side of the trade that are really going to be making the money. The classic case is this payment for order flow. It's a sleazy practice. Never should have, that horse is so far out of the barn. But it's really, it's letting market makers draw order flow by paying for it as opposed to publicly posting the best quote. And they trade in front of published market interests. They trade in between the spread. They make a lot of money off of it. I think AOC hit the nail on the head. It's not really, free trading. It's just less transparent cost. You're losing in the quality of execution. You're not paying a commission to do that trade, but you're losing in the quality of the execution. And those big Wall Street players on the other side of you, they're the ones making money. So this idea that Robinhood is somehow democratizing this and allowing the little guy to take on the big guy, I just don't think that's what's going on. Invest long-term, find real value, find good stocks or broadly indexed funds, and put your money there.
Sheila, there was so much interest in payment for order flow yesterday in the hearing,
Right.
and I'm wondering if you see payment for order flow being banned, and if that does become banned, what is the impact? Who wins and who loses there?
Yeah, we won't be banned because these traders love not having to pay commissions. They don't understand that they're still paying for it. It's just not transparent what they're paying for. But I think, commission-free trading is here to stay. It's very popular. And I can't imagine politicians or regulators, having the courage to take it on. I mean, AOC had an interesting, maybe we should require that at least 50% of it get repaid to the investors. That might be an interesting idea. Probably a lot of resistance to that too. But it's, it never should. It was, I have a history on this. I used to work for the New York Stock Exchange, decades ago, battling Bernie Madoff on this. It was done in the name of creating competition for exchanges. But that was the wrong kind of competition. The competition should be on who's got the best published quote, not on who wants to pay for order flow. But it's just the horse is so far out of the barn. I just don't see regulators or politicians reining it in at this point, sadly.
So Sheila, if you don't see that being banned, you also said people should be investing for the long term, but we know that they don't. They aren't. They're very much interested in these shorter term trades. What are the reforms that you think are practical that could really be implemented right now?
Well, I think again, shortening the settlement time is something that we should be focusing on. I think more transparency around short positions, I think, is important. Looking at margin requirements, looking at capital requirements for broker-dealers, all of those kinds of things can help provide more stability to the financial system. I support a transaction tax. That we need, frankly, it's too easy to trade now. We need a little more friction. So creating a little more cost, especially for high-frequency rapid trading, I think would be a good thing and have a stabilizing influence on our equity markets. But these market structure problems have been neglected for decades. There's no, I wish there was a magic wand, but there's not. They've been building for years. They're going to take years to resolve. I have a lot of confidence in the nominee for the chair of the SEC, Gary Gensler. He knows these issues better than anyone. It'll be good to see what he takes on first. But again, there aren't any quick fixes. This is going to be a long slog.
Sheila, I'd love to get you to expand on what you said about Bitcoin earlier in the month, and that is stay away, nosebleed levels. If you're wealthy, fine, but you don't have a lot of confidence. Since that time, we're beginning to get some indications that at least corporate treasurers are giving it a look. Does that evolve your view at all?
Well, you can tell how influential I am. I think the price went up when I said that. I just say what I do. I stay away from it. It is very volatile. No, I don't think that's where corporate treasurers should be sitting there putting their money. Elon Musk wants to do that. I think there's a real question about that. It's highly volatile. you want to have some stability in your cash accounts, I would assume. And there's all this talk about we're going to finally have inflation and the dollar is going to lose a lot of value because of all this spending we're doing. Yeah, that is a risk, but nothing compared to the volatility embedded in Bitcoin. So, people need to make their own decisions. But I do think more on the retail side, corporate treasurers should know better. But in terms of retail investors, it's just it's just not a good place to put your money. Understand there's a difference between the technology that underpins Bitcoin, the blockchain technology, where I think is very promising, that could help us lead to faster settlement times, for instance. There's a difference between that technology and Bitcoin itself. There's no intrinsic value with Bitcoin. And don't confuse the two. A lot of promise with the technology, but the coin itself, no. I don't think there's much there.
Well, okay, a lot of people disagreeing there, but great to get your perspective. I mean, as the price shows, $1 trillion market cap on it now. I wonder what do you think would be a real step forward? What technology can do for the retail investor, the saver, the individual in our society right now that really needs to do better things financially? What can tech do? What would be progress?
Well, payments is a really the big area where using blockchain technology can we have a heavily intermediated payment system now. It's getting cash from point A to point B. It's an antiquated system. We're behind the rest of the world. This is one of the reasons why you have slow settlement times and equity settlement as well. Using blockchain to get money from directly between intermediaries as opposed to having to go through these very large financial institutions to facilitate those transactions for you, that will be faster, safer, and lower cost for consumers. It will also help the government itself. You can see how the government has struggled in getting these pandemics payments out to households, whether it's the household payments, the unemployment benefits. It's a very clunky payment system. So using distributed ledger to disintermediate those transactions is really, I think, the huge promise for technology and blockchain in particular.
Yeah, the U.S. behind a lot of other countries on that as well. Sheila Bair, thank you.
Happy to be here. Thanks for having me.
Keep your eye on a couple of the LiDAR names this morning as we look at autonomy. Luminar and Velodyne, some key players in autonomous vehicles. We got a report out saying that Apple may be looking to partner with suppliers in that recently revived self-driving project. Those names and some others get a boost on that potential interest. A lot more Squawk Alley still ahead. Don't go anywhere.
Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
NatWest has reported a full-year pre-tax loss of £351 million. The British lender also confirmed it will exit the Irish market after more than 100 years of operations.
It was a really challenging year, but we really believe it was the year that as a group we really stepped up. And disappointing to deliver a loss, obviously, but when you look at the operating profit pre-impairment, we were up 4%, and that, I think, in this environment was a really good outcome.
She's a courageous corporate strategist.
She had a very high ambition and drive to succeed.
Fearless philanthropist.
To give such a transformative gift is incredible.
And Grammy-nominated musician.
Music is what I am. Everything else is what I do.
Defying all convention.
I've broken boundaries because I didn't know they existed.
The Brave Ones. Chandrika Tandon on CNBC.
Watch Dropbox. Shares falling this morning in early trading despite a beat on the top and bottom and a big increase in paid users. Soft guidance is the catalyst behind today's drop. The company also taking a one-time $400 million charge in the fourth quarter to reflect the company's shift to remote work. That stock down about 2.5%. There's still a lot more Squawk Alley ahead. Stay with us.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Most countries will experience recessionary-like conditions. Is it necessary for another 1.9 trillion to be directed at the economy?
We do need some more fiscal stimulus to continue to bridge the gap, to continue to allow us to move through this tunnel and get to the other side.
It is still about crossing that bridge to the recovery, but where the journey seems to be a little bit delayed, but should not be derailed.
We want to accelerate on the vaccine because we are fully aware that there is a direct link between vaccine and economic recovery.
We're starting to see some cracks here, and the EU is just the latest example.
People are focused on right now, when are we going to get our vaccines? This next generation, which we are seeing, and I think those will be flowing quickly around the world.
The challenge will be not a global distribution. The challenge always is finally the last mile.
To highlight key players making an impact. Our next guest is a former media executive and now heads a company aimed at creating more safe, inclusive, and equitable workplace cultures. Joining us now is Tequitable CEO Lisa Golobter, former head of digital products at BET and a member of the Hulu launch team. Lisa, thanks so much for being with us this morning. I want to start off by just asking you to explain how Tequitable works and what it is that you do with your corporate clients.
Thanks so much for having me, Julia. Happy to be here with you. So Tequitable is really trying to use technology to make workplaces more equitable. And so our mission is to help create companies that are going to create a work culture that works for everyone. And so we've created this third-party confidential platform to help companies address issues of bias and discrimination in the workplace. So for example, if my boss makes a sexist crack, right, that's not the totality of who he is, or he tries to touch my locks, right? I'm not going to go to HR for that because that's the nuclear option, right? I'm not trying to get him fired, but I would like those behaviors to stop. On the other hand, if I feel like I'm being overtly discriminated against and harassed, right, then I want the company to take immediate action. And so what Tequitable tries to do is help the employee in either of those situations figure out what their next steps should be and how they can move forward. And then simultaneously, companies really don't have a great sense of what's happening on the ground in the day-to-day on their culture. And so we try to provide data and insights back to them on that. And so for us, it really is about providing a sounding board for employees where they can come get advice, explore their options, and figure out their next steps, to give them back some agency. And then we use data that we anonymize and aggregate to identify the systemic issues within an organization's culture. We create a report for the management team with actionable recommendations, right? So for us, it's really important. We work on both sides of the equation because we want to create systemic change.
So Lisa, it's so interesting because Twitter just made this commitment that 25% of its executives would be from underrepresented minorities by the year 2025. What do you think of that kind of commitment? Is that the kind of thing that works? Is that something that other companies should consider doing?
Absolutely, yes. There's no question that, one of the things that people are like, oh, it's like we can't find Black folks, we can't hire them. Just hire them, just do it. It can be done. I will say one of the things that's been really interesting to me is, so since there have been laws that have been passed around minimum requirements for underrepresented folks on boards, magically, folks have been able to find people and to find really excellent, remarkable, great fitting candidates. And so it really is about making that commitment and making the effort that counts.
So Lisa, great to have you. I'm not a corporate lawyer, but if I were, my first question would be, when there's a lawsuit, what happens? Do an employee's contacts with Tequitable show that the company should have known something was going on? Or do you have to tell the employee that reporting something to Tequitable isn't the same as talking to HR? Do I somehow get protected by the idea that I proactively sought data and engaged with this platform? What happens?
Yeah, no, it's a great question, and I don't even play a lawyer on TV, but I have actually been able to satisfy the kind of inquiries from the greatest of legal minds. So there's a few things. So we're actually based on the model of an ombudsman, and ombudsmen have been around for centuries, really, but in the U.S. since about the 1960s. And so there's actually a book, a really thick book by Chuck Howard, which is basically a legal guide to setting up an ombuds office. And so we're building on things that have been practices and models that have already been learned from. And so, no, ombuds are, in fact, independent, not beholden to the company's management structure, but also confidential, right? So they won't even, we won't even acknowledge if somebody has spoken with us or not. And we also impartial and neutral. So we don't take the side of the employee, nor do we take the side of the company. We're really trying to provide fair processes, to ensure fair processes. And then we are very specifically informal and off the record. And so we say that in English, we say that in legalese. We actually don't even collect personally identifiable information. So we have all kinds of mechanisms in place. We shred notes, we do data purges. So there's all of these ways that actually we don't even retain those records. So that's kind of the end all and be all of it. We don't collect them, we don't retain them, and we're legally.
Yeah, I was going to say, given that frame, the way you're framing it, what does it say about traditional HR efforts to read the sentiment of their workforce through employee surveys? Is that sort of just a dinosaur step at this point?
So I think that there is an ecosystem. I think there's pieces across the landscape that are really important, right? So I think doing an employee engagement survey or a pulse survey, right, that can be a great way to get a baseline and to have something concrete that you can measure year after year against, so you know where your benchmarks are. But I will say that the disadvantage of employee engagement surveys, one, you have to worry about survey fatigue, but two, oftentimes employees don't feel like the information they send in goes anyplace, right? There's no active feedback. It's a one-way street. That's why one of the things that Tequitable does is we provide a learning platform. So if something's happening in the moment, we can actually help you figure out how to handle it as it's happening.
Lisa, this is such important work. We appreciate you joining us to talk about it, especially as companies really understand the value to their corporate organization and having a more diverse workforce. Thank you so much for being with us today.
Thank you. Appreciate it.
For sure. Uber, meanwhile, losing a key fight in the UK over the classification of its drivers. But will that have repercussions in the U.S. over its drivers' employment status? Head to CNBC.com for the latest and stay with us. We're back in a moment.
retail, actually, we don't want to get into long leases at the moment because, we don't want to lock ourselves up. I think this is definitely the bottom of the market. With the fourth wave ended, social distancing measure is lifted, I think, I'm hoping that the worst is over for retail.
It's one of the world's largest accommodation search platforms. Trivago CEO Axel Heffer talks COVID's impact.
It's a very difficult point in time right now. In most countries, there are tight restrictions.
Recovery.
We definitely expect domestic to be the majority of the market. It will take some time to rebuild that confidence in travel overall.
And the future of travel.
We are using structured data to provide you with inspiration of where to travel.
Don't miss the CNBC Conversation.
Daybreak in the US.
Trade nerves all around. Tech stocks down again today.
Start on top of the news. Brian Sullivan, Worldwide Exchange on CNBC.
In case you missed it, Disney Plus suffering some outages across the country earlier this morning as fans rushed to watch the latest episode of Marvel's WandaVision on the streaming platform. John, I don't know about your kids. My kids are all in, and it harkens back to the things we used to hear about Netflix, like on Christmas Eve back in the day, remember?
Yeah, I mean, my kids, I'm all in. I hear, though, Julia, that Eastview, New Jersey had no problems whatsoever with WandaVision. The signal is coming through loud and clear.
I think it's really interesting that Disney's taking this approach of dropping one episode per week. It's obviously working. There's so much excitement, and it's very different than the Netflix strategy of dumping a whole season at once. But guys, I also have to note this is a big deal for Disney. Hong Kong Disney opens today. This now means that there are only 2 Disney parks that are fully closed. And Carl, it's meaningful to show that over half of Disney's parks are at least partially open.
Yeah, the Hong Kong news, of course, it's been some fits and starts over there, but it does lend some promise, Julia, as you suggest, to parks back home, maybe opening for at least the summer. I know Six Flags this morning did talk about hiring workers for all of its parks and all of its water parks to be open come summer. So that reopening play is definitely on the front burner. One quick programming note before we head over to the half. We can't knock the hustle out of Squawk Box. They got Jay-Z coming on with Becky, Joe, and Andrew on Monday. That's going to be a CNBC exclusive. Everyone have a great weekend. Let's get to headquarters in the half.
Yeah, we'll look forward to that, Carl. Thank you so much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the breaking point for stocks. Is there one if rates keep rising? We'll discuss and debate that with our investment committee today. Try to find out where your money is going to work best in the months ahead. Joining me for the hour today, take a look at our lineup. Joe Terranova's here along with Josh Brown. Pete Najarian will be along in a second. Brenda Vangello is the CIO of Sandhill Global Advisors. Liz Young with us too, BNY Mellon's Director of Market Strategy. I'll take you to the wall. Let's get a check on where stocks are trading on this snowy Friday yet again in the New York area. You've got green all across the board. We're keeping our eye on interest rates too. Again, Liz, the question, is there a breaking point for stocks if the 10-year yield continues to go up? Well, we're not there yet, apparently, because stocks aren't getting too upset.
Yeah, well, I think the real question here is, should rates be going up, and why are they going up? And I think, yes, they should be going up, and they're going up because the economy is expanding. We're expecting further expansion later in the year. We're expecting big improvement in corporate data, and we're expecting a little bit of inflation. And inflation continues to get kind of a bad rap. Inflation means there's healthy demand in the economy. So I welcome the rise in rates. Now, the question about what's the breaking point, when does it matter for the market, I don't know what the magic number is. I don't know that there is a magic number about the mental threshold of when it's going to actually turn us down. I think it's more about the speed with which we get there. And if we gradually go up in rates throughout the year, I think that's okay and we can digest it. So I'm okay with this rate rise. I think there's going to be volatility in 2021 in the Treasury curve. I would lean into that volatility and use it as a buying opportunity if it does cause a pullback in stocks.
Well, there you go on the 10-year. 134 is the yield as we look at it right now. Josh, I should also mention today the Dow hits a new intraday high. The real area of concern seems to be the NASDAQ and tech. Now, you have a nice green board today, but the last few days, the NASDAQ has looked a little wobbly. Those high multiple tech stocks seem to be the ones that might be most at risk if interest rates continue to rise. How do you see it?
That's exactly how I see it. I think at 1.5%, deals stop getting done. I think that's when you don't have 50 SPACs every 48 hours. I think you see cryptocurrencies all of a sudden have a little bit of slowing in momentum. It's not like a catastrophe, but when you make the risk-free rate actually worth something, it gives people an alternative. And it doesn't mean they sell everything, but they just think twice before that next incremental buy into the next non-cash flow generating greater fool, game that they were going to play. So I do think we're in a place right now where everyone thinks they're really smart because they've been investing in things that don't have any need to generate cash flow whatsoever, and they've gone up and up and up and up.
Yeah, we'll get back to Josh in a second. So, Pete, that's the question. Where is the area that you would see would be most at risk? Is it, some of these SPACs, some of the high-flying IPOs, some of the highest of high multiple tech stocks that have just absolutely ripped? Where is the area that our viewers need to keep most in tune with?
I would say yes to all of the above, Scott. I think you make a really good point. I mean, they've been a great run, right? We've talked about this time and time again, but we look at these multiples, and you don't have multiples in some cases, and so we have to price these stocks in a completely different way. Well, I don't know how healthy that is, so I think that it makes a very big difference in how you're determining where you want to have your investments. And obviously, if you want to have high-risk investments out there, sure, there are some great opportunities like this. But I think at the same time, you have to understand, if you're in that world and you want to be in those kinds of names that you just mentioned with these unbelievable multiples, if they've got multiples and all of the rest, you're basically looking for whatever you'd consider to be sort of like a hope of some sort that this can continue and someday maybe grow into it. Other than that, you've got some high risk. There's no doubt in my mind. And I think there are better places to be, Scott, where you've got lower risk, and yet you've still got plenty of reward. Maybe not the same kind of reward as you're seeing in some of these others, but certainly there's been great reward in this market already, just kicking off 2021.
Yeah, Joe, I mean, look, the bottom line is you can't have it both ways, okay? If you want to make an argument that stocks are so compelling, especially these technology stocks that trade at high multiples, and those multiples don't matter because interest rates are so low, if interest rates start to rise, you just can't brush it off and say, well, it doesn't matter because rates are rising for the right reasons, so the multiples are justified where they are. Or am I wrong?
You're not wrong. The way that I would think about it, and the viewers should think about it, is basically the economy and the market is on a 5-on-3 power play in hockey. Got a two-man advantage. You better score as many goals as you possibly can because you can't realistically expect you're going to play the entire game with that 5-on-3 advantage. We're going to return to 5-on-5 hockey at some point and a return to normalcy. And that return to normalcy is going to be rates that, as Josh pointed out, 1.50, that's where the S&P dividend yield is. So you're going to have competition for equities at that point. We could rise even further towards the January 1st, 2020 price for the 10-year Treasury of 192. Why? Because you're seeing a steepening of the yield curve, which is really illuminating this economic optimism. Understand something, Scott. The last time that the 10-year Treasury had a move like this was from 2016 into the end of 2018. We went from 1.50 to 3.25. The yield curve actually flattened at that point. So this time is a little different. you can expect the economic optimism to lead to higher yields. And as I said before, that's when the two men are going to come back on the ice, and a lot of the easy ability to score these goals is going to be removed from the market. That's just reality.
Yeah. Okay, but, you know, unlike a two-man advantage in hockey, and I like your analogy, I'm a hockey guy, I'll run with that, this power play is going to go on for a while. I mean, if you listen to Sarah's interview with Janet Yellen yesterday, the new Treasury Secretary, former Fed chair, it just underscores the fact that she wants to go big on stimulus, Brenda. So, you know, you're going to get likely a large stimulus package. You're reflating the economy. Some of the GDP projections are now just through the roof, and they seem to be ratcheted up by the day. So in that sort of environment, would you want to buy an Apple, you know, and rates going up? In that environment, would you want to buy an Apple, or would you want to buy a Deere or a Caterpillar, for example? What's the best place for the money?
Yeah, I think in that sort of environment, obviously everyone's going to benefit from more stimulus. And I think when it comes to Janet Yellen, she's looking and reflecting back on the last cycle and thinking if we had done more, we wouldn't have ended up with a decade of pretty slow economic growth. But I think that's key to why tech worked so well during that time frame, is because growth was relatively scarce. But I think as we look forward, and suddenly growth won't be as scarce if there's lots more stimulus, that those areas that have been underperforming for the last decade and that would really benefit from faster economic growth, like the Deeres and the Caterpillars, the financials, the industrials, those groups should really be bigger beneficiaries. And if we look at where earnings projections are, even for this year, we can see that energy, financials, industrials, consumers are all projected to grow earnings faster than technology. So I think it's not just a rate story, but it's also an economic growth story that's playing out here. And I think that should support this shift to more cyclical groups working better, I think, than technology, where comparisons are hard. They're going to start getting harder in the first quarter here.
Yeah, all good points. So, Josh, I think you're back with us. Your shot's not frozen anymore. Let's play this game, okay? For this year, let's say for calendar year 2021, is Apple going to do better than Deere or Caterpillar and Deere going to be the places to be for all of the reasons that all of us have just put forth on the table?
I think that's really tough to say, because the question is, does Apple the company do better than Caterpillar or Deere, or does Apple the stock do better? And Apple the stock has some features about it that put it in a position really to be competitive with almost any stock in the market. And it's counterintuitive, because you would say, all right, well, it's a $2 trillion market cap. Like, how much could it go up? The buyback is a very big factor in why Apple could have a really good year as a stock, even if the business has tougher comps. I think we all agree a lot of people were buying electronics last year that they don't necessarily need to replace this year. That being said, though, we're also in a phone cycle. So I'm in Apple. Even if I thought they wouldn't have a great year, I would still be in it because I'm an investor, and I've always been in it the entire way up. But I do think there is a story. There's a story where the Caterpillar names continue to recover, and Apple still manages to put up a competitive return as a stock.
So we could broaden it out too, Pete, and make it not so specific to Apple. But if I said to you, do you want to be in big cap tech, or do I want to be in big name industrial, whether it's the Cat, Deere, or another name that you have on your list, what would it be?
Sure. You know, I still like the technology space, Scott, and I think the reason that I do is when I look at the various names in technology, I still think that the names that I like the most, and obviously we were just hearing from Josh about Apple. I mean, I look at these names, Microsoft and Apple and multiple other names out there, where when you look at the PEs, in some cases, are they stretched? Maybe a little bit relative to the past, but based on the environment that we're in and a lot of the different categories that we're moving into in some of these names, obviously the cloud still has tremendous growth, and I think will continue to have that kind of growth. So names like Microsoft and Google and Amazon, I think will still flourish because of that. And then you look over at Apple, and they just continue to have new reasons to why we want to own them, obviously. And it just continues, Scott. So I do think there's still plenty of room yet left for technology to move to the upside, but that doesn't mean you can't have a little bit of both. I quite honestly, I don't know that we have to make that decision, because I think you could own Apple, but you could also own a Boeing, or maybe it's Deere, or maybe it's Caterpillar. For me, it would be Boeing, because I think after the year that we've gone through and watched Boeing, and we all know all the different storylines, we know about the airlines and all that, I think that is a stock that potentially could be poised for a lot higher levels over the next year, or maybe even a little bit longer than that, based upon where they were going before we actually ran into all the different headaches that they've had to deal with, and obviously some of the terrible things they had to deal with as well. I think there's a lot of reasons why there's tremendous growth for Caterpillar, for Boeing, and obviously Deere as well.
So, Joe, what if I'm sitting at home and I've got a portfolio that's really done well over the last, let's say a couple years, certainly has done well in the pandemic, and I had taken advantage of the scene, and I really put money to work in enterprise software, okay? High valuations, those multiples have gone up, the stocks have done quite well for me, and now I'm listening to our conversation and thinking to myself, rates seem like they may continue to go up for all the reasons that the investment committee on the halftime report has just talked about. Some have come on either at the very beginning of the year or late into 2020 and suggest, like Brad Gerstner, for example, and said, enterprise software valuations may be ahead of themselves. There's got to be a bit of a comeback. Are you looking at a Snowflake in your portfolio? Are you looking at a Salesforce, an Oracle, an Adobe, and saying maybe now's the time to take some profits there and put that money to work elsewhere, or not?
If you have not taken any profit in emerging software, the answer is yes. You should be giving consideration to taking some profits. I am not saying to liquidate the position in entirety, but you can take a little bit off of the table. I think that's the prudent thing to do. I think technology overall, you're going to see bifurcation in terms of performance moving forward. Just point towards mega cap technology for 1 second. You bring up Apple. Since January 25th, when Apple traded to a new all-time high,
I knew that was going to happen. We'll pick Joe back up in his comments about Apple. Brenda, let me go to you, though. You're out on the West Coast. You're out in the Valley. What about the idea of, and maybe you're in some of these names that we were just talking about, not Apple per se, but some of these enterprise software names, even some of these newer, younger companies that have gone public, their stocks have just soared right out of the door. What do you do with those?
Yeah, I think for the newer public companies that have soared right out of the gates, I think it's going to be interesting to see how the next year plays out, because there is going to be a period of time where the rubber is going to need to meet the road, and these companies are going to have to put up good quarter after good quarter after good quarter to continue to support the multiple that they're getting. There has been this huge rush, and it's not just in enterprise software, but in other areas, particularly within small cap as well, like renewable energy, that really have just soared to the moon. So I think we're going to have a period of time where we're really going to need to see the growth and the surprise in earnings to really allow these companies to grow into the multiple. But to the extent that they are able to grow and continue to grow sequentially and increase the growth rate sequentially, I think they will continue to stand out versus the larger cap peers, where they may have had such a tremendous 2020 that we're now going to be looking at growth rates that are declining sequentially. So I think there's going to be a difference there in who gets the multiple. And the companies that are still able to grow sequentially, I think should be able to still command a higher multiple than those that can't.
Yeah. Joe, I think we're back. I'm sorry, Brenda. Joe, we're back with your shot. I'll let you finish your thought on Apple. I can't wait till we just throw this technology nonsense out the window. We're all around the same table again. Boy, that's going to be one heck of a day.
Boy.
I can't wait for that. But let's try and get through. Your answer on Apple here. Pick it up.
Sure, I'll have the suit on that day when we do make that return. But Apple has clearly underperformed since it's making that all-time high on January 25th. There's something about it. Maybe the street doesn't like the introduction to EV. But yet, Scott, Microsoft and Alphabet have both traded to all-time highs within the last 3 days. So that's where that bifurcation in technology performance is really going to come into play. Your question is a fair one. As I said, yes, You're giving consideration to paring back some of your holdings in emerging software, and you're also looking to the cyclical components of the economy. How about industrials for 1 second? If the economic optimism is real and we are going to accelerate very quickly in 2021, well, guess what? It's actually time to think about owning some of the airlines, which is something that is radically different than I would have commented on just 3 to 6 months ago.
That's interesting. Do you have a name or two that you like right here, or you would start taking a look at for those reasons?
Alaska Air, first on the list of airlines, United Airlines second, and Delta third.
Well, you made Farmer Jim happy, right? Farmer Jim's been sitting in Alaska Airlines telling you that that's been the one to own. So now you've gotten in the seat with him. That's interesting. You know, the other area, guys, that has seen a nice amount of gains, Liz, the financials. They're leading this week for obvious reasons, as we've been talking about rates potentially depressing some other areas. Well, it certainly hasn't done that to the financial space. Does that continue to work? Are we running out of gas on the financials trade, Liz, or do we have more room?
I don't think we're running out of gas. I think financials have been waiting for this environment for years, that we have a steepening curve. They can actually make money on that net interest margin. And we got more constructive on financials at the beginning of the year. I would stay that way through 2021. Plus, there's the buybacks that can happen. So as we move through the rest of the year, and even just watching earnings, not only on a broad index level, but for financials, I think we see improvement as things go on. And financials is a space that is not going to get rewarded in a super high volatility environment or a super high beta environment, which is what has been rewarded lately. So as we try to pass the baton from policy back to fundamentals, I think a lot of these financials are going to look really good.
Yeah, you know, Josh, I've been dying to talk to you about the Buffett, the Berkshire 13F, you know, not only because you own Berkshire shares, but the move out of J.P. Morgan entirely, I just found so interesting. I know you like J.P. Morgan. You're in that stock. What's your view on the move at Berkshire to get totally out of J.P. Morgan?
I never thought I would say this, but I think the Berkshire 13F is probably less worth paying attention to than maybe ever before in my lifetime. I think it's absolute incoherence from the outside looking in. I don't think there really are any fundamental takeaways on individual companies. I don't think there are any sector bets that make any sense for a non-Berkshire treasurer. I really just think
let me ask you
they've got a couple
Let me ask you this.
All right, go ahead.
Well, let me ask you this, because it's a very interesting part. Forgive me for cutting you off. It's a very interesting point you make. And when we were talking about the 13F from Berkshire the other day, I mentioned how, you know, it's all conjecture and speculation. And it's so hard to read into it because, you know, Buffett is where he is in his life at this point. He has other people who are running the portfolio, so whom you don't hear from really ever. So it's really hard to get into the mind of Berkshire Hathaway in a way where it wasn't like that for many of the past years.
So here's what I think happens. First of all, the financial crisis. Two things about the financial crisis that I think have rendered the Berkshire 13F completely irrelevant to investors from now on. The first thing is that the rescues that Buffett pulled off, everyone saw them. Everyone became very aware at how incredible those trades were. Specifically, what he did with GE, with Goldman Sachs, Bank of America, and on and on. Those rescues where he was the only person willing to come in, take a preferred stock issue that was created directly for him because him investing gave these companies the imprimatur of, hey, they're going to survive, right? Like that, he had that premium that he was able to command for putting money out. The Fed just took his job away. They said, well, we don't need Warren Buffett because it turns out we can print. Rates never rise. Inflation never goes up. We can print enough to do all of these deals. And that's exactly what you saw happen. And in fact, the Fed did so much that there weren't even takers for the money. The Main Street lending program that they tried, it's not even for Main Street, by the way. It was for businesses with, I think, 500 employees and up. Nobody even wanted the money. That's how much money was out there. Look at SPACs. Nobody needs capital for anything from Berkshire Hathaway. Therefore, the premiums that they can command in order to dole out that capital are so low that it's almost not worth doing. So what game is he going to play? He's going to buy stocks at 25 times earnings? He doesn't want to do that either. So I think they're making some investments that look big, but they're really not in the scale of the company. Again, keep in mind the Berkshire Securities portfolio, I think, is like $250 billion. So they buy a little Chevron. They buy some Japanese trading banks. They do a little Verizon. These are not needle-moving investments. And I think people emotionally were disappointed that Mozart didn't, drop a new symphony to blow us all away during this last crisis. The other thing, though, Scott, I think, is that it all happened too fast. So he did bottom tick the airlines. That's true. Another curiosity. But there just weren't values created. There weren't distressed companies. Policy came in and did Berkshire's job for it. You could argue that's what policy should do. That's a whole other conversation.
But look,
so I don't think that people looking at Berkshire can look at it the same way.
No, but you have to pay attention, Josh, to the 13F, and you must want to know what he owns. How can you not want to know that or declare it irrelevant if you own Berkshire Hathaway stock?
No. If you own Berkshire Hathaway stock, of course. Of course. But even then, like, what are you going to argue with them? But I'm saying the 13F used to be relevant for tens of millions of investors because they would try to glean from it. I'll give you a great example. During the dot-com bubble, Warren Buffett was buying housing stocks. You know what he was doing? In doing that, he was positioning himself for the next bubble that we would soon have a couple of years later. He was buying aluminum siding, carpeting companies that built homes. That's how he spent that period of time in 2000 while everyone else was chasing fiber optics and dot-com stuff. So he's always been ahead of the curve. He's always been on to the next thing. This time he wasn't, and I really don't think there's any signal for non-Berkshire shareholders to take away from any of his buys and sells. He bought Barrick Gold in one quarter and sold it the next quarter. There's no rhyme or reason to that. There's nothing you could take away from that. So I think I think people need to just say.
Well, I was going to say one of the reasons why I went to you was because you own Berkshire shares, so you'd have a unique perspective in and of itself, plus the fact that I know how closely you have followed Buffett and Berkshire over the years. Speaking of, Pete, when we talk about the financials, another name that's been in the Berkshire book, Wells Fargo, which is very interesting to me that you just bought Wells Fargo stock, not options, but stock.
Right. And I had calls in there as well, Scott, and then I just decided to add and go with the stock side of things as well. This seems like something that wants to break out. It's been breaking out, and we've watched this run for a while now, and we've seen names like Bank of America and Citi finally start to move, specifically Bank of America, and we've seen some of these other names. I really have been adding to this financial exposure that I've had for a while now. This goes back towards the latter part of last year, just because it was so hated, Scott, and it didn't look and didn't feel all that good back in the late fall, but it's starting to feel a heck of a lot better now. And I think that there's a lot of different areas within, let's call them really financials rather than just saying banks, because I think there's this huge distinctions between each and every one of the names that we bring up each and every day, and I think that's really important. So, yeah, Wells Fargo, that's, we're talking banks. I think that they are positioned now very, very well. I think they've got a lot of this now behind them. And because of that, I think that's why we're seeing the performance that we've seen of late. And this is a stock that even on some down days recently, we've watched Wells Fargo actually move back up and be in the green while the markets are actually still going fairly deep into the red at times. So I think that there's a lot of reasons right now to look at certain names within the financial space, and I've got quite a few of them right now, and I'm happy with all of them because when you look back to the earnings cycle, we actually learned a lot about a lot of these various names and how they're doing it and where they're actually capitalizing best. And I think there's There's just countless names out there right now that still have plenty of upside. And I think there's a lot of room to shift around within that as well. I see Joe's talking about Goldman Sachs and Morgan Stanley as his exposure. Those are great names. They have absolutely been performing incredibly well. I've traded those, but I haven't had, I've been in other names where I want to be from an investment standpoint, but those are phenomenal trades because the movement that we've seen out of some of those names just violently to the upside has been extraordinary.
Yeah, we're looking at Wells get a little bit of a lift here as we're having this conversation, too. We'll keep our eye on that. We also are keeping our eye on next week, a busy week for earnings, Home Depot Square, NVIDIA, Shake Shack, and more. We're going to get you all set up for that. A reminder, you can always watch or listen to us live on the go on the CNBC app. We've got Unusual coming up, a lot more, just a couple minutes away.
Real money.
Heat map right now.
Real money.
Heat map right now. Pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
The initial conservative is going to take around 15 months for Indonesia, but the president really asking us to accelerate within 12.
Medical.
If we get the vaccines faster, we'll be able to roll out the program faster.
The vaccine, I think, is a turning point, but don't underestimate testing. I think if we can get testing to 45 seconds, 30 seconds, that will also be a groundbreaker.
Welcome back. I'm Rahel Solomon, and here is your CNBC News update at this hour. President Biden laying out U.S. foreign policy priorities at a big security conference in Germany. He said that the U.S. commitment to NATO is, quote, unshakable, and that allies must push back against the anti-free market policies of China and others. And during the Q&A session, Biden said that he's ready to declare a major disaster in Texas to unlock more FEMA resources. The U.S. has rejoined the Paris Accord on climate change. Secretary of State Blinken says that addressing climate change risk is now a key priority for the administration. Ford has recalled 154,000 older vehicles to find 45 missing Takata airbags. The vast majority are Ford Rangers from the 2004 to 2006 model years. And Prince Philip will stay in the hospital until next week. Doctors say that the 99-year-old husband of Queen Elizabeth, they say it's just out of an abundance of caution and that he is in good spirits. Good to hear that. Scott, I'll send it back to you.
All right, appreciate that, Rahel. Thank you, Rahel Solomon. All right, the committee's making moves. Josh, I'm coming to you. We're going to get to one of your new buys a little bit later. It's very interesting. I do want to talk about some things that you sold, though. You sold Unity Software. So why don't you tell me about that first? And then there's something else I want to talk to you about, too.
There's no specific reason for the Unity sale. I own it as part of a venture capital strategy, so I was in it pre-IPO, and it's no longer pre-IPO. So there's a holding period, and when the holding period ends, I sell. I think it's a great company. I mean, it's gone up like a huge amount from the original purchase, so it's a huge profit, but there's no fundamental judgment there. What's the next one you want to do?
I want to talk about gold. You sold Barrick Gold.
Okay.
And I'm just curious. I mean, I think it was in the last, I don't know, day or so. Gundlach has made some interesting comments on gold of late. You had, and he was maybe talking about how Bitcoin is now the stimulus asset rather than gold. Ken Griffin was on Squawk this morning, maybe dissing Bitcoin a little bit. And I think you own some Bitcoin still, too. Just give me your view on why out of Barrick Gold, what you think of what Gundlach said, and Bitcoin, too.
I am starting to come around to the idea that Bitcoin, all right, picture a world where there is no Bitcoin. Where would gold's price be? Right? So that's the question. I think it would be closer to 3,000, quite frankly, than 1,500. So one thing that you have to understand about commodities, especially the precious metals, people either want them or they don't, and nothing else matters. They're purely supply and demand. It's how much gold is there in the world versus how much demand is there. A lot of the demand that normally would be for gold, I do believe, we could say it's another generation, whatever you want to say, I do believe has found other things that it's more interested in as a non-dollar bet or a weak dollar bet even. So it's not that there's a problem with Barrick Gold, there's a problem with any of the miners, or there's even a problem with gold itself. The question is, do people want to buy it or not? And you can only really go by technicals. And technically speaking, gold peaked in August for this cycle. And so it's really like 8 months or 9 full months almost where price has been slowly but quietly declining. And now you actually even had a dollar rebound this past week. So I just said, is there some place I could be that's better right now? And I think I found it. So it's not a judgment against Barrick Gold, the company. There's just no demand for gold right now, and only technicals will tell you when that's changed.
Interesting. Joe, you got some good stuff going on, too. You bought the SMH, Louisiana Pacific, and Old Dominion. Why don't you take me through those?
Louisiana Pacific I gave as the final trade on Wednesday. They had reported earnings on Tuesday. Earnings were incredibly strong. The guidance was raised. This is a small cap company, which gives you exposure to the incredibly strong housing market. Old Dominion, that's a name that I've been in the past. I know that our viewers will know that. They also reported earnings. They have 100% revenue exposure in the U.S. And Scott, can you find a domestic company that was able to raise prices 5% and they were accepted? Not even a blip. So the supply chain is restarting. This is basically smaller than a truckload transportation. It's a name I've enjoyed owning in the past. I'm back in it again. SMH. I am in the SMH, and listen, basically, and Stephen Weiss has done a great job with Teradyne. I've been in Teradyne. I sold Teradyne the other day. I still have AMD, which I think Pete has as well. But just look at the Applied Materials earnings from last night. Look at the performance from names like Lam Research and Clack and Maxim. I wanted to have the semi-exposure once again and do it in a broad-based manner, because CapEx is going to return specifically for the semis, and you're going to see that inventory build over the next 6 to 9 months. And that's the best broad way for me to get that.
Yeah, I mean, companies like the automakers are telling you how in demand chips are, right? Yep. Just take a lead from them. Pete, before we take a quick break, you've got new calls in. I'm just going to go through some of them. You have a lot, and you can tweet those out if you'd like. The ones we don't get to. Jeffries, Las Vegas Sands, and a company called Summit Materials. Do you want to tell me about Summit Materials, just because I don't think we've ever talked about it before? You can talk about the other two, but do that first.
Yeah, it's a name. Absolutely. Summit's a name that I've been in the past, Scott. I got out of it because this thing has been nothing but a stock that seems to be performing extremely well in the construction material space. And Joe was just talking about it. We've heard everybody else talking about what's going on in the economy, and we talk about construction, industrials, and all the rest of it. Well, this is the bottom down. So you're starting down with Summit. This is a name that just continues to move to the upside. We've seen activity in here on multiple occasions. And so anytime that I see that again, Scott, if I'm out, I got to get back in, or I might have to add. I was out, so I added this one. I like what they do, and I think this is a company that probably doesn't get looked at. It looks, matter of fact, it's been looked over many times, I think, in the past. Las Vegas Sands is interesting to me because of the fact that as we start to open up a little bit more, and I'm not just talking about here, Las Vegas Sands, let's not forget, it's Singapore, it's Macau, and yes, it is in Las Vegas as well. But this is a company that I think has already recovered a lot. I think there's still plenty of room to the upside for this name, so I continue to want to own this one as well. And I tell you what, there was just so much activity, Scott. The one thing I would point out, I don't think that I've ever traded as much in the last week and a half or 2 weeks ever outside of being on the trading floor. So it gives you a little bit of an idea of just the changes. And you mentioned it. I probably am not going to tweet it all out. It'll probably fill out more characters than I can. But it's really incredible just how much activity and the accelerated moves, the ups and the downs. The movement has been absolutely extraordinary.
Give me a shout. Give me something on Jefferies. Why Jefferies?
Well, I love the financials, and this is one of those names that I think stands out. I didn't have any kind of a position in here. I've been in there in the past. And, Scott, when we were talking about financials earlier in the show, I looked through my list. It's countless how many different names are either with stock or with calls. And I think that there's plenty of different names that I can rotate in and out of. And this name, I like the name. I think they're really well run. Obviously, they've done some things over the past year or so that have changed the structure of the company itself. I like what they've done, and I think this is a name that really could start to participate like the Wells Fargos and all the rest.
All right, we'll throw a shout to Richie Handler as you're talking about Jefferies. All right, up next, Pete's latest trades and unusual activity. Plus, in celebration of Black History Month, we are honoring some of our CNBC contributors. Here's Degas Wright with his story.
Early in my career, I was interviewing for an analyst position. I arrived at the office and told the reception, I'm here to see the manager. And she said, have a seat in the reception area. I was the only person sitting there. When the manager came into the reception area, he asked the receptionist, did Mr. Wright leave? That manager did not see me. He did not see that the person sitting in that reception area was the same person that described in the resume. But to me, that did not matter because I knew my value.
Spring break in 6 words. 10 college kids, 1 motel room. Hey, I've been there. I got the bathtub. Please don't tag me on Facebook. There you go. That's smart. That's smart.
The stories and opportunities driving Wall Street and investors. Tyler Matheson, Melissa Lee, Kelly Evans. Power Lunch. Weeknights on CNBC.
I'm not quite sure at this stage. I mean, we certainly want to get back to a 70% payout ratio as quickly as we can, but we just do want to be have confidence in see more. Could be later than that too, just depending on how this half pans out.
We're ushering in the year of the ox. After an unprecedented year of turmoil, we'll look at what's ahead.
The U.S. is in recovery. The rest of the world is starting to catch up.
As China marks a major milestone.
The CCP goes into its 100th anniversary feeling very confident.
And will travel finally get back to normal?
In a normal year, you will see hundreds of million, maybe 200 million people out there on the move. But this year, probably only at 50%.
All that and more in our special year of the ox, Plowing On.
All right, welcome back. Pete, it's you. Unusual. What do you got?
All right, let's get after it. I got a tech travel company for you, Sabre, Scott. Now, this one's pretty interesting. On January 29th, stock was 1080. They were buying calls. On February 2nd, stock was 1190. They were still buying calls. Today, the stock's 1390, and they're buying the March 14 calls, Scott. They bought over 8,400 of those calls. They started at 80 cents, went up to $1.10. Stock was trading 1390 at the time. So the stock definitely, they're buying right at the money calls. I'm going to be in this one at least 2 to 3 weeks. I think there's still more upside coming there. Joe mentioned the SMH. I already own Micron, the stock, but Micron, again, is hitting. It's hit 9 separate times since the start of January. Stock was 74 at the start of January, and they started buying calls. Today's stock was trading about 89. They're buying the 93 strike calls that expire next Friday, the 26th. They bought a total of 5,200 of those between 90 cents and $1. I got 1 week for these to pan out for me. Stock, I think, is already starting to make a nice move. Stock, as I said, was 89, but it's already making a little bit of a move today. This is a stock that I think very easily could get through 93 in a hurry.
Yeah, it's pushing 90, 89, 68, and climbing. Pete, thank you for that. All right, check out this mystery chart. Sector's up 12% this year. It's outperforming the major averages. A big call now from Goldman Sachs on it. We'll talk about that. We've got Josh's new buy within that as well. You don't want to miss that in our call of the day. Coming up next.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
The declarations that I made yesterday is one in which of equality. We will get to 50-50. We're 8 weeks for all. Mothers, fathers, and an additional 6 weeks for both.
Let's look at the mystery chart. We showed you. There it is, housing. It's done quite well. Rahel Solomon has our call of the day today. Rahel?
Hi, Scott. Yeah, Goldman giving KB Home a double upgrade from sell to buy. Price target goes to $51 from $32 a share. The note pointing out, Scott, that the ongoing urban exodus to the suburbs and, of course, low mortgage rates. So the demand for homes is there, but Goldman also estimating that there were 43 homes for every 100 buyers in 2020. So supply is also tight. And the surge in home building also pushing building material prices higher. Lumber, for example, is up 60% in 3 months. And Scott, as you know, we've seen these type of upgrades for some of the home builders pretty much throughout the pandemic. There are now no sells on the stock, according to FactSet. After lagging a bit through 2020, KB Home is actually up 25% so far in 2021. Our own Jim Cramer pointing out a few weeks back that he also thinks KB Home has more room to run. And some of Goldman's other top picks, Scott, in the space include D.R. Horton and Pulte Group, both in the green so far this year, though Pulte is a relative lagger, up just 7%, Scott.
All right, Rahel, good to see you again. Thank you. All right, Liz Young, look, these stocks have obviously done well. Housing's been a boom. You think it's run its course?
Yeah, I hate to be a contrarian here because I think the rest of the panel is going to disagree with me, but I do think the residential real estate market has already seen a pretty big heyday. And if I was going to play real estate right now, I would start to go into REITs, office space, some of that retail stuff that's going to come back to life. And I'll tell you what, I'm in Manhattan. Rentals are actually going up now. So when rents are going up, that usually means that people are coming back to the city. I think the residential real estate boom is over.
Yeah, interesting. Brenda, do you agree, disagree?
I think there's still a long tail to the supply-demand imbalance, but I think it's going to be interesting to see what happens over the next year when people are asked to come back to the office or not, or maybe they decide to prioritize other spending, like going on a vacation instead of deciding to move. So I think there could be a little bit of flux here, but I think the longer-term story of supply-demand is still intact.
All right. We're going to take a quick break. We'll come back. We'd already talked a little bit about gold, but we'll find out how the futures traders are playing it now. We'll get their move. We'll do it next.
Change is all around us, shaped by technology and human ingenuity.
Helping you navigate the new normal. Squawk Box on CNBC.
When can we expect some of these bottlenecks to be ironed out? How long is this supply shortage going to persist for?
So the manufacturing process is quite a complex process, and it takes quite some time to get new tools into the fab and to qualify it. So therefore, from that perspective, we need to assume that this situation will take several more months until we can see a relaxation in the overall supply chain.
On the next Managing Asia, the man running Singapore's largest supermarket chain, FairPrice Group.
Before DORSCON Orange, we could already see, the build-up of crowd at our stores. They were buying like there's no tomorrow. We are managing stockpile, covering a few key categories. We have had to review and rethink many of our strategies.
Sia Kian Peng, CEO of FairPrice Group, on the next Managing Asia.
Time for the futures outlook. Gold prices, well, we talked about them before, reversing higher after touching the lowest level since June earlier. Brian Stutland with us with our Friday trade.
Yeah, Scott. I mean, when you talk about gold, it's kind of an interesting concept because it's been going down. All the rest of the commodities are in this super cycle to the upside. But I think the reason here is people are looking for different ways to utilize gold. Gold really, to me, doesn't have much value anymore, especially if it closes a little bit lower to here. It's going to be a major technical breakdown. And when you look at it, I'm trading VIX futures for the volatility event, and I'm trading Bitcoin to hold storage value. So I don't really need gold anymore. And I think if we get a close here below 1785, I would be a seller of the April futures contract because I think it can go down all the way down to 1710 or so. I'd put a stop a little bit higher up and basically paying a payout of 7,000 versus risking 7,000. So I'm playing that range. I think gold is just losing value. It's a key technical level here. We've had a 50% retracement from low to high that you just saw on that graph. And I think if we close below the 1780 level or so, I think it trades a lot lower. So I'd be playing it to the short side using gold futures, that April futures contract, to play that short.
All right, good stuff. Have a good weekend. We'll see you soon. Yeah. We've got final trades next and Josh's new buy.
We are seeing new customer segments coming through. They're younger, they're a bit more adventurous, and they really want to start to move across the country. We are seeing the older generation becoming a bit more conservative. So now we actually have to change our value proposition to speak to this younger audience who are looking for things that are slightly different, but also very conscious. In order to meet these needs and wants. Travel brands need to be visible, but they need to be empathetic. They need to be aware of the environment that we find ourselves in. We've got to show ourselves as one that is caring, but also handing back the power to the traveler. When you are good and ready to travel, the destination will be ready for you. The destination is put in certain health and safety protocols, essentially to protect yourself and also its employees, but the power is in the consumer. When you are ready, when you are confident, we'll welcome you with open arms.
Tyler Matheson, Melissa Lee, Kelly Evans, Power Lunch on CNBC.
When can we expect some of these bottlenecks to be ironed out? How long is the supply shortage going to persist for?
So the manufacturing process is quite a complex process, and it takes quite some time to get new tools into the fab and to qualify it. So therefore, from that perspective, we need to assume that this situation will take several more months until we can see a relaxation in the overall supply chain.
Missed the show? Don't sweat it. The Halftime Report now has a podcast. Market-moving interviews, call of the day, unusual activity, and of course, Ask Halftime. Look for us on Apple Podcast or your favorite podcasting app and subscribe to the Halftime Pod today.
NatWest has reported a full-year pre-tax loss of £351 million. The British lender also confirmed it will exit the Irish market after more than 100 years of operations.
It was a really challenging year, but we really believe it was the year that as a group we really stepped up. It's disappointing to deliver a loss, obviously, but when you look at the operating profit pre-impairment, we were up 4%, and that, I think, in this environment was a really good outcome.
She's a courageous corporate strategist.
She had a very high ambition and drive to succeed.
Fearless philanthropist.
To give such a transformative gift is incredible.
And Grammy-nominated musician.
Music is what I am. Everything else is what I do.
Defying all convention.
I've broken boundaries because I didn't know they existed.
The Brave Ones. Chandrika Tandon on CNBC.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
All right, Josh, tell me about Gores Holdings 6.
Well, that name is just a placeholder. This is a SPAC that's already announced the deal. They're buying what I consider to be one of the most interesting private technology companies that I've come across in a while. It's called Matterport. And Matterport basically has this massive library of digital versions of all of the buildings that exist in the world. They started off as a 3D camera company, but now it's much bigger. They've got an app that's really popular. You can download it right now. You can capture your entire house digitally without the aid of a 3D camera. But basically, this is a play on virtualization. I think it's a category killer. They see themselves as a Zoom or a PayPal or a Netflix-esque company with a huge lead over everyone else in digitizing the environments in which we work and live in. So their customers would be like commercial real estate companies, residential realtors, people in the hospitality industry, the leisure industry, remodeling. So they basically have a huge lead, and that's what this SPAC will turn into, Matterport. Look into the CEO, this guy RJ Pittman, who joined in 2018. Background is like Apple, eBay, Google, just a bananas resume. And I'm really excited about what this company might be able to turn into. So I own the SPAC pre-closing of the deal.
Yeah, we have our SPAC index, our CNBC SPAC index. It's interesting that the relationship of owning the SPAC pre-deal and then once it actually starts publicly trading, you can see the difference in performance. There is our SPAC 50, which is up 0.5%.
I've never done it, by the way.
Josh, why don't you give me a Say again?
I've never done that, by the way. This is the first time I'm buying a SPAC that's already announced the deal at a premium. I've never done it, so I'm pretty excited about this. Final trade, Invitation Homes. I disagree. Yeah. I disagree with what Liz said about suburban real estate. This thing is going higher. INVH on the verge of a breakout.
Okay, Liz, I'll give the ball to you.
Tips, all aboard the inflation train.
Okay. Brenda, you have a final trade for me?
American Tower, huge beneficiary of continued demand for cellular data and 5G.
All right, Pete, with the great background today, what do you got?
How about that healthcare? I'm going to go with AbbVie, Scott.
Okay, good stuff. And Joe Terranova?
Waste management.
All right. Good weekend, everybody. The exchange begins now.
Thanks, Scott. You have a good weekend, too. I'm John Ford. Here's what's ahead on the exchange. An exclusive interview with New York Fed President John Williams. We will ask about the economy, policy flexibility, inflation, and the path of asset purchases. Plus, should the so-called joke digital currency Dogecoin be taken seriously. The argument for why it matters to the markets, and the chip industry is facing a new problem, the weather. But we begin, of course, with the markets. Dom Chu with those numbers. Dom.
Interesting markets, not from the macro perspective, but some individualized pockets of the market that are showing some real life. First of all, the Dow Industrials, as you can see here, up roughly 0.25%. The S&P 500 just about flat on the day. At the highs, we were up roughly about 17 points. At the lows, down about 5. And the Nasdaq Composite holding steady to around that 13,880 level, currently up about 0.1% there. So again, steady moves in the market overall. But let's jump to some of the hot spots in the market that we've seen so far today. First of all, check out shares of Palantir, up 11%. That's roughly just off the highs of the session so far. The big data analytics company, remember, had a big earnings report, a little bit of disappointment there. A 6-day losing streak that saw it lose about 34% of its overall value. It's popping up a little bit here. Remember, ARK Invest, Cathie Wood made some positive comments, upping their stake in the company a little bit. Earlier this week, they announced that. And then we've got a little bit of activity with Palantir being mentioned in the Wall Street Bets Reddit forum. So that's adding to some optimism about that stock. So those shares up about 12%. And then, of course, you got to talk about what's happening with Bitcoin. Another record high today, 54,765, the last trade there. That's just a hair below the 54,866 or thereabouts, roughly, record high that we saw just in the last few moments or so here. But still, that 5% move higher puts the one-year total return at 440% overall. So Bitcoin price is certainly still catching attention. I would say this, though, John, over the last 8 or 9 sessions, we've been pretty close to very extended above its 50-day average price. We'll see if that momentum can still continue.
50-day average price. Does that even matter? Is that a thing for Bitcoin, Dom?
I don't think it is. I don't think there's any fundamental metric or technical metric you can use to track these types of things.
Dom Chu, thank you. The market's also getting a boost from Treasury Secretary Janet Yellen's comments on CNBC yesterday that a large COVID relief package is necessary and could help the U.S. return to full employment in a year. She also said there are some risks to the economy.
Inflation has been very low for over a decade. And, it's a risk, but it's a risk that the Federal Reserve and others have tools to address. The greater risk is of scarring of people, having this pandemic take a permanent, lifelong toll on their lives and livelihoods.
For more on the state of economy, maybe the state of those tools, we are joined by Steve Leisman and New York Federal Reserve President John Williams. Steve, take it away.
John, thanks. It just so happens that John Williams is a former colleague of Janet Yellen, so we'll see. John, thanks for joining us. How you much agree or disagree with the new Treasury Secretary? Let me begin in a slightly different place and come back to the issue of stimulus, and they're all related, John. But the issue of the 10-year yield, which is now up near 135, and it's had quite a run this year. It was down below 1% when we began the year. Do you worry that yields are getting up or near a place where it becomes restrictive to economic activity?
Say hi, Steve. It's good to see you. Good to join the program today. I also should mention that today is my older son Kenneth's birthday. So happy birthday to Kenneth. Happy 23rd birthday to Kenneth. If he's watching this program. In terms of watching the 10-year yield, obviously it's an important indicator. What I've seen over the past several months is I think a reflection of a number of factors around the economy. One is clearly additional fiscal support that we saw late last year, and we're, obviously a lot of discussions around that and expectations of additional fiscal support. Also progress on vaccination here in the U.S. and around the world. So, what I see is the markets, especially the Treasury market, responding to some good news on vaccination and progress there, and maybe reduce downside risks there, and news around additional fiscal support, which should, accelerate getting back to full maximum employment. So, to my mind, we're seeing signs of rising inflation expectations back to levels that I think are consistent, closer to consistent with our 2% long-run goal, and signs of somewhat higher real yields off in the future, reflecting greater optimism in the economy. So it's not, to me, a concern. It's more of a reflection of, I think, market's perception of a stronger economic outlook.
John, as you correctly state, real yields are up a bit, but they're still, I believe, negative if you just take a general inflation number and subtract it from the yield. How do you think about when and if the rise in yields becomes something that ends up restricting or putting a brake on economic activity, such that you think it might be something the Federal Reserve needs to do something about?
Well, as you point out, they're quite negative, and not just in the United States, but in many economies or have negative long-term yields. And I do think that reflects the extraordinary economic downturns that countries around the world have seen, and the expectation is going to take quite some time for economies to get back to full strength. It's also in the context of a very low neutral or normal interest rates as well. As we've talked about before, interest rates even before the pandemic had, kind of the normal level of interest rates was quite a bit lower. So in terms of thinking about this, again, we're, the Federal Reserve, we're very much focused on maximum employment and price stability, achieving a sustained 2% inflation rate, and, achieving a maximum employment. So the context for me in thinking about monetary policy is not so much exactly where the yields are in terms of 10-year yields or other financial, prices, but really about how do we best position monetary policy for success in achieving our goals.
Let's now layer in the discussion, John, if you would, about the coming stimulus and or relief bill, if you will. The idea that there's another 1.5, 1.6, the president's asked for $1.9 trillion of additional federal spending that's coming, which, some economists have described as, pouring gasoline on a pretty already hot fire. If you think about where GDP forecasts are right now, does it worry you that perhaps there's too much stimulus coming down the pike?
Now, the first thing I'm going to say won't surprise you, that's the job of elected members of Congress and the president to decide on fiscal policy, and I'll state a monetary policy. Honestly, right now, the economy is still in a very deep hole. Employment is down by roughly 10 million from where it was before the pandemic. Unemployment is still quite high, and employment to population ratios are really quite a bit lower than we would like to see. So I think right now, the economy has quite a ways to go to get back to maximum employment, and we have a ways to go to get back to our 2% inflation target. So I'm not really concerned about stimulus or fiscal support right now being excessive or anything like that. Really what I want to see is an economy that gets back to full strength as soon as possible, obviously in the context of a sustained 2% inflation rate.
John, talking about assets in general, the Federal Reserve Monetary Policy Report to Congress today, which I assume you're aware of, talked about asset valuation pressures having returned to or exceeding pre-pandemic levels. I guess that's a euphemism for asset prices being high. How much concern do you have about that and the idea that Fed policy underpins those kinds of high asset prices?
Well, this does take us back to the, very high asset prices we were seeing even last year and before. And clearly equity prices are quite high. We're seeing quite a pickup in residential real estate prices and, very tight spreads on corporate debt instruments. So there's definitely a lot of indications of very strong asset prices. I do think it reflects a couple of fundamental factors. One is I think that, market participants and investors around the world are looking ahead through this year and looking into an economy that hopefully will have a pretty robust recovery and a strong expansion over the next several years, which would support stronger valuations. I also think that we still are in a globally low interest rate environment, even abstracting from the cyclical part of that very low yields on sovereign debt or on treasury securities, things like that, does all else equal imply higher valuations for asset prices. So I think the big drivers, the fundamental drivers, are really kind of optimism among investors to get, that the U.S. economy and the global economy is going to have a strong recovery and expansion, and expectations of low rates, well off into the future. And those combined will give you higher asset valuations. In terms of concerns around this, it's one thing to say that the fundamentals kind of tell you that asset prices should be somewhat higher. obviously the concern would be if that gets out of control or we see really strong imbalances resulting from that in terms of business or household or behavior by businesses or households or financial institutions. And there I actually don't see really the evidence for that.
Okay. John, let's talk about another asset price that seems to be very high right now, which is Bitcoin. Tell us how a central banker looks not only at a cryptocurrency, but at a cryptocurrency that has doubled in value in a very short amount of time. Are there levels of concern? And what do you say to people who believe that maybe one of these days something like Bitcoin or a cryptocurrency might become the normal or regular currency of the United States?
Well, I'm not going to comment specifically on Bitcoin or any of the cryptocurrencies, in terms of what their proper valuation is. I'm not an expert at that. I do think that technology, broadly described, is transforming the payments landscape globally. And I'm not here just talking about cryptocurrencies, but the Federal Reserve is developing a new real-time gross settlement payment system. Other central banks around the world are doing that. We're seeing other innovative ideas in the private sector of coming up with new ways of doing payments faster, easier, more efficiently. So I do think in the broader context, this is going to be a period of a lot of innovation, a lot of new products that hopefully will actually solve some problems that we've had in our payment system, and that's high costs, the challenges of cross-border payments or remittances, and some of those other issues. So I do see this as a period where the private sector, central banks, and others are really actively thinking about how do we best, modernize, if you will, payments. And I think of cryptocurrencies as being perhaps a separate issue of that, but definitely, in the world of central banking and obviously in the banking world too, there's been a lot of study of the technology, the underlying technology of blockchain and other aspects of that, and how could those either help or be used with some of these ideas. So I do see this as a world of change. I don't know exactly. I'm not going to comment specifically about any particular kind of product, okay, but that's how I see it.
John, one more question here. I can't let you go without asking about the future of monetary policy. I think you guys have made it clear that the quantitative easing of what you're doing, or asset purchase, doing $120 billion a month, that will go down before you raise interest rates. What's the outlook for that? Do you believe something like reducing it or tapering it is on the cards for sometime this year?
Well, as we've said from the beginning, our decisions on monetary policy, and we've communicated this, I think, consistently, are going to be based on where the economy is, specifically relative to our maximum employment and price stability goals. And so the answer to that question is going to be, it depends, but importantly, it depends on how we're doing in the economy in terms of the actual data, in terms of the actual performance, referring to maximum employment, in terms of the labor market, in terms of economic growth, and also how we're doing in terms of reaching our 2% inflation objective on a sustained basis. So it's going to, all of our decisions, whether it's around our asset purchases, are going to be driven by how we're doing and how we see us doing in terms of those two goals. Now, we've used specific language around that, looking for substantial progress in terms of our asset purchases. Obviously, right now, we're still, we haven't seen, since we made that announcement, we've been the economy has been in a very slow period due to the winter wave of COVID, spread of COVID. But so right now, I am in a wait and see mode, and we're going to watch the data and see how the economy does, and specifically focusing on the progress on our two goals, and make the decisions that are appropriate to achieve those goals in the future.
John, you've been very generous with your time. Appreciate you joining us here on The Exchange, and a big happy birthday to your son, Ken, who just has to be watching. What else would he be doing?
I hope so. All right.
All right, thanks. John, back to you.
And thank you, Steve Leisman, as well. Now coming up, the overall market's performance might have been underwhelming this week, but the reopening trade was red hot. Investors piled into cruises, hotels, airlines, and casinos, while at-home names fell short. Is it the right rotation for investors? Plus, Elon Musk says Bitcoin is, quote, less dumb than cash, unquote. He knows cars and rockets. Is he right about crypto? We will explore. The Exchange is back in 2.
Divided by distance, united by business.
This is the new reality we're all
Helping you navigate the new normal. Squawk Box on CNBC.
I'm Jemana Versace, and these are the stories you should be checking out on CNBC.com. President Biden's return to the Iran nuclear deal is looking uncertain as the two countries remain in standoff over a lack of progress. Biden's team wants to see changes before it lifts the sanctions, but Iran wants Washington to make the first move. That story's on the website now. U.S. Treasury Secretary Janet Yellen has urged lawmakers to pass President Biden's $1.9 trillion stimulus package, telling CNBC in an exclusive interview it's the only remedy for the worst setback in decades. Head online for the full story. And is there life on Mars? NASA begins a new chapter of space exploration by successfully landing its Perseverance rover on the surface of the red planet. The six-wheeled robot will be looking for evidence of past life. Check out that and more on CNBC.com. And remember, you can follow us on Twitter at CNBCI.
Welcome back. The Dow hit a new intraday high today, despite a mixed week for stocks. Investors having a tough time finding gains, but one place to find them could be reopening stocks. Names like Marriott, Wynn, and American Airlines all higher this week, including an 18% surge for Carnival Cruise Lines. But meantime, the stay-at-home trade is dozing off on the couch. 2020 darlings like Zoom Video, Netflix, and Peloton all in the red. So is a rotation into the recovery trade now underway? Let's bring in Caterina Simonetti, the Senior Vice President at Morgan Stanley Private Wealth Management, and George Cipollone, Portfolio Manager at Penn Mutual Asset Management. Guys, happy Friday. Caterina, how much of this, what we're seeing this week, is about reopening hopes? How much of it is just maybe selling out of some big gainers as major indices hit new highs?
John, thank you for having me on the show. I think it's a little bit of both. Market has been heavily supported. It is strong. The earnings season delivered some great surprises. And I think that we're definitely getting on board with the reopening philosophy and getting behind the cyclical names and getting behind the story of reopening and repositioning our portfolios to reflect what's going to come in that post-vaccine, post-COVID type of era, which is really exciting. But having said that, I think that consumers have developed some really powerful habits over the course of the last 9 months, and stay-at-home names should definitely not be discounted. There is a place for them in the portfolio, and we certainly are paying attention and owning them.
Yeah, it's not as if we're not going to spend any time at home when we eventually are cleared to really go out. George, I was just listening to Steve Leisman's excellent interview with New York Fed President John Williams, and something that struck me was just this idea of optimism justifying so many of the valuations that we're seeing in the market now. But it seems to me like the optimism has become the story driving the optimism. Is that dangerous at some point?
It absolutely could be. And so we're value investors, and so we look at valuations, and valuations are really important to us. And so if you think of the Fed's impact, they've had two major impacts here. They've kept interest rates low, which has driven up asset prices. And number two, they have stimulated a certain behavior in the market where people tend to be a little more irresponsible. And we've seen that through certain examples of specific stocks like GameStop, for example. Yeah. And so yes, to your point, we are seeing that, and that is behavior that is being led through Fed action. So that is something to be cautious about. And then if just going back to this reflation trade, I think it's important. We are income investors, so you are seeing a dramatic impact in the bond market today. And I think that's another thing that's very, very important to keep an eye on.
Katarina, how do you sort of hedge against, protect yourself against being too optimistic about the optimism, getting numb to the valuations? I mean, bonds don't do what they used to do. So what's your strategy?
Our larger strategy is that this is not the time to perhaps just invest in broader indexes. This is very much a stock picker's market, and this is very much the market where investors have to pay attention to earnings, to valuations, to data. Interest rates, for example, we believe that is one of the most important piece of data to watch. Specifically, of course, we know that interest rates have been going up gradually over the course of the last couple of months, but the speed with which this were to happen, and to George's point, we can expect some type of pullbacks in the market. We can expect that interest rates are going to have an effect on consumers' confidence and consumer participation in the market. But if interest rates were to go up really quickly, unexpectedly quickly, or to the extent that the general public is not expected, then perhaps some type of a broader correction will happen.
So, George, you were just talking about value. Where do investors go for it now?
Yeah, so you have. I agree 100% with Katarina. You have to be selective. You cannot be as broad as you were in the past. I mean, if you bought just the broad LQD or you bought the TLT, for example, which is invested in long treasuries, you are down 13 to 14% just since last July. That's a pretty steep decline. So as an income investor, we have found value across the market cap spectrum in large, small, and dividend payers. We've also found value on the front end of the high yield curve. And we think there is some good value there. Also in convertible bonds. Convertible bonds have this beautiful risk-reward relationship where if you buy the right company with the right balance sheet, companies that have more cash than debt, you're protected on the downside. But as the stocks increase and the underlying common stock increases, you can make multiples, 25, 50%, 100% on your money. And we like that risk-reward trade-off there.
All right. Well, thank you, Katarina. George, have a good weekend.
You too. Thank you.
Now, for more ideas on how to invest in this market, head to CNBC Pro. You'll find Goldman's top energy pick, BMO's growth plays, and why Citi sees a 10% pullback. Now, coming up, President Biden getting ready to tour a Pfizer COVID vaccine manufacturing plant and meet with workers. We got the latest on production and distribution across the country as weather delays shipments. Plus, the case for why Dogecoin should be taken seriously. And don't forget, you can watch on the CNBC app. The Exchange will be right back.
I wouldn't describe Hong Kong as a sticking point between U.S. and China. Sometimes, I hope that protectionism.
Pressure on Australia, the boycotts that we're going through at the moment, these are 180 degrees at odds with everything Xi Jinping solemnly told the Davos virtual conference.
It will take some time. I don't think there's, we're going back to where, we were before the Trump administration.
I think still in the early days of the Biden administration, but so far we have seen some companies that are listed in the U.S. returning to Asia, to our market.
Keep up with the crisis. Squawk on the Street on CNBC.
Welcome back. I'm Rahel Solomon, and here is your CNBC News update at this hour. Shortages of drinking water are now taking center stage in Texas. Houston Mayor Sylvester Turner visiting a water distribution site this morning. The shortages have also spread to cities in Tennessee and Mississippi. New York Governor Andrew Cuomo says that nearly 75% of the state's nursing home residents have been vaccinated for COVID-19. He also announced an easing of capacity on indoor dining.
In 1 week, we'll go to 35% in New York City restaurants, which is consistent with New Jersey. What's happening now is people in New York City, Staten Island, Manhattan, are going to New Jersey, to those restaurants. So it's not really accomplishing a purpose.
And Britain's Prince Harry and his wife Meghan say they will not be returning as working members of the royal family. They, of course, stepped away from those duties a year ago. Tonight on the news with Shepard Smith, he's going to take a look at what led them to that decision and what may be next for the couple. John, I'll send it back to you.
Rahel, thank you. And it is Friday. That means maybe you can rest, but money never sleeps. So we're going to take a look ahead to what's in store for your money next week. Here's your Friday Fast Forward.
It may be the shortest month of the year, but February is closing out with a long list of events. Earnings will test the at-home trade. Domino's and Papa John's gives us a glimpse at the hot pizza trade. DraftKings looking to justify its big rally. And in their earnings debut, we'll hear from delivery darling DoorDash and the reigning king of rentals, Airbnb. On the data front, we'll get key reads on the consumer, including confidence and spending, while the Case-Shiller Home Price Index and new home sales will tell us just how hot housing still is. And that's not all. Fed Chair Jay Powell testifies in front of Congress. Apple holds its annual shareholder meeting. And as the COVID vaccine becomes more widely available, the FDA meets to discuss granting emergency use authorization to Johnson & Johnson. And COVID vaccine manufacturers will appear on the Hill. That's your Friday Fast Forward.
We're going to talk about some of that now as we wait for the FDA's meeting next week on that Johnson & Johnson vaccine. Let's look at where we stand now as health officials say weather has delayed 6 million COVID vaccine doses. Bring in our Meg Terrell. Meg, we're seeing news on Pfizer's vaccine today, cold storage, one-dose efficacy and transmission. What do we know?
Yeah, so, a lot of this data normally, when we aren't in a pandemic, would come out before a product gets the FDA's clearance. But because they got this to market as fast as they possibly could, we are now getting a lot more information about the vaccine after it's been on the market. So one big piece of news is that Pfizer and its partner BioNTech have submitted data to the FDA seeking clearance for their label that they can store this vaccine for 2 weeks at regular freezer temperatures instead of having to have it at that arctically cold minus 94 degrees Fahrenheit for that long-term storage. So they think this could help make it easier to distribute the vaccine around the country and around the world. Now, some separate news from 2 studies out of Israel where there has been a massive vaccine rollout. They are not yet peer-reviewed, but they suggest that the vaccine might reduce transmission. And there are also some data suggesting that there is high protection after 1 dose. Now, John, we've all heard the debate over whether we should spread out first doses of the vaccine and potentially delay the second dose of the vaccine. Dr. Fauci and Andy Slavitt on the White House COVID briefing this morning really saying they are sticking to the 2-dose need, but this will raise more questions. However, the data were just out to 28 days after 1 dose. And so a knock is that we just don't know how long that 1-dose protection will last, John.
Meg, all of that sounds potentially really important to logistics, especially that 2 weeks at regular freezer temperatures as opposed to having to have all of this special equipment. Have you heard anything about any sense about how much loss there has been of vaccine because of that sub-zero freezing issue?
You know, it's not something that we've heard is very well documented. We do hear anecdotes about this happening, or when there are power failures, how doctors and healthcare workers have to scramble to try to use these vaccines as fast as they can. And of course, in these situations like we're hearing about in Texas, I mean, this is becoming even more of an emergency, but there haven't been great data on vaccine loss. One thing we did hear this morning, though, Andy Slavitt saying there have not been any doses lost to spoilage because of these delays we're seeing from the weather. But in terms of, you know, the actual storage at hospitals and things like that, we just don't know.
Yeah, we have to imagine, though, it could make a positive difference. Meg Terrell, thanks.
Thanks.
Now, coming up, Twitter hits an all-time high as investors ignore another call by Congress for CEO Jack Dorsey to testify. So why is Wall Street so bullish? Plus, Uber has a new UK problem, and it's Black History Month, and we are honoring some of our CNBC contributors. Here is Halima Croft sharing how to silence your doubts and believe in yourself.
Always believe you have the right to be in the room. I think that is one of the biggest hurdles that you have to get over. Silence that voice in your head that says you're a diversity pick, you don't belong. Always know in your heart that you make that room better, that your views, your talent is important to getting the best outcomes for any organization that you're a part of.
See the future painted in my eyes. Open up the door and fade into the night. Dive into a world I know. Take my hand, follow me into the sun. There's no end. This is where we go alive.
At Standard Chartered, we believe money can be a force for good, which is why we've committed $75 billion to funding sustainable projects in parts of the world that need it most. Because progress doesn't have to cost our planet.
This is where we go alive.
For retail, actually, we don't want to get into long leases at the moment because, we don't want to lock ourselves up at, I think this is definitely the bottom of the market. With the fourth wave ended, social distancing measure is lifted, I think, I'm hoping that the worst is over for retail.
Brian Sullivan.
Good morning.
Worldwide Exchange on CNBC.
Now let's catch you up on a few stories that should be on your radar. It is time for Rapid Fire Tech Edition. Here to break down the headlines with Josh Lipton, Deirdre Bosa, and Tim Seymour, CIO of Seymour Asset Management and a CNBC contributor. First, Twitter hit an all-time high this morning, but the stock has lost almost all of today's gains. Earlier this week, it actually surpassed $74.73 a share. Its all-time peak. It's set all the way back in December of 2013, shortly after its IPO. Question is, why? In fact, Twitter has been on a tear since the Capitol Hill riot and following the platform's decision to permanently suspend former President Trump. Folks assumed that Twitter lost its main attraction that day, but so far the social media giant is proving that it's doing just fine. Maybe it's not a giant exactly, Josh. I mean, I don't know. But what do you think is driving Twitter? Is it this promise of maybe some more paid services layered on top, the competition with Clubhouse? I don't know. What?
Well, actually, that is interesting, John. That competition, that rival with Clubhouse is so interesting. I love the discussion you had on your show today about Squawk Alley. That's a rivalry that I want to see play out. I've been hanging out on Clubhouse. I get it. It's live. It's real time. You raise your hand. You can jump in. And now but obviously different entrepreneurs and companies see the popularity, the blood in the water. They're going to jump in with clones of their own. And how that kind of plays out.
Could this be, Josh? Could it be an anti-Facebook trade? I mean, look at all the stuff that's going on there. I mean, we kind of lost Tim and Deirdre, so it's going to be rapid-fire Josh Lipton edition for a couple minutes here. So, I mean, is this anti-Facebook? Maybe. I mean, Facebook having plenty of issues here. Australia, for example.
Well, listen, there's all kinds of content, and there's all kinds of new ways you are distributing that content, and distributing is getting easier and easier. I think with this, listen, I get it. I see the interest and the attraction when you're on there, and now these companies now get into this space. They put their own kind of spin on it, their own kind of character, their own kind of business model. It's going to be a lot of fun. I don't know necessarily there has to be one winner. We'll see how it plays out, but I do understand the attraction and the interest.
Yeah, I mean, I'm looking at this. 1 month, Twitter is up 57%. I mean, let me look over at Square, that other company that Jack Dorsey is running. It's up 22%. That's crazy. I mean, the valuation of these things is getting longer than Jack Dorsey's beard. Anyway, let's hop across the pond. Uber losing a major employment rights case in the UK as the top court there rules its drivers are indeed workers and not contractors. So what now? This ruling could jeopardize Uber's business model in the UK, set a precedent for other gig economy companies. Uber's got to work with UK authorities to determine compensation for the drivers involved in a 2016 case. The company says it's also going to consult with all UK drivers to understand the changes that they want to see. Investors, though, they don't seem to mind this ruling. Shares of Uber had been higher today, have reversed course, but not by that much. Shares slightly in the red now. Josh, I don't know. I mean, these bureaucratic things, I mean, look how slow Brexit moved. How long is it really going to take these issues to hit Uber in just the UK? And now the UK, I mean, it's not all of Europe. Who knows if it even has broader implications? You think investors have gotten used to the idea that if you're Uber, it's a slog. You got to figure these things out. But there's no really huge number two?
Yeah, I don't know, John. Maybe if you're a tech investor, you've also gotten used to these headlines coming out of Europe. You know it's going to be just the cost of business. You've also known this headline was a risk for some time. I am interested, John, did we ever see, and you would know this better than I, but did we ever see surveys of these drivers in the UK, the Uber drivers? I mean, the men and the women who were driving Uber themselves and what they thought about it. Was it tracking surveys we saw of those drivers here in the U.S.? And would that even matter to you, John?
I think it would matter. I certainly care what the workers, what the contractors feel. And let me tell you what, we're shuffling this lineup like a deck of cards. We got Deirdre Bosa back. We've also got Dom Chu. Dom, on this Uber thing,
yes.
We've seen Uber go through so many different changes. How much does the UK matter when you're trying to be roughly global? I mean, granted, ex-China, because they're not playing there anymore. And now you're delivering food mostly. So, I mean, how much does it matter?
Incrementally, I'm not sure it does that much at all, because the prevailing winds have been shifting this way for a while now. And we've been having this discussion even here in the United States about the difference between having a full-time employee, or let's look at this from the driver's perspective. Whether you want to be a full-time employee or whether you wanted to be the gig worker that only wanted to kind of turn your app on and take the rides and fares whenever you wanted to. In Europe, I could see this playing out because Europe has always been more focused on workers' rights. Many of the economies there are more socialist in nature, higher tax regimes, more benefits to citizenry, that sort of thing. But what it comes down to for the precedent it sets is whether or not the drivers really want to be guys who have to punch a time card in and out. If as a full-time employee, I was hypothetically made to work, say, 8 to 9 hours a day with a 1-hour paid break, and I had to work a certain shift that the employer told me to, I'm not sure how many of the drivers would feel like that's something that they want to do, even with a minimum wage in place. So that's going to be a big precedent to set all across any jurisdiction for any ride-sharing app for sure out there, John.
Deirdre, we had this story on CNBC months ago, about an Uber Eats driver making $8,000 in a month. I bet you he doesn't want to be an employee.
Yeah, well, there is this argument, if you make them employees or workers as they would be in the United Kingdom, does that strip away that flexibility? That is a really, sensitive point where labor activists say, no, that is not the case. You can still have flexible hours, and Uber has long argued that that would take away the flexibility. But, I would actually argue that this is hugely important. The UK, London, is a very, very important market for Uber. 60,000 drivers, and that's just on the ride-sharing side. So it sets a very important precedent. Uber is hopeful that it won't apply to all of its drivers. Right now, it's just a small group of them. It was an important victory in California. We've talked about it a lot, Prop 22. However, we will see how this continues to play out, because guess what? Prop 22 has passed on higher costs to who? Us, the riders, and Uber, the company, less higher than they would have been had workers been classified as employees. But I think that there's just so much here, and I think that it's a reminder that there's regulatory battles ahead that are far from clear-cut, even in California.
Aren't the riders really burritos now, mostly, though, when you think about it? I mean, it's not people so much that the Uber drivers are driving around. It's mostly, it's our food. Anyway, let's bring it back home. Talk about chips. Not those kinds of chips, though, not the takeout. Chip manufacturers facing yet another challenge in the ongoing semiconductor shortage. Extreme weather, these winter storms that slammed Texas, are impacting the semiconductor sector as electricity and natural gas providers continue to suspend service to chip facilities in Austin. According to AccuWeather, there could be as much as nearly $50 billion in total damage and economic loss. Josh, I'm wondering if this changes the pitch of Texas to everybody move here, if they're going to have to face some questions about, is your infrastructure really ready for that?
That's a fair point, John. I mean, we saw headlines. There's some big chip makers who were thinking about building some big new facilities there. Does that, given resources, infrastructure, does that change their minds? Certainly, this is coming at a really tough time because, you are already seeing this chip crunch, this chip shortage. It is the most serious and severe we have seen in years. It has impacted production, everything from computers to cars. And now what you're seeing is, because of this weather, there are chip makers in that Austin area that are having to idle their plants, their facilities. So think NXP, Infineon, and Samsung. Checked in with those companies this morning. They're still facing those challenges today. And when you talk to chip analysts, they say this, usually in normal times wouldn't be a big deal, but because of the shortage, we're already feeling that they could exacerbate those problems, John.
Yeah, I also wonder if it's possibly an opening for some of these next generation energy companies that have different types of backup generators that don't require natural gas, et cetera, whether this is an opening for them as well to be fail-safe. Well, all right, Dom, now it seems like we can't go a week without Bitcoin reaching a fresh all-time high. We're talking about that at the beginning of the show. Today, though, a major milestone, the total value of the cryptocurrency topped $1 trillion. And what might have helped to push Bitcoin over that threshold? This not-so-ringing endorsement from Tesla CEO Elon Musk. In a tweet justifying Tesla's stake in Bitcoin, he called the crypto a less dumb form of liquidity than cash. Musk went on to tweet, Bitcoin is almost as BS as fiat money. The key word is almost. Okay, Dom. Elon Musk says a lot of things on Twitter. He goes through these streaks. Now, I will note, even though he said that about Bitcoin, most of Tesla's reserves are still in cash. So should we pay attention to what he's saying or where he's got his money?
Most of the world's reserves are still in cash,
oh, yeah,
I would argue. And most of them are in U.S. dollars because it is still the preeminent reserve currency of the world. Now, so here's the argument that many people in the Bitcoin world or the crypto world will make about the benefits of crypto versus cash or fiat currency, as Elon Musk wants to put it. The idea that those fiat currencies, because of the massive push in money supply that's being put onto the market by central banks, has debased the values of all of these paper-backed currencies, central bank central bank-backed currencies, and that's the reason why there is a quote-unquote fundamental case for cryptocurrencies. Now, whether or not you really believe that, there's still a use case that needs to be made before people will widely adopt it. And of course, you know that many central banks and regulatory agencies, by the way, if a government decides to come out, not saying that it will, hypothetically, if a centrally planned government decides to come out and say, you know what, this is illegal, we're going to make it black market, we're going to do whatever like that, that takes away a lot of the use case out of it. So again, there's regulatory risks that Deirdre mentioned for things like ride sharing. It's still a big concern for many of the crypto people out there, because remember, in the early days, we talked about them being used as, you know, currency for arms deals and drug transactions and that sort of thing. If that's what it goes back to, it's not going to be widely as adopted as people want to believe it will be, John.
All right. Well, we're going to end it there. Fun edition of Rapid Fire. We switched slingshots. We used different types of ammo. Josh Lipton, Dom Chu, Deirdre Bosa, thanks. Tim Seymour, thank you just for the emotional support. Still ahead, stockpiling paper products and cooking at home both helped push some consumer staples names to record highs. But as economies reopen and more people get the vaccine, is that run coming to an end? We will dig into the staples sector next. And as we head to break, check out shares of Bumble, falling more than 4% today. Now, despite this drop, it has still climbed more than 64% since its IPO last Thursday. The Exchange will be right back.
Real money.
Heat map right now, pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
I'm not quite sure at this stage. I mean, we certainly want to get back to a 70% payout rate. Now is a good sign that we have a good level of confidence. We'd like there to be a bit more. So it may be the full year, but it could be later than that too, just depending on how this half pans out.
We're ushering in the year of the ox. After an unprecedented year of turmoil, we'll look at what's ahead.
The U.S. is in recovery. The rest of the world is starting to catch up.
As China marks a major milestone.
The CCP goes into its 100th anniversary feeling very confident.
And will travel finally get back to normal?
In a normal year, you will see hundreds of million, maybe 200 million people out there on the move. But this year, probably only at 50%.
All that and more in our special year of the ox, Plowing On.
Welcome back. The pandemic boosted several consumer staples names to record highs over the past year as people stocked up on packaged food and cleaning supplies. But as more people get vaccinated, is the sector setting itself up for a slump in 2021? Dom Chu playing offense and defense at the wall now with more. Dom.
It is already starting to play out, John. That's the key here. For a lot of consumer staples investors out there, they've already seen the value come out of some of those quote-unquote high flyers that we saw during the virus pandemic peaks. Now, take a look at the sector overall, because as you can see with the consumer staples sector, it's up a very modest 1.5% over the last 12 months, handily underperforming the broader S&P 500, which is up about 15% roughly during that same time frame. Also, take a look at the valuation argument, because here we have been seeing over the course of the last decade, for the most part, investors paying a higher premium for consumer staple stocks when it comes to how much price they will pay for every dollar of earnings. Now, that's been the case over the last decade. As you can see here, the reddish-orange line is the PE ratio on a forward next year's basis for the consumer staple sector. It's always pretty much above the blue line, which is the S&P 500, up until the past couple of years, and certainly during the virus pandemic, now all of a sudden it's trading at a discount to the overall market. The S&P 500, of course, at record highs right now, but a little bit of that allure coming out of the consumer staples sector. That's one to watch there. As opposed to what's happening with elsewhere in the market, we are seeing a little bit of the momentum come out of some of these names. Look at Clorox, bleach, disinfecting products, McCormick Spices, the stay-at-home trade, cook-at-home trade, and of course Procter & Gamble from consumer goods. You can see over the last year, in the middle of the year, we've started to see a little bit of a decline in trend, so maybe that's going to be a trend that plays out if the vaccination protocols and distribution keeps on the upward trend that we're seeing, John. I'll send things back over to you.
All right. Thank you, Dom. Very real things there. But coming up, Dogecoin, the nominal cryptocurrency named after man's best friend, is up more than 500% in the past month. What is behind the surge? Now, I have likened Dogecoin to Chuck E. Cheese tokens, but should we be taking these kinds of meme coins seriously? That's next.
Most countries will experience recessionary-like conditions. Is it necessary for another 1.9 trillion to be directed at the economy?
We do need some more fiscal stimulus to continue to bridge the gap, to continue to allow us to move through this tunnel and get to the other side.
It is still about crossing that bridge to the recovery, but where the journey seems to be a little bit delayed, but should not be derailed.
We want to accelerate on the vaccine because we are fully aware that there is a direct link between vaccine and economic recovery.
We're starting to see some cracks here, and the EU is just the latest example.
People are focused on right now, when are we going to get our vaccines? This next generation, which we are seeing, and I think those will be flowing quickly around the world.
The challenge will be not a global distribution. The challenge always is finally the last mile.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Dogecoin, the cryptocurrency that started off as a joke, is no longer a laughing matter for some people. The dog-themed crypto is up 1,000% year-to-date thanks to support from Elon Musk, Snoop Dogg, no kidding, and other celebrities. CoinDesk says Dogecoin's rise reflects the power of collective belief and a longing for a more ideal form of crypto, and it is time to take it seriously. Joining me now is Emily Parker, the writer of that CoinDesk op-ed, co-host of First Mover on CoinDesk TV. Emily, I'm not convinced. I mean, I really do think that Dogecoin is like digital Chuck E. Cheese tokens. I mean, they're really valuable to a toddler at Chuck E. Cheese, but once you leave, my goodness, I mean, in 3 years, is this really going to have value?
I mean, I get what you're saying, and Dogecoin is in fact ridiculous. However, our Chuck E. Cheese tokens, do they have a market cap of $7 billion? Do they have a 1,000% return year to date? So there is some difference, right? And the point that I'm making is not that Dogecoin is like a serious investment. It's just that this is real money. And I think it really reflects the moment that we're in now, where basically collective belief and collective action on social media can create can really raise the price of an asset. And that's what we've seen with Dogecoin, and that's what we've seen with GameStop.
Yeah, I hear you. But, on your point about the market cap, I think if we gave 4-year-olds the power to make serious financial decisions, would you like this car or would you like this bag of Chuck E. Cheese tokens, they would pick the bag. And, so in a way, I think it is analogous. So is this more time to take it seriously, Dogecoin itself, or time to take seriously the fact that people are so swept up in this meme-like moments that they've taken on a financial significance that can have real-world implications?
Yes, I think the way you phrased it is actually more accurate. So just to be clear, I'm not encouraging people to buy Dogecoin.
Okay.
I'm just saying that, I'm just saying that that's exactly right. We are just in a really interesting moment where assets are kind of being valued by the masses, by the mob, by social media. And I think Dogecoin is just a perfect representation of that. Of course, there are people who truly believe in Dogecoin, but I don't think that all the investors in Dogecoin are investing based on fundamentals, or they're investing based on kind of like a crowd sentiment and the fact that, it's just part of a zeitgeist.
As we're learning more than ever in 2020 and 2021, there are people who truly believe in all kinds of things that may or may not have a fundamental basis. And so be careful out there, investor, whether it's GameStop, AMC, Dogecoin, what have you. Emily Parker of CoinDesk, thank you. Have a good weekend.
Thank you.
Now that will do it for the exchange. Power Lunch picks up after this quick break.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
The declarations that I made yesterday, one in which of equality. We will get to 50-50 gender equality by 2022. We created a breakthrough program, benefits program for parental leave, with 8 weeks for all, mothers, fathers, and an additional 6 weeks for both mothers.
On the next, Managing Asia, the man running Singapore's largest supermarket chain, FairPrice Group.
Before DORSCON Orange, we could already see, the build-up of crowd at our stores. They were buying like there's no tomorrow. We are managing stockpile, covering a few key categories. We have had to review and rethink many of our strategies.
Sia Kian Peng, CEO of FairPrice Group, on the next, Managing Asia.
Good afternoon, everybody, and welcome to a frigid Friday edition of Power Lunch. Along with Seema Modi, I'm Tyler Mathisen. And right now, President Biden is set to tour a Pfizer facility in Michigan that makes the COVID-19 vaccine. The rollout ramping up a little haltingly, but ramping up nonetheless. The case numbers are down. But will it all be enough to get the economy roaring back by summertime? We'll talk to the CEO of one company that is counting on it. TripAdvisor shares are higher today and up nearly 40% this year. How about pot stocks? They've cooled off this week. Did the cannabis craze get a little overhyped, or is this industry only going to get bigger? What do you think? We'll analyze it for you as Power Lunch starts right now.
Happy Friday, everyone. I'm Seema Modi. Let's begin with the markets right now. With 2 hours left in trade, stocks are higher across the board as Janet Yellen pushes for more stimulus. But the Nasdaq and S&P still on track to close the week lower. Let's bring in Bob Pisani for more. And Bob, it's not often you see a name like John Deere up 10% on the day.
They're just killing it in the manufacturing and the agricultural space. But the important thing, Seema, is we're kind of flat on the S&P. I mean, haven't you noticed last 2 weeks, folks, we're not going anywhere. Look at the S&P. We're essentially sideways. I know Janet Yellen, God bless her, is beating the drum on stimulus, but we're sort of reaching the limits of what can happen here on stimulus. Tech isn't doing anything at all for us. So just look what's moving today. Okay, so we have the reflation trade going. So energy stocks are up, material stocks are up, industrials are on the upsides. Banks are also doing well because yields are up. There's your reflation trade. Semis are up because applied materials had a fantastic number. Thank goodness, because semis were weak all week. So let me show you what's going on with the other mega cap names, though. Here's a problem. We're dead in the water. Facebook is doing nothing for us right now. Apple is 10% off its highs. 10% off the highs, folks. Go back and look at it a few weeks ago. Google's doing all right, but 1 out of 5, we need a little more move from big cap tech, and we're not getting it right now. Thank goodness Applied Materials, one of the biggest semiconductor equipment manufacturers in the world, knock them out of the ballpark numbers here. That's an historic high for Applied Materials. Demand's exploding for chips all over the world. We know that. Josh talked about the supply problem. That's an issue, but the demand is certainly there. Now, Seema mentioned Deere. What's going on? Well, agricultural demand is exploding. Demand for construction equipment is exploding. That's an historic high. They beat the analyst numbers by 80%. I don't ever think I've ever seen that. 80% they were off, the analysts. How can that possibly be? They got it wrong by 80%, but they actually did. Finally, folks, you want to talk about things that are high priced? So the earnings are great, but the stocks are high priced. That's the problem. Speaking of high priced, Bitcoin, there is a Bitcoin ETF. Only not in America. There's one in Canada. It started yesterday, and it traded among the heaviest volume of any ETF in the United States or in Canada. And again, this is trading on the Toronto Stock Exchange. Roughly parallels some of the Bitcoin moves that you're seeing there. But hopefully, maybe we'll get a Bitcoin ETF, Tyler, in the United States by the end of the year. Who knows? But the Canadians, they got there first. Back to you.
All right, Robert, thank you very much. Bob Pisani, we'll see you later. So with the markets a bit of on a Yellen high lately, the broader issues of rising rates and inflation do remain. Let's bring in Ron Insana. He's a CNBC senior analyst and commentator, as well as senior advisor to Schroders North America. And Brian Belsky is chief investment strategist with BMO Capital Markets. Let's take a tour a little bit of what you guys are seeing right now in the markets, and whether you're sensing a little bit maybe the early signs of a pullback. Do you see that, Brian, at all?
Well, good afternoon, Tyler. Always great to be on with the awesome Ron Insana as well. I would say this. Too many people are looking for a pullback. When people stop talking about a pullback, that's when we're going to have a pullback. When people stop talking about a bubble, that's when we're going to have a bubble. Things are not linear for long. We have to slow down here a little bit. Now that the earnings parade has stopped as well, it's not surprising that things have slowed down. That doesn't mean we're going to have a correction. I think the market is transitioning to an earnings-driven market versus this multiple-driven market. And oh, by the way, that's very fundamental, very healthy, and needs to continue. So we're still bullish, and we would continue to be buying the dips in this market.
So let me get you to untangle something that tangled my brain a little bit in my notes, Brian. I'll turn to you, Ron, in just a minute. You say the return to normalcy in 2021 is a fallacy, not going to happen. but you remain quite bullish. You don't think inflation is much of a threat. You think stimulus is going to be there. The Fed has said as much, that they're going to be there through 2022, maybe even longer. So why do you discount the importance of a return to normalcy in 2021?
It's a great question. Normalcy doesn't mean that stocks are going to go down. Normalcy means that we're going to get back into normal living and normal societal, and that's obviously not going to happen. That's just common sense. And we said this in November when we published our year ahead piece, Tyler. We think it's going to be much of the same type of market in terms of momentum, rhetoric-driven, emotional. But the biggest difference, we believe, 2021 versus 2020 is clearly a broadening out of the rally, more of a stock pickers rally. Correlations have fallen, and we think you want to be more thematically and fundamentally driven and not so concentrated in the Mafangs, of course, which was talked about in the hit right before we spoke here.
Ron, why don't you jump in here? I sense that over the past few weeks, you have turned from relatively more cautious than some of the other folks we hear from on CNBC, but still cautious, but a little more hopeful. Am I reading you right?
No, you're reading me right, and I think you talked about the Yellen high. I think we're going to get the Biden bid on infrastructure, which is already there. I mean, Bob was talking about, some of this stuff being priced in. I'm not sure we've fully priced in what might be a bipartisan move to spend a lot of money over time on infrastructure, and so we're seeing the Deeres and the Caterpillars and those other basic industrial companies do quite well. And that rotation from large to small, from growth to value, from U.S. to international is still working. Japan's at a 30-year high. Asia, generally speaking, coming off the Lunar New Year, has been doing pretty well. Germany's done fine. So, all of that's working and continues to work, Tyler. Listen, I'm still, yes, cautious about a correction with the 10-year note yield rising as quickly as it has to 135 with inflation break-evens, both 5-year and 10-year, now at more than a 1-year high, and about 2.2, 2.3%, depending on which one you're looking at. I do think that might give the market pause, generally speaking, at some juncture, but a correction, not the beginnings of a bear market. But yeah, I mean, economically, with the vaccine news coming out, much more stimulus coming in, and more to come beyond that, and I think a reluctance probably to raise taxes in a meaningful way down the road, there's just a lot of ammo left that I probably didn't fully discount into my own scenario.
Right. Let me get you to give me a quick answer here. You mentioned, and I was going to come back to you, on the rising interest rates, Ron, now at 135. Is that signaling a healthier economy or rising inflation or both? How worried are you about that and about the prospect that within a couple of years our total debt is going to be $30 trillion, say, and our economy is going to be $23 or $24 trillion? So we're going to have basically maybe 140%.
Yeah, I've been worrying about all those things since 1984 when I started in the business, and I'm still worried about it. So yes and no. I mean, the flip side here is that with respect to inflation, I mean, the Fed's probably not going to move off the dime. I think it's a catalyst for a correction, not for a bear market. And the market continues, as Brian said, to get somewhat overextended in a certain fashion, and there are pockets of speculation that at some juncture are going to burst. It's going to be the rate of change in interest rates that determines, how swift and how severe a correction might be, and rates are moving pretty fast. So I'd be keeping an eye on that. The market has shrugged off the debt issue for all intents and purposes, at least for now. We'll see if that comes back to haunt the bond market later on, but that doesn't seem to be the issue at the moment.
Brian, I'm going to give you a very quick last word on interest rates at 1.35 on the 10-year. Concern you or not?
No, we'd say meh to inflation as well. We've been waiting 39 years for that. It's always dangerous asking an equity guy about fixed income, but as long as that 10-year Treasury stays below 150, I think it's an exceedingly positive environment for stocks.
Ron and Sana, B squared. Thank you very much. We appreciate your time today. Seema.
Tyler, for more on the move in interest rates, let's go over to Rick Santelli at the CME with the bond market heating up here. Rick?
Yes, it is heating up, and what a great discussion we were all having. Let's look at a week to date of both 10s and 30s. We are guns hot. As Ron pointed out, we have traded up to new highs for this cycle post-COVID, 136 on 10s. And let's stick with that 10-year for a minute. Open that 10-year chart up to March of 2016. How many weeks have we been talking about the potential to get up to those double bottoms in 2012 and 16. Well, here we are. That was 136. Zoom, zoom, zoom it back to the 2012 bottom in July, which was at 138. And here we are. Does that mean we have to stop here? No. But the pause here is very significant. Maybe it's a place if you were short looking for rates to rise to take profits. But maybe the bigger issue is if you're the wrong way, we start to trade above this issue. Nervous. You need to be nervous. We could get up to 160 quick. Finally, 30 years even more aggressive. 10 years of comp in February of 20. And now January of 20 on 30-year bonds, as you see. 2013 puts them up a dozen basis points on the week, and all the spreads, of course, are steepening with 10s to 2s, the widest in 4 years. And, Tyler, you asked what's more important, inflation, the economy, why are interest rates going up? Does it matter? I'll tell you why it matters. Because if we have to spend $700 billion a year servicing a $30 trillion debt, what other budget is that money going to come from? Stimulus is fine. It doesn't mean we have to worry about raising taxes. It means we'll have no choice.
All right, Mr. Santelli, thank you very much. Very good point there. As rates go up, the service on the debt gets more costly. You know that if you have a variable rate mortgage. Let's get to Josh Lipton now for a market flash on new moves around the Apple car. Josh.
That's right, Tyler. So check out names like Luminar Technologies in today's trade and Velodyne LiDAR. These companies make self-driving car sensors known as LiDAR, both moving sharply higher earlier now, pairing those gains slightly. The move follows reports that Apple is in talks with LiDAR suppliers as it pursues development of a passenger vehicle. That is according to Bloomberg, citing sources. Remember, our own Phil LeBeau has reported that Apple has been talking with car makers about manufacturing an Apple-branded autonomous electric vehicle. No surprise that Tim Cook would be curious about at least exploring such a product, opening the potential to tap a global auto and mobility market valued at $10 trillion. Apple declining comment on that report. We'll bring you headlines if we do get more information. Back to you all.
All right, thank you very much, Josh Lipton. And coming up, 66,000 new COVID cases in the U.S. yesterday. Still a lot by any measure, but 6 weeks ago, we saw more than 300,000 cases in a day. Look at the drop-off. That is about an 80%, if my math is right, maybe a little less than that. We're going to take a check on the vaccine rollout as the president gets set to tour a vaccine manufacturing facility, one of Pfizer's. And we'll ask the CEO of TripAdvisor if the vaccine can save the summer travel season. That's next on Power Lunch.
Daybreak in the U.S.
Frayed nerves all around. Tech stocks down again today.
Start on top of the news. Brian Sullivan, Worldwide Exchange on CNBC.
Is that of the 1.3 million Australians who either lost their jobs or saw their working hours reduced to zero, 90% of those are now back at work.
We are optimistic. The fiscal stimulus and investment will be boosting our demand.
We have already several quarters of contraction, so I hope that we could see some encouraging growth.
We are not going back to the pre-COVID world in terms of quality, while we may get back there in terms of quantity by the end of this year.
Foreign tourism will be coming a little bit late that we expected earlier.
A big part of in Asia. Continue to be strong, and then some in Japan. Some industries are booming, so they can absorb jobless people.
Travel companies posting big losses for the fourth quarter, but that hasn't stopped hotel and online travel stocks from rallying this week. Case in point, TripAdvisor hitting a 52-week high despite reporting a wider than expected loss for the fourth quarter as the company sees higher search activity for international trips. CEO Steve Kaufer joining me now for a first on CNBC interview. Steve, welcome back.
Oh, very nice to be here. Thanks.
So with a vaccine on the horizon, you're starting to see more search activity, travelers book travel for later this year. But I'm really curious as to why you're starting to see more international travel pick up when we still have travel restrictions in place and some countries, their vaccine rollout being a bit slower than expected.
So what we see on the site and what we hear from the surveys that we're doing is that travelers are eager to get out and somewhere. And a lot of people missed that international trip over the past year. And so they're already planning. They're aware that they're likely to get vaccinated over the next 3 or 4 months. And so they're planning ahead. They're trying to figure out where they're going to go. And a lot of those places are, in fact, international destinations.
You know, I think one burning question out there right now is whether countries will make a vaccine a prerequisite to entering their country. What are you hearing on that front? Because countries like Spain have already said if UK travelers want to come in, they have to show that they've gotten the vaccine.
And I think that makes a reasonable amount of sense now, but it's really hard to predict what all these countries are going to be doing in the middle of Q2 or towards the end. American tourists especially bring a lot of dollars to a lot of different places all over the world. And I think countries are going to be pretty eager to make it easy for travelers. I think most Americans, if they want to get vaccinated, will be able to get vaccinated in the second quarter. So it looks like the summer travel season should be pretty strong.
And you're hoping to capitalize on that growing demand for travel, especially as summer nears, with your launch of Trip Plus, the subscription program. But there was an analyst out there at BTIG who says that TripAdvisor famously overpromises and underdelivers historically when it comes to planned programs. How do you prove how are you going to prove the market wrong here, Steve?
Well, if you look at what TripAdvisor Plus is all about, we're providing an incredible value for the travelers. They're getting, for a subscription price, they are getting a discounted hotel room, they are getting perks and benefit, they're getting other services when they actually arrive in destination, they're getting a discount on attractions. And so if you want to turn a regular traveler into a savvy traveler, you should really think about TripAdvisor Plus because it's going to save you so much money and give you a better experience once you get there. Imagine saving $250 on a hotel trip because you're planning on a trip to Europe on that hotel. And you get anywhere from a bottle of wine to a free upgrade at that hotel. And you take that savings and you apply it to stay an extra day or to take the private tour instead of the group tour. All for the value of our travel subscription that you can get on TripAdvisor. So we think it's tremendous value for the traveler. We think the hoteliers are quite interested in it because it brings them an extra guest that's likely to stay longer and be of a higher luxury status. And it's great for TripAdvisor because we're building what we hope will be a very meaningful recurring revenue part of our business.
Yeah, I'll be very curious to hear from you next quarter about subscription and users for that new program, especially how it strategically positions TripAdvisor compared to other online travel operators like Expedia and Booking. But I do want to turn to politics because you have been critical of Google in the past, the challenges that Google has created for your company, TripAdvisor. I'm curious now with Democrats controlling the Senate, whether you think now, this year, we could see some type of regulation that will take aim at Google.
I think our position on Google is fairly well known. It's not just TripAdvisor, it's many, many other companies that are trying to provide real value to customers that use the internet, and Google's becoming a chokehold, a bottleneck on letting that traffic flow to the best sites, to the best folks that can provide answers. So I am very hopeful that the Biden administration will continue what the past administration had started in terms of an extra level of scrutiny and hopefully action on companies like Google that are, essentially hurting consumers by limiting the choice that they get.
We will be watching. Steve, thanks for joining us today. Steve Kaufer, CEO of TripAdvisor.
Thank you for having me.
All right, we've heard a lot about the rise of retail investors in recent weeks, but who are these everyday traders? The answer may surprise you. Power Lunch will be right back.
Real money.
Heat map right now, pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
When can we expect some of these bottlenecks to be ironed out? How long is this supply shortage going to persist for?
So the manufacturing process is quite a complex process, and it takes quite some time to get new tools into the fab and to qualify it. So therefore, from that perspective, we need to assume that this situation will take several more months until we can see a relaxation in the overall supply chain.
She's a courageous corporate strategist.
She had a very high ambition and drive to succeed.
Fearless philanthropist.
To give such a transformative gift is incredible.
And Grammy-nominated musician.
Music is what I am. Everything else is what I do.
Defying all convention.
I've broken boundaries because I didn't know they existed.
The Brave Ones. Chandrika Tandon on CNBC.
For many, the phrase retail investor tends to conjure up images of 20-something day traders talking stocks on Reddit in their parents' basement. But the reality is actually far from that. Robert Frank has more. Robert.
Hey, Tyler. More than 10 million Americans opened new investments accounts last year, and a new study shows that they are older, more diverse, and more long-term oriented than the whole GameStop story might suggest. Now, the study by the FINRA Education Foundation and the University of Chicago looked at people who had opened investment accounts for the first time in 2020. Now, most were between 30 and 59 years old. Nearly half were women. A third were African American or Latino, with African American share of new investors twice that of existing investors. Now, the main reason they wanted to start investing was retirement, and they were motivated mainly to start investing by the low minimum investing amounts, which was actually more important to them than the free trading that we often talk about. Now, most are not active day traders. About 90% of them trade less than 3 times a month. In fact, these new investors are less likely to actively trade than existing investors, but they also need a lot of financial education. When they were asked 5 questions, they scored an average of 1.4. That was nearly half the score of existing investors. Now, most of their investing advice came from friends, family, and colleagues. Tyler?
I'm very interested in the demographics of this new cohort of investors. More women, more people of Latin background, African American background. Is this because they suddenly found these platforms, or because the platforms went out and marketed to them?
It was both. And what was interesting is the main connection that they had to these investment platforms was through friends. So it wasn't advertising, it was through friends. So it was a lot of peer-to-peer colleagues and friends saying, hey, check this out. And the second thing, which I think we've sort of overlooked in all this discussion about free trading, is the fact that you didn't have to have $10,000. You know, investing can be so intimidating for those who don't have a lot of money to invest. And the idea that, look, we're not going to make you put in even $1,000. You can invest $200, $20, whatever it is. That low threshold was really the on-ramp for so many of these investors who have not been in the stock market.
Do those companies that, I think that's exactly right, because I think most people who sign up for these things, they don't want to trade all that much, but they are attracted by the low minimum. Does the company make money on these accounts now, or are they banking that eventually these people are going to get to a break-even point for them where they will make money on them?
I think it's a little, you know, they're getting a lot from order flow and other sources of revenue now. I think eventually they want to sell this group credit cards and lots of other financial products. And this is a group that is sort of younger in the broad cohort of things. They're 30 to 59. So I think they are also hoping that these investments, this wealth grows over time, and they will be wealthier and generating more revenue over time. But look, this truly is a democratization. What we need to do is get them better educated to be long-term investors. And I was encouraged that retirement, as opposed to speculative trading, is their main goal.
Right. Robert, thank you very much. Have a great weekend. Robert Frank, SEMA.
Still ahead, Ty. President Biden about to tour a Pfizer vaccine facility in Michigan. We will take you there live next. Plus, after a massive start to the year for marijuana stocks, they are off their highs. As the pot rally peaked, we're going to discuss when Power Lunch returns.
Travel brands need to keep a very tight balance between being visible and not forgotten, but at the same time being empathetic and power back to the consumer. When they are ready to travel, South Africa will be waiting for them. You got to be present out there. You got to lead the conversation. You have to give comfort both to the trade, the sector itself, and also to the consumer. That's how you build confidence. You also build confidence by informing and educating the consumer. Because an educated traveler becomes one that is informed. They know exactly what to expect, and more importantly, they know what to demand from the destination once they get there.
NatWest has reported a full-year pre-tax loss of £351 million. The British lender also confirmed it will exit the Irish market after more than 100 years of operations.
It was a really challenging year, but we really believe it was the year that as a group we really stepped up. And disappointing to deliver a loss, obviously, but when you look at the operating profit pre-impairment, we were up 4%, and that, I think, in this environment was a really good outcome.
Welcome back. I'm Rahel Solomon, and here is your CNBC COVID update at this hour. Dr. Anthony Fauci says today that a new study from Israel showing that the Pfizer-BioNTech vaccine is 85% effective after only one dose, quote, looks interesting, but doesn't show how long-lasting that protection is. For now, he says that the government will stick with its recommendation that everyone get 2 doses rather than give more people one shot more quickly. And as cases decline, more restrictions are being loosened. In the last hour, California announced that it will allow youth sporting events to resume next week in at least 27 counties with low infection rates, although testing will be required for high-contact sports such as football and basketball. And the NCAA will allow some fans to attend the Division I basketball tournament next month. All 67 games will be played in Indiana. Attendance will be limited to a quarter of capacity with masks and physical distancing mandatory. And no loosening yet at U.S. land borders with Canada and Mexico. Amid continuing concerns over COVID variants, the Biden administration today extended the ban on non-essential travel through at least March 21st. Tyler, I'll send it back to you.
Rahel, thank you very much. Let's take a quick look at the markets and where they stand on this frosty Friday. The Dow Industrial is a little bit higher, at least they were earlier in the session. As you see there, just by 6,100. It's basically flat. The same really can be said for the S&P 500, down just a little, and the NASDAQ kind of flat. Russell 2000, it, however, is moving up on the day by 47 points, or better than 2%. Oil market closing for the day. Dom Chu is at our commodity desk. Dom.
All right, so Tyler, what we could spend for oil, gasoline, and natural gas prices, much of it because of the deep freeze in Texas and other parts of the central U.S. Right now, oil prices are closing out the week on a lower basis with U.S. benchmark West Texas Intermediate, or WTI, prices $59.14, 2+% declines there. World benchmark Brent crude futures, you can see $62.82, almost 2% declines. And natural gas prices are actually lower now just in the last 15 to 20 minutes after a bigger drop yesterday as well. Those oil prices falling as much of Texas's oil-producing infrastructure looks to get back online with that freezing weather, hopefully moving out of the area. Attention now, of course, turns back to the more traditional demand and supply developments with regard to COVID vaccinations and global oil output, OPEC supplies, that sort of thing. So, Seema, keep an eye on those oil and gas prices. We'll send things back over to you.
Brent crude at $62. Thank you, Dom. President Biden to tour a Pfizer vaccine manufacturing site in Michigan this hour. Meg Terrell has more on the state of the administration's vaccine rollout. Good afternoon, Meg.
Hey, Seema. So we are expecting to see the president along with the CEO of Pfizer at this Kalamazoo plant. This is where they do the finishing process for all of the vaccine in the United States. They actually formulate it there and then they put it into vials, do all of the purification steps, and it is from that plant in Michigan that they start shipping around the country. Now, here's a look at how many vaccines have been deployed in the U.S., both of the Pfizer and the Moderna vaccine. So far, 41 million people, or about 12.5% of the population, have at least received their first shot, and 16.2 million people, are approaching 5% of the U.S. population, is fully vaccinated with 2 doses. Now, this is happening at the same time. We are seeing these dramatic drops in case numbers in the U.S., in hospitalizations, and now also in the numbers of deaths. Daily cases are down about 70% from their peak that we saw basically at the lowest level now since late October. The number of folks in the hospital with COVID, still 62,000 people hospitalized with this disease, but it's the lowest since mid-November and down more than 50% from the peak. Deaths have now started to come down as well. You're seeing them at the lowest level since early December, down 40% from the peak. So, guys, experts say that it is probably on the early side for the vaccinations to really be driving a lot of this. They will start to make a bigger difference, but everybody is still really concerned about these variants circulating out there, a huge risk to potential future spread.
Yeah.
Seema?
Certainly seems to be. And I know you've been following the vaccine rollout, not just here in the U.S., but in other countries as well, Meg. Israel has really received a lot of praise. Can you tell us a little more about the new data that's coming out of that country?
Yeah, and what's great about the data from Israel, isn't just that they have had such a successful rollout of the vaccine, which they have, but they also have been doing a lot of data collection. And so the world is really looking to Israel to see how these vaccines work in the real world. There are 2 studies that have come out today. One that was in The Lancet, another reported on by Reuters, looking at the ability of the vaccine to prevent transmission, not just to prevent cases of the disease. And it seems like it appears to do that at pretty high rates. Now, Now, these are not yet peer-reviewed studies, but the indications are looking good. Now, another study, which Rahel was just mentioning in the news update, suggests that there is 85% efficacy after just one dose of the vaccine, but that's only out to 28 days. So you hear folks like Dr. Fauci and others saying we don't know the long-term protection from just one dose, and that's why we need to get two. Guys?
All right, Meg, thank you very much. Meg, following the story there, we're going to talk a little bit more about it right now as President Biden tours a Pfizer vaccine manufacturing facility out in Michigan. We expect some footage of that throughout the afternoon. For more on the vaccine rollout, let's bring in our friend Dr. There's a look at what he's doing. I guess he's walking through one of the plants out there where they make and package the vaccine. Let's talk to Dr. Jeremy Faust, emergency physician at Brigham and Women's Hospital in Boston. Dr. Faust, it's great to have you back. I feel like we're brothers almost. I've seen you so much over the past few months. One of the things that interested me there in the previous conversation is how much the case count has fallen. And that case count apparently peaked back in November before there was a vaccination. Why are cases down as much as they are? Obviously, the vaccines have some part of the explanation, but not all of it.
Yeah, it's great to see you too. And as you say, the cases really took off in the fall, November, December, and then actually reached their peak about 15 days after Christmas. That is not a surprise to any public health official or expert who follows this. We were worried about that fact. And when you see that graph and that sort of area underneath the curve, those are lost lives. But we now see that we are coming away from that. Is that a combination of the effect of our initial vaccines? In part. It's also probably due to the fact that when people hear the news and see what's going on, they say it's a bad time, and so they hold back. There's a cyclic nature of our behavior. We see danger and we respond. So, and then also, quite frankly, we now have a president who's not out there every day saying, don't be afraid of the virus. I don't know what the effect of the social media messaging is, but it has, as someone who does this all the time, it's been nice to have to fight against less medical misinformation.
I had my first shot of the Moderna vaccine earlier this week. I've got a lot of questions about it and the vaccines in general, but let me get your perspective if you know. Does one vaccine, Moderna or Pfizer, have a higher profile of adverse reactions? In other words, you hear a lot of people say, it's that second shot that gets you, brother. Is one of these vaccines more prone to produce a response negative in someone who gets it?
If you look into the trials, there's slight differences here and there, but I think that the main point that you just said is so important, which is the first jab, the first injection has some degree of a side effect or adverse sort of effects that we now expect. It's that second one. 50% of people who get the second Pfizer vaccine, for example, are going to have real fatigue, like they don't want to go to work fatigue. 29% will have a fever. And the reason I mentioned this is so important is that we have to lower the bar for people to get this vaccine. We have to have paid sick leave. We have to give expectations. What worries me is that people will avoid the vaccine because they hear that. And in fact, what we want to say is, look, this is our immune system working, doing its job. Let's make it really easy. Websites are crashing. That's a disaster. We need to make this so easy. There can be, as my friend Cass Sunstein says, there's no sludge here. We can have no sludge. If someone wants a vaccine, they should be able to get it right away, and we need to educate them on these expected side effects.
The other concern, doctor, is the South African variant. I mean, do you think we are testing enough for this variant? There's some medical experts say we're not, and therefore we don't really have an accurate gauge on how much it's spread here in the United States.
Yeah, it's a very important question. The South African variant has now been detected here in Massachusetts for the first time, and it comes at a moment when we have fewer hospitalizations. So I don't want bad news, I want good news. We know from recent studies that the Pfizer and Moderna vaccines do have some reduced response to these variants in the laboratory conditions in terms of neutralizing the antibodies. But we don't know what that means clinically yet. And so we have to not give this virus an opportunity to to teach us a hard lesson. Every time a person gets infected, that person becomes a literal breeding ground for possible more mutations we haven't even dreamt up yet. And those could be the worst nightmare. Those could make the vaccines less effective. They could make the kids who have been relatively spared sicker. So I think that what we are learning here is the faster we can suppress virus transmission overall, the fewer of these variants show up, and then the fewer question marks we have.
Mm-hmm. I'm famous for compound questions, and I'm going to end on one. The Israeli finding that it appears that the vaccine inoculates you not only against getting the disease, but also against having the ability to transmit it. I'd like to get your comment on that. And then the other question is kind of a personal one. If all 4 members of your family, my wife and I, and my father-in-law and mother-in-law, we're all vaccinated, and my 15-year-old son doesn't need the vaccination, can we go out and sit safely in a restaurant and hug one another?
Okay. I'll start with the first one. The first question is about the reduced transmission. We keep seeing these little hints. We see it in the Moderna trial, in the appendix, in the back of the study. We see a little signal that the vaccine can stop all infection, asymptomatic transmission. Not perfectly, not high enough, because they only checked about 21 days out. So it's a hint that there's good news, but we need to see what happens many more days later. Now the Pfizer study from Israel, same kind of thing. We see that the longer and longer you get away from these doses, the less disease there is, and possibly now the less transmission. That could be why, even though not a lot of people have gotten both doses, that we're seeing a decrease. The second piece is it really depends on the sphere outside. So, for example, you could go and do a group gathering, and I would take a restaurant out of the picture because restaurants are a difficult subject, but in a home or wherever. And it could be safe for you if everyone in your outer orbit is also equally protected. What we don't know is if someone just got vaccinated 2 weeks ago and they spread it across, and then they go home to their relative who you didn't see, there's some degree there. So I think we're getting closer to what you're saying, Tyler. I think it's something that I'm looking forward to, but we need just a bit more data before I'm doing that kind of activity.
Dr. Faust, always great to see you. Clear answers, as always. Jeremy Faust, we appreciate it. Seema.
And Tyler, as the vaccine rollout continues to hit speed bumps, it's not just individuals having a hard time getting their hands on a shot. Companies are ramping up their health facilities as mass workplace vaccinations remain in limbo. Bertha Coombs with that story. Bertha.
Seema, you know, there is an urgency for large employers of frontline essential workers like Tyson Foods to get their hands on the vaccine. Tyson is vaccinating workers in Illinois, Virginia, and Missouri this week, but they got a total of 1,000 doses. Up until now, they've actually only gotten 25 to 50 doses at a time for nurses and staff over 65. With 120,000 workers across 24 states, they are scrambling for every dose they can get.
We're not turning down any opportunity to obtain vaccine for our team members.
Tyson and other meat packers have come under fire for widespread outbreaks early in the pandemic. It's prompted a congressional probe, but they've since instituted testing and other safety measures with their occupational health provider, and they've worked on educating workers to combat vaccine hesitancy. They just can't get supply.
We're coming to these jurisdictions asking for, 1,000 or 1,500 doses. They don't know going in sometimes how much they'll have to actually allocate to us.
And it isn't just Tyson trying to get those doses either. In the meantime, the company is giving workers 4 hours paid time off to get an appointment to get their shots off-site. But Tyler, first they have to get that appointment.
Bertha, wherever you are, it is just beautiful. Thanks very much. Bertha Coombs reporting. Up next, energy stocks climbing again today, up more than 21% this year. One of the better performing sectors after a long decline. Our traders will discuss that one when we return.
retail, actually, we don't want to get into long leases at the moment because, we don't want to lock ourselves up. I think this is definitely the bottom of the market. With the fourth wave ended, social distancing measure is lifted, I think, I'm hoping that the worst is over for retail.
It's one of the world's largest accommodation search platforms. Trivago CEO Axel Heffer talks COVID's impact.
It's a very difficult point in time right now. In most countries, there are tight restrictions.
Recovery.
We definitely expect domestic to be the majority of the market. It will take some time to rebuild that confidence in travel overall.
And the future of travel.
We are using structured data to provide you with inspiration of where to travel.
Don't miss the CNBC conversation.
Helping you navigate the new normal. Squawk Box on CNBC.
Welcome back to Power Lunch. Energy, a big mover today. It's the top performing sector in the S&P 500 this month and year, with oil-rich Texas mired in a cold storm and demand tied to this economic reopening on the rise. Where to next for this once underperforming sector, and what's the trade? Craig Johnson of Piper Sandler, Boris Schlossberg of BK Asset Management. It's your Trading Nation team today. Happy Friday, guys. Craig, I'll start with you. The speed of the recovery, that certainly caught a lot of people by surprise. Where do you see oil prices going from here?
Seema, no question, it's caught a lot of people by surprise, and they're asking two questions. One, is this move for real, or is it just going to be another stutter step from here? If we come back and we look at a chart of, say, the XLE, it's at a very interesting inflection point. You've made a very nice double bottom low, and it looks like to us that we're getting very close to reversing. I think from here, people have to add energy exposure begrudgingly. It's a small part of their benchmarks, but I think you got to buy the energy sector and at least start adding to positions. Stocks like Exxon, stocks like Pioneer, all look constructive from our perspective.
But Boris, there's still no shortage of oil, and global appetite for oil still remains low or less than pre-pandemic levels. So what's the best way to play this?
So there's a couple ways to play this. I really like Marathon Petroleum right now because it's the largest refiner in the U.S. It's just sold off its retail operations to 7-Eleven for $16 billion. So it's going to use that money to pay down debt and maybe buy back shares. It's got a 4.25% yield. If you want to get super fancy, you can sell the March 51 puts and get the stock 7.5% lower from the price here with a higher yield. And I think it's going to benefit from the long-term move in oil. So to me, that's going to be one of the better plays as we go forward.
Yeah, energy actually one of the sectors that has the highest dividend yield of 5.5%. Boris and Craig, great to see you both. Thank you for joining me today. And head to our website, tradingnation.cnbc.com, for more retail trades. Ty.
All right, Seema, can a boom or can a bust? Hot stocks higher today, but still off their highs after a recent sell-off. We'll talk to a top analyst when Power Lunch returns.
And now, the
Virgin Mary? No.
Vogue.
Madonna.
Divided by distance, united by business.
This is the new reality we're all in.
Helping you navigate the new normal. Squawk Box on CNBC.
I'm not quite sure at this stage. I mean, we certainly want to get back to a 70% payout ratio as quickly as we can, but we just do want to be have confidence in see more stability and confidence in our future revenue before we do that. So I think going to 60% now is a good sign that we have a good level of confidence. We'd like there to be a bit more. So it may be the full year, but it could be later than that too, just depending on how this half pans out.
Well, let's check out Bitcoin today. A new all-time high, slightly above 55,000 at one point, up another $2,700 or so. Just to imagine that. All right, we're going to take a quick break. Then we're going to check in on pot stocks. Their red-hot rally has cooled a little bit. Can you bet on it to resume? We will be right back.
The declarations that I made yesterday, one in which of equality. We will get to 50-50 gender equality by 2022. We created a breakthrough program, benefits program for parental leave, with 8 weeks for all, mothers, fathers, and an additional 6 weeks for both mothers.
We're ushering in the year of the ox. After an unprecedented year of turmoil, we'll look at what's ahead.
The U.S. is in recovery. The rest of the world is starting to catch up.
As China marks a major milestone.
The CCP goes into its 100th anniversary feeling very confident.
And will travel finally get back to normal?
In a normal year, you will see hundreds of millions, maybe 200 million people out there on the move. But this year, probably only at 50%.
All that and more in our special year of the ox, Plowing On.
Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
Marijuana stocks have soared so far this year as the U.S. and other countries around the world all seem to be moving to broader acceptance. Look at Tilray, for example, up 250% this year. But the stocks have cooled off. Sticking with Tilray, the stock hit a high of $67 last week and is less than half of that right now. So with these stocks off their highs, is now a time to buy. I'm joined by Cowen Managing Director Vivian Nazer. Vivian, it's good to have you on. Here's what I want to understand. Why are the Canadian cannabis stocks up so much more than the U.S. ones when the positive developments on regulation has been here, not in Canada?
You said it so well. I think it's really a function of liquidity and access to the investment. The U.S. operators trade on junior exchanges in Canada, which makes it harder for retail investors.
Democrats in control of the Senate. There's this hope that that will lead to full legalization. When do you see that happening? Is there a timeline in place?
We're not looking for full legalization, though we are looking for incremental progress under the 117th Congress. What we're looking for is a modified version of a piece of legislation that was proposed last term called the States Act, which really just kind of pushes down rulemaking to the states. That would have material implications, though, for the U.S. publicly listed operators. We think it would change the tax code in a very beneficial way by eliminating 280E. We think it would provide access to commercial banking and insurance, and we do think it would allow for relisting onto the U.S. exchanges.
That's interesting because without full federal legalization, the financing tools for these companies are really limited, right? They have to go to the debt market. Curaleaf had a debt facility just yesterday, a yield of 19%. We've also seen more SPACs in the marijuana space. Do you see that continuing?
I mean, the cost of capital does remain high, which is one of the key benefits to the operators for the safe banking component of the States Act. I'd also, remind your viewers that there is a separate piece of legislation, the Safe Banking Act, that did pass the House a couple of times last year, though we would hope to see bigger progress in the 117th Congress.
You've seen an improvement in accounting for these cannabis stocks. I know that was the initial concern when they first came to market. Which one is your top pick here?
Our favorite idea is Green Thumb Industries. They're a U.S. multi-state operator operating in a dozen states with roughly 50 operating dispensaries. They have a best-in-class profit margin, 32% adjusted EBITDA margin last quarter.
And Tilray, we know it was a big conversation topic on Reddit. Seems to have cooled off, at least last time I looked at Wall Street Bets. But how big of a role is that playing in the stock?
Well, I think, broadly, it's a good opportunity to remind everybody that cannabis investing is not for the faint of heart, and volatility is nothing new in this industry.
It certainly is. And we'll leave the conversation there. Vivian, good to see you. Thanks for joining us today. And Ty, here we are with the market trying to end the week with a new record. And the reopening trade really gaining traction here. Marriott, Carnival, Royal Caribbean, obviously stocks I watch really closely, but all sitting on gains of double digits for this week. Yet, we're not really sure when cruises will restart.
No, the market is hanging in there. There's a little bit of squishiness today, I would say. If people haven't, I recommend you go on our website and read Seema's piece about Marriott and the passing of Arne Sorensen, who both Seema and I agree was one of the really creme de la creme of American executives over the past 20 years, and a hell of a nice guy as well, right, Seema?
Certainly was. Thank you for saying that. My op-ed on CNBC.com. One other thing I wanted to mention, Bitcoin, yes, fresh record high, but did you know it only took 5 days for Bitcoin's market cap to go from 900 billion to 1 trillion. Now today, above 52,000 and a market cap of 1 trillion. You typically think of Apple and Microsoft with those type of big numbers. But now this one cryptocurrency right up there.
All right, have a great weekend, Seema. Stay out of the snow or go in the snow if you like it. Everybody, thanks for watching Power Lunch. Closing bell right now.
Tyler, Seema, thank you very much. Welcome to the Closing Bell, everyone. I'm Wilfred Frost along with Sarah Eisen. Stocks have lost their early gains. For the week, the S&P 500 now down 0.5%. The Nasdaq has lost 1.5% for the week. Let's have a look at what's driving the action. Cyclicals outperforming, industrials, materials, financials in the lead both today and for the week. Deere's up about 10% now. Airlines higher as well. Growth stocks lagging. FANG is lower, although Palantir, chip stocks, Bitcoin all rallying to end the week. And broadly positive news on the vaccine front, both in terms of distribution and efficacy. That, along with Secretary Yellen's constructive comments to Sarah on the need for a big stimulus bill yesterday, keeping equities just about in the green, though not for the S&P 500. In fact, now just dipping into the red, Sarah.
Dow and NASDAQ still green. Let's see what happens over the next hour. Coming up, a CNBC exclusive with the CEO of Coca-Cola, James Quincy, on coming back from the pandemic. Some news today related to its body armor stake and new areas of growth like alcoholic drinks. Plus, another well-known consumer name, the brand new CEO of Clorox, on her company's push to ramp up production of sold-out wipes and disinfectants, and where she sees demand leveling out in 2021 and beyond. Also, Twilio CEO Jeff Lawson, fresh off of his earnings report that sent the stock flying higher. The stock has quadrupled in the last 12 months. It's now a $65 billion software company. That big interview also coming your way. First up, though, let's focus on the stories we are watching today in this final hour of trade. Mike Santoli tracking the market action as always. Meg Terrell following those latest vaccine news developments as we gear up for President Biden to make remarks this hour at Pfizer. Mike, though, let's start with you in the markets. What do you see?
Yeah, Sarah, we've operated in a pretty narrow range here most of the week. You've had a little bit of a downdraft each day. None of them really snowballed into a major pullback, but definitely a prolonged pause, really being driven by what's going on in the bond market. Treasury yields ramping higher is changing the kinds of stocks that are working or not. So the large cap growth stocks still under pressure. Apple, Microsoft, they're really weighing on the S&P, while you see things like banks and cyclicals doing just fine, industrials as well. So you see basically just curling lower from the top of this channel we keep talking about. By the way, today is the one-year anniversary of the pre-COVID peak. So this is essentially, more than a round trip, of course. You are substantially up, something like 15% since that peak, February 19th of 2020. But obviously a pretty dramatic V in the middle there. Take a look here at stocks versus bonds, year-to-date basis. S&P 500 against a proxy for long-term bonds, both corporate and government. The reason I plot this is we are expecting, as we get into month-end next week, perhaps some rebalancing activity. If you are basically in a 60-40 stock bond portfolio, asset allocator pension fund, you're now 63-37 because of the performance relatively of stocks and bonds. So presumably you're going to go out of equities into fixed income. It's not always been the defining factor in the markets, but there is sometimes a headwind when it comes to something like that. Here, on the other hand, it's where you're not seeing any let-up and no rebalancing away. Micro-cap stock volumes. This is micro-cap volumes as a percentage of large-cap Russell 1000 volumes. Really steady for lots of years, and then boom, and then boom. I mean, basically penny stocks, anything that looks tiny, that moves fast. Retail investors are all over it right now. Lutho Group put this together, and it's one of many readings, guys, that we're seeing that shows the retail investor really whipping around a lot of these market indicators and somewhat perhaps changing the interpretation of what they mean over the longer term.
Treasury yields continue to dominate the conversation, Mike, on Wall Street. And we're also seeing a pre-pandemic peak there for the 10-year yield above 130 back to February before the pandemic.
Exactly, late February
of last year. Wall Street feels a little bit mixed, though, Mike, on whether that represents a threat for equities and valuations.
I think everyone assumes there is a level at which it's potentially a threat more broadly. Initially, it seems we have room before we get to that point. Now, why is that? One is last year at 136 or at 1.5 on the 10-year, nobody was saying that the level of interest rates was a challenge for the overall stock market if the economy was going to be going in the right direction. You are seeing it, though, in the large cap growth stocks, in those stocks that are real proxies for, multi-decade cash flows that really did have full valuations based on low fixed income yields and also negative real yields. Well, those yields are less negative than they were. That was the catalyst for that little correction we had back in September, which was 10% in 2 weeks, mostly driven by those over-owned big growth stocks. So those are I think the back and forth that you have to track right now. But the absolute level of yields probably not yet a big threat.
Mike, thanks so much for that. S&P just lower, Dow, Dow and NASDAQ just higher. President Biden expected to make remarks this hour after touring a Pfizer manufacturing site. Let's get to Meg Terrell for all the latest. Hey, Meg.
Hey, well, while just getting a tour, the president with the CEO of Pfizer, Albert Bourla, this plant in Kalamazoo, Michigan, is where the Pfizer vaccine gets finished, the finishing steps in terms of formulation and getting put into vials. And it is from there that they ship this vaccine all across the country. This is Pfizer's largest manufacturing plant. You can see there the president, and that was Albert Bourla. You can see him there in the background wearing a mask there talking with somebody. Getting a question after we've been seeing these data coming out of Israel about whether Pfizer's pursuing just one dose of the vaccine. It doesn't sound like that is something they are doing right now, but of course that is a big focus as we are worried about these variants that are circulating. So we are waiting to hear President Biden speak. You also see Governor Gretchen Whitmer there as well. And guys, this is on top of a lot of vaccine news coming out today. Pfizer and BioNTech have asked the FDA to allow them to store the vaccine for 2 weeks at regular freezer temperatures. They have submitted stability data showing it can be stored that way, which would make it a lot easier for distribution. And then Novavax, you can see the stock up there more than 5% after they reached an agreement to supply more than 1 billion doses of its vaccine once it gets regulatory clearance to the COVAX facility, which is this World Health Organization facility to provide vaccine around the world, guys. So lots of vaccine news, and we're waiting to hear more of those remarks. And of course, we'll update you on any news. Back over to you.
Meg, thanks so much for keeping us posted, as always. Up next, an exclusive interview with the CEO of Clorox, Linda Rendell, on the newfound demand for our company's products, restocking the shelves, and where growth goes from here. You're watching Closing Bell on CNBC.
I'm Jemana Versace, and these are the stories you should be checking out on CNBC.com. President Biden's return to the Iran nuclear deal is looking uncertain as the two countries remain in standoff over a lack of progress. Biden's team wants to see changes before it lifts the sanctions, but Iran wants Washington to make the first move. That story's on the website now. U.S. Treasury Secretary Janet Yellen has urged lawmakers to pass President Biden's $1.9 trillion stimulus package, telling CNBC in an exclusive interview it's the only remedy for the worst setback in decades. Head online for the full story. And is there life on Mars? NASA begins a new chapter of space exploration by successfully landing its Perseverance rover on the surface of the red planet. The six-wheeled robot will be looking for evidence of past life. Check out that and more on CNBC.com. And remember, you can follow us on Twitter at CNBCI.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Daybreak in the U.S.
Frayed nerves all around. Tech stocks down again today.
Start on top of the news. Brian Sullivan, Worldwide Exchange on CNBC.
Dow's up about 30 points. Clorox out with a bullish outlook yesterday, announcing that it raised its sales growth rate to 3 to 5% from 2 to 4% previously. The company also plans to boost production of its disinfecting wipes and sprays as Clorox continues to try to meet demand. Clorox CEO Linda Rendell joins us now for an exclusive interview. Linda, great to have you on Closing Bell. Welcome.
Great to be here, Sarah. Thank you.
I wanted to start with that updated and increased sales forecast. Is that an acknowledgement that these pandemic habits that we've adopted as far as hygiene are here to stay?
That's exactly what we believe, Sarah. I think first it's really related, one, to our strategy and the strong progress we've made on that over the last 18 months. But two, it is the change in consumer habits that we're seeing around cleaning and disinfecting. And that's true here in the US, but really around the world. People are adopting cleaning as more of a thing around safety and wellness, not just a chore.
Are the wipes available on store shelves yet? There was a time where you couldn't get your hands on one.
Yes, they have certainly been the hot item, and we've made really good progress in increasing our capacity. So last quarter, we made about 1 million canisters of wipes, and we're getting them to stores every single day. This quarter, we're up to 1.5 million canisters per day, and we're going to continue to expand that as we bring new capacity online through the next few months.
Linda, Clorox as a brand name is synonymous with wipes here in the US, has been for a while, certainly over the last year or so. Is that the same situation around the rest of the world? Are there markets you still have a big opportunity to expand into where you don't have a big position yet?
That's exactly right. You know, Clorox is known in the U.S. for a lot of things. Wipes is definitely one of them, but our heritage is in bleach and other spray cleaners. And that's true around the world, where our heritage is also in bleach and spray cleaners. But we're seeing consumers looking for easier solutions to clean. And so as we've introduced wipes into new countries, there's been strong adoption of them, and we see a long runway of growth ahead of us in that area.
I guess my question is on that long runway, Linda, because no question about it, now people want that. They want the big brands, and they want the Clorox bleach and wipes. But before the pandemic, it was all about cleaner ingredients, 7th generation, Mrs. Meyer's, no chemicals, free of phthalates. You think we're going to get back to that place? And if so, what do you do about it?
Yeah, Sarah, we definitely see consumers looking for more transparency in ingredients, and that's why we've led the industry on being transparent around what's in our products. And of course, consumer safety is also always the first thing that we focus on. And we've seen strong growth across our cleaners in wipes and bleach and sprays for all of these years, where consumers have been looking at transparency being important. So we're going to continue that focus to give consumers the information they need. And we're also looking at ways to make our products more sustainable over time. For example, our Clorox wipes, we launched a compostable wipe earlier this year, but we had to stop production of it given the pandemic. We just had to focus on SKUs that we could run faster. But we're going to bring those compostable wipes back, and we expect it to be a large portion of our portfolio as we move forward.
Will, Linda, despite your kind of optimism for long-run growth, will 2020 prove to be a banner year that's very hard to repeat? I mean, comps this year are going to be pretty tricky at times.
We've certainly had a strong 2020. If you look at just our first half, very strong double-digit sales growth across our portfolio, and the majority of our businesses had double-digit growth. We are absolutely heading into a period where we're lapping that growth, but we were able to revise our sales outlook upward for the back half of the year because we're continuing to see that strong consumption. So I do think, you know, if you want to compare periods, it's good to look at a clean period. If you compare the back half of our fiscal year 21 to the back half of our fiscal year 19, for example, we're still up strong double digits, even though we have that lap.
Linda, finally, this is your first appearance as CEO on the show. A leadership question for you. First of all, it's about time this industry promoted a woman to lead the company, given who the consumer is. You're coming in at a time of banner sales. How does the company change under your leadership, given your sensibilities and the fact that you are a younger woman, which is who this company needs to cater to?
Well, thanks, Sarah. You know, what we're focused on is taking the core of who we are, and that's a company that values, above all else, doing the right thing. And that's something that's core to me and every single Clorox employee, and we're leaning into that. But we want to play more offense, and what we've said is playing 100% offense under our leadership. We have terrific brands. We get to serve so many people around the world, and we can do that more and better. And that's really what my leadership is focused on, is keeping us on the offense.
Linda Rendell, thanks for joining us.
Thanks so much.
We've got 45 minutes left in the session. We've got the S&P just lower down, NASDAQ just higher. Check out, by the way, some of today's top search tickers on CNBC.com. Palantir, again, at the top. Huge interest in that name. 10-year, of course, which is surging higher this session, and this week up to 135 comes second. More on the rise in yields to come later in the show.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO.
The initial conservative is going to take around 15 months for Indonesia, but the president really asking us to accelerate within 12 months.
The target is to vaccinate 80% of our population to achieve the herd immunity.
So by the end of this year, 40 or 50% will be covered by the vaccine.
Why only 55%? Because that doesn't sound like herd immunity.
We have around 40 million who are below 18. Medical authorities do not recommend them to be vaccinated.
We hope to get most of our people vaccinated by the third or the fourth quarter of this year. If we get the vaccines faster, we'll be able to roll out the program faster.
The vaccine, I think, is a turning point, but don't underestimate testing. I think if we can get testing to 45 seconds, 30 seconds, that will also be a groundbreaker.
On the next Managing Asia, the man running Singapore's largest supermarket chain, FairPrice Group.
Before those gone orange, we could already see, the build-up of crowd at our stores. They were buying like there's no tomorrow. We are managing stockpile, covering a few key categories. We have had to review and rethink many of our strategies.
Sia Kian Peng, CEO of FairPrice Group, on the next Managing Asia.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Where big tech
is likely to be the largest IPO ever.
Meets the street.
How do you look at valuations overall right now?
Carl Quintanilla, John Fort. Squawk Alley on CNBC.
Very low for over a decade. And, it's a risk, but it's a risk that the Federal Reserve and others have tools to address. The greater risk is of scarring of people, having this pandemic take a permanent, lifelong toll on their lives and livelihoods.
That was Treasury Secretary Janet Yellen yesterday supporting President Joe Biden's $1.9 trillion stimulus package, as she believes its benefit to Americans outweighs the risk of inflation. Joining us now, Goldman Sachs Investment Grade Syndicate Head Johnny Fine. Johnny, good to see you. Thanks for joining us. First question is a broad one on just the rates outlook, which have clearly spiked today and this week. Is the pace getting a little bit out of hand now?
I don't think the pace is getting out of hand. I think when you look at where we've come since the beginning of the year, we're maybe 35 basis points higher in yield on the 10-year note. You think about that in context, that's roughly a basis point per day. And the vast majority of this move has been very orderly. I think it's very natural when you think about the economic data that we're seeing, the prints that we saw on Wednesday, both in retail sales as well as in PPI. I think it's natural that we'll see a gradual uptick in yields across the curve. I don't expect them to get that much higher than where they are right now, but I certainly don't see this as being a danger sign for valuations in credit markets.
And what about credit spreads? Are they rising in tandem in an also fairly relaxed way?
Actually, no, they're not rising. If anything, they're performing even more strongly. There's a pretty weak relationship between credit spreads and term interest rates over time. Where we stand right now in terms of investment-grade credit spreads is that we're within touching distance of the tightest spreads that we've seen since the global financial crisis, significantly tighter than they were pre-pandemic and back to really the levels that we saw at the beginning of 2018. So credit in no way, shape or form is concerned by the movement higher that we've seen in yields.
What about what Secretary Yellen said there about inflation? Johnny, where's the bond market broadly on how big of a risk that is and whether the downside risk to the economy, as she painted the picture, outweigh the potential negative risks of rising sustained inflation?
Well, I couldn't agree with Secretary Yellen more. And by the way, that was a fantastic interview yesterday, Sarah. Well done. I think she really hit the nail on the head. Central banks around the world have been overly fearful of inflation for as long as I can remember. I think the move last fall from the current Fed administration to go to average inflation targeting as opposed to a static 2% target is in some ways a tacit admission that monetary policy had been too tight coming out of the global financial crisis because of those inflationary fears. Those fears aren't there, and they shouldn't be there, I think, for good reason. So yes, we will see a move higher, probably above 2% over the course of the next several months. Part of that will be the base effect from the low levels of inflation we saw entering the pandemic last year. But it's certainly not a concern, and I entirely agree that the stimulus package that's needed in the weaker sectors of the economy, it's a small price to pay if we see a further, call it 25 basis point move higher in yields across the Treasury curve. I think it's a very small price to pay when we have more than 3 million people fewer working today than we did pre-pandemic.
Johnny, clearly you guys had very strong volumes last year, as did many of your rivals. A new theme I know you're keen to talk about in terms of ESG bonds. Can that pick up the slack if overall otherwise volumes in macro terms or cyclical terms were dropping off?
Well, I don't think we're going to see the volumes repeated of 2020. I think there were unique conditions that led to the corporate financing bonanza last year that won't be repeated again. But there are signs that we're going to be running at a healthy clip this year. We're already running at a higher pace than we were in 2018 and in 2019. We're about to hit, I think, a record month of issuance for the month of February. And you're right, ESG financings are becoming a more important component of our fabric overall. In 2015, for example, there was $10 billion of ESG-related financings. In 2020, there was $75 billion in the US market of ESG-linked financings. We're already running at a pace year to date that's 4 times higher than we ran a year ago. Do I think it can pick up the full slack of where we were in 2020? No, I don't think so. But do I think it can be a much more meaningful part of our issuance fabric? Absolutely, 100%.
What do you think, Johnny, about everything else that's rising along with bond yields right now? Bitcoin and the cryptocurrencies, stocks which continue to power to new highs. Do you see correlations there? Do you see fundamental cases?
So I think what we're seeing is a fundamental bid for all risky assets in a very correlated manner. It's a function of the monetary easing that we continue to see, the crowding out effect as the Fed continues to buy Treasury bonds. That's ultimately finding its way into credit, investment grade, high yield. It's clearly finding its way into equities as well. Stimulus is aiding that. And then, of course, all other assets are benefiting from what's expected to be a sharp economic recovery over the course of 2021. That's why you have the spike higher in commodities that we've been seeing over the course of this year. Bitcoin benefiting from a whole bunch of different currents and trends that we're seeing in the investing market. And so we have a very highly correlated risk market right now. I don't think that's going to remain the same over the course of 21, i.e. I think we'll start to see some differentiation.
We're going to have to leave it there. Thank you so much for joining us. Much appreciated, as always. Great backdrop as well. Let's now listen in to President Biden, who's following Pfizer's CEO, who just made remarks. Podium being disinfected there for President Biden, who now begins his address.
Thank you not only for what you do for the credit you've given me that I really don't deserve. This is a case of life and death. We're talking about people's lives. I want you to know that once we beat COVID, we're going to do everything we can to end cancer as we know it. I've asked Dr. Eric Lander, a renowned Harvard MIT scientist, to co-lead the Presidential Council of Advisors in Science and Technology and the Office of Science and Technology Policy. These are White House offices that bring together the country's top scientists and address our most pressing needs. They'll be part of the administration's work to develop a DARPA-like advanced research effort on cancer and other diseases, just like there is DARPA in the Defense Department that develops the breakthroughs to protect our country. This administration is going to be guided by science to save lives and to make lives better. That's why I wanted to come here, Albert, to thank you, to thank all the workers here in Kalamazoo. And I'm here to thank my good friend, Governor Whitmer, and she has become a good and close friend. The governor's been on the front lines of this pandemic as well for a long time, and I think she's doing an incredible job in very difficult circumstances. And Michigan is also fortunate to have my buddy Gary Peters as United States Senator and Debbie Stabenow. Gary is here. Gary has been a workhorse in making sure that we move through this funding to get things done, because he understands better than anyone. It's about urgency, the urgency of the moment. So Gary, thank you, Senator. Thank you for all you're doing. Last week, I toured the Vaccine Research Center at the National Institute of Health in Bethesda, Maryland. I met world-class doctors, scientists, and researchers who were critical for discovering the vaccines in record time. I remember when we first started talking about this, asking Dr. Fauci and others, said, well, it could take up to several years, maybe as many as 6 or 8 years, to find a vaccine. It's a miracle of science and the brilliant minds that we have around us. And now it's a second miracle, the miracle of manufacturing to produce hundreds of millions of doses. Let me say it again, hundreds of millions of doses. I came here because I want the American people to understand the extraordinary work that's being done to undertake the most difficult operational challenges this nation has ever faced. And let me say parenthetically that it's not enough that we find cures for Americans. There needs to be cures that the world is able to take part of, because you can't build a wall or a fence high enough to keep a pandemic out. On our tour, I met a few of your nearly 3,000 workers, Albert. Experts managing ingredients that come in from different cities and states. Experts handling 3D modeling and artificial intelligence to ensure that every dose is properly crafted. Experts ensuring sterile environments so that each vial, each and every one, is safe and free of contaminants. All of this is followed by extensive safety and quality control inspection, then careful packaging and labeling. We walk by a freezer farm that then keeps those doses viable so they can be shipped. This is an incredibly complex process. And at every stop, safety is the utmost priority. The whole process takes teamwork, precision, and round-the-clock focus. Machinists operating some of the most advanced equipment in the world, working side by side with chemists, biologists, pioneering technologies that less than a year ago were little more than theories and aspirations. And it takes a partnership, in our view, between the federal government and all the companies and universities contributing to the vaccine effort. Just over 4 weeks ago, America had no real plan to vaccinate most of the country. My predecessor, as my mother would say, God love them, failed to order enough vaccines, failed to mobilize the effort to administer the shots, failed to set up vaccine centers. That changed the moment we took office. I directed Jeff Science, my COVID-19 response coordinator, to lead my administration's work with the vaccine manufacturers to buy more vaccines and to speed up delivery. Albert referenced it earlier, and I want to thank him for making it happen. Because we worked together, we're now on track to have enough vaccine supply for all Americans by the end of July. That doesn't mean it'll be in all Americans' arms, but enough vaccine will be available by that time. These orders allow facilities like this one to plan ahead, accelerate their production schedules. Here's what else we did. When we discovered that vaccine manufacturers weren't being prioritized when it came to scrutinizing and securing supplies they needed, we fixed that problem and got them what they needed. We also used the Defense Production Act to speed up the supply chain for key equipment, like fill pumps and filters, which has already helped increase vaccine production. In fact, on our tour today, they showed me a critical piece of machinery they didn't have before. Now they do, and it's allowing them to ramp up production. And as we increase supply, we're carrying out a clear plan to get shots into the arms of 300 million Americans or more. And I know people want confidence that it's safe. Well, I just toured, and it's where it's being made. It takes more time to do the check for safety than it does actually to make the vaccine. That's how fastidious they are. And listen to Dr. Fauci. Dr. Fauci assured me that COVID-19 vaccines were safe. That's why several weeks ago I went through the rigorous scientific review. That's why I took my vaccine shot publicly, to demonstrate to the American people that I know and believe it's safe. That's why Vice President Harris also received her shot publicly. We all know there's some history, there's some hesitancy about taking this vaccine. We all know there's history in this country of having subjected certain communities to terrible medical abuses in the past. But if there's one message to cut through to everyone in this country, it's this: the vaccines are safe. Please, for yourself, your family, your community, this country, take the vaccine when it's your turn and available. That's how to beat this pandemic. And we're making progress. We deployed more vaccinators, the people to put the vaccine in your arm. We're now making it possible for retired doctors and nurses to come back and under law administer these shots. We've put new vaccinators in the field. These include over 800 medical personnel from our commissioned corps at the Department of Health and Human Services, and personnel from the Federal Emergency Management Agency, FEMA, Defense Department, National Guard. We're literally lining up thousands of vaccinators, because it's one thing to have the vaccine, it's very different to get it in someone's arms. We're also creating more places for people to get vaccinated. We've provided $3 billion to states, territories, and tribes to create hundreds of new vaccination centers to ramp up the existing ones that are there. Right here in Michigan, with Governor Whitmer, FEMA has provided tens of millions of dollars to bolster the state's community vaccination centers. From the National Guard at the Expo Center here in Kalamazoo, to the TCF Center in Detroit, to parking lots and churches across the state. We've worked with governors in California, Texas, New York, and more to come to stand up mass vaccine sites and stadiums that will be open 24/7 in arenas and community centers. It's an effort that's on top of the federal government covering the full cost for the state's use of their National Guards for pandemic efforts. And you suggested I do that a while ago, and I promised you I'd do it, and we did it. We also started shipping vaccines directly to thousands of local pharmacies across the country, so eligible folks can get the COVID-19 shot like they would a flu shot. Here in Michigan, that's already more than 220 pharmacies, like Rite Aid and Myers, in more than 130 cities in Michigan. And that's just the beginning. It's only been 4 weeks. And for folks who aren't near a pharmacy or mass vaccination centers, we're deploying mobile clinics. These are special vehicles and pop-up clinics that meet folks where they live, folks who don't have access to transportation to get the shots. We're also supplying vaccines to community health centers, federal community health centers, to reach those who are hit the hardest: Black, Latinos, Native Americans, and rural communities, which have higher rates of COVID infections and deaths than any other group. Here in Michigan, we're already partnering with community health centers, serving more than 370,000 patients in 11 cities across the state. That's because you guys have pointed out where they were, why it was so important, and how we'd get to, as Gary talks about, get to the people most in need and the people most dying from COVID. This is important to ensure everyone is treated equally and those hardest hit get the care they deserve. We're now at a point where we've seen the average daily number of people vaccinated nearly double from the week before I took office to about 1.7 million average per day getting a shot. We're on track to surpass my commitment. You may remember when I said in my first 100 days just before I was inaugurated, it seemed like 100 days, but anyway, first 100 days before I was inaugurated, that we'd administer 100 million shots in my first 100 days. But we're on the path to do that. We're averaging 1.7 million a day. Soon we'll be at 50 million, and I'm confident we'll exceed the number. But that's just the floor. We have to keep going. But despite the progress, we're still in the teeth of a pandemic. New strains are emerging. In a few days, we'll cross 500,000 Americans who will have died from COVID-19. 500,000. That is almost 70,000 more than all the Americans who died in World War II over a 4-year period. All the sorrow, all the heartache, all the pain. And while we wait for everyone to get vaccinated, we still need you to wash your hands, stay socially distanced, and mask up to help save lives. That's why, with the authority I have as president, I signed an executive order, the only authority I have to require this, to require masking on all federal property, all modes of travel like planes, trains, and buses. We've been calling on governors and mayors and local officials, Republicans and Democrats, to institute mask mandates within their jurisdictions, just like Governor Whitmer has done here in Michigan. Look, I know it's inconvenient, but you're making a difference when you do it. Everything we do matters. We need everyone to do their part for themselves, for their loved ones, and yes, for your country. It's a patriotic duty. We need Congress to pass my American Rescue Plan that deals with the immediate crisis, the urgency. Now, critics say my plan is too big, that it costs $1.9 trillion. So that's too much. Well, let me ask them, what would they have me cut? What would they have me leave out? Should we not invest $20 billion to vaccinate the nation? Should we not invest $290 million to extend unemployment insurance for the 11 million Americans who are unemployed so they can get by while they get back to work? Should we not invest $50 billion to help small businesses stay open when tens of thousands have had to close permanently? Should we not invest, and by the way, they make up half the employment in America. Should we not invest $130 million to help schools across the nation open safely? Right now, 24 million adults, 11 million children don't have enough food to eat. And lest you think I'm exaggerating, think of those scenes you've seen on the television with cars lined up which seemed like miles to wait to have someone put a box of food in their trunk. People who never, ever, 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 ever thought they would need help. And through no fault of their own, they're in that circumstance. If we don't pass the American Rescue Plan, 40 million Americans will lose nutritional assistance through a program we call SNAP, the old food stamp program. Do we not invest $3 billion to keep families from going hungry? 1 in 5 Americans are behind in their rent. 1 in 10 are behind in their mortgages. How many people do you know that will go to bed tonight staring into the ceiling and say, God, what is going to happen if I don't get my job, if I don't have my unemployment check? What's happened to me? I'm losing my health insurance. What do I do? This is the United States of America, for God's sake. We invest in people who are in need. Do we not invest $35 billion to help people keep a roof over their heads? I could go on, but you get the point. I'm grateful that the Senate and the House are moving quickly. And I'm prepared to hear their ideas how to make the package better and make it cheaper. I'm open to that. But we have to make clear who is helped and who is hurt. And my hope is that the Republicans in Congress listen to their constituents. According to the polls, there is overwhelming bipartisan support. The vast majority of the American people, more than 70% of the American people, with all the polls you all conduct, including the majority of Republicans, want us to act and act big and quickly and support the plan. Major economists, left, right, and center, say we should focus on smart investments we can make now in jobs and our people to prevent long-term economic damage to our nation and to strengthen the economic competitiveness going forward. In fact, an analysis by the Wall Street firm Moody's estimates that if we pass my American Rescue Plan, the economy will create 7 million jobs this year. This year. We've also been in constant contact with mayors and governors, county officials, members of Congress, both parties. Both parties. I've met with them in my office. I've met with them on the internet, on Zooming on with them. Both parties in every state. And guess what? They agree we have to act now. I got a letter from more than 400 mayors from big cities and small towns. They understand we're not going to get our economy back in shape and the millions of people back to work until we beat this virus. That's why the American Rescue Plan puts $160 billion into more testing and tracing, manufacturing and distribution, and setting up vaccination sites. Everything is needed to get vaccines into people's arms, which is the most difficult logistical effort the United States has undertaken in peacetime. It includes $4 billion for new manufacturing plants. So we're ready to manufacture vaccines in the future. We don't have to wait. I'm going to close with what I said before. I'll always be straight with you. I said in my inaugural, I'll give it to you straight from the shoulder, as Roosevelt said. Because the American people can take the truth. They can handle anything. I can't give you a date when this crisis will end. But I can tell you we're doing everything possible to have that day come sooner rather than later. And all of you here are doing some of the most important work in this facility right here that can be done. And I know this is personal. I walked in today, and I won't say who came up to me, but one of the people in this building came up to me and said, my father-in-law is dying from COVID. I said, can I call him? He said, no, he couldn't take a call. He's just keeping his prayers, please. How many of you know somebody who's in real trouble or has passed? How many people do you know who sat down to breakfast this morning and looked at an empty chair across the table? You've seen the devastation of this virus in your family, your community, but you're stepping up. You're saving lives here, lives of your loved ones, your neighbors, your fellow Americans. You're showing how this town, this state, this country takes care of our own, leaves nobody behind. We can do anything when we do it together. I believe we're on the road, I promise you. I know we'll run into bumps. It's not going to be easy here to the end. But we're going to beat this. We're going to beat this. May God bless you all, and may God protect our troops. Albert, thank you and your people for all you do. Thank you.
President Biden there at a Pfizer manufacturing plant for vaccines in Michigan, making a forceful case for his stimulus plan. Does say, though, he's open to talking about making it cheaper and hearing ideas. Also appealing to Americans to take the vaccine, saying it is safe. He has seen that firsthand. They spend a lot of time.
Is not the same as putting it in someone's arms.
This is going to be
a continuous rolling
We'll continue
effort.
to monitor it for you, let you know if he makes any other headlines. In the meantime, we've got Dr. Scott Gottlieb here. He's former FDA commissioner and also sits on the board of Pfizer, the company where President Biden is speaking, and Illumina, also a CNBC contributor. Great to have you, Dr. Gottlieb. It seems like the biggest headlines on vaccines out of this event is actually what Pfizer said, which is they're doubling the output, and they're set to provide 120 million vaccines by the end of March, 200 million by the end of May. So then why are the timelines from Dr. Fauci and others getting pushed back into late summer for majority of Americans to be vaccinated?
Yeah, I still believe that we're going to have general availability of vaccines come April, and it's going to be a combination of rising supply and also, the demand we're going to find once we vaccinate 100 million Americans, I think that the demand isn't going to be as brisk. That doesn't mean we'll get above 100 million Americans. We will get well above 100 million Americans. But, the incremental 25 to 50 million Americans is going to take some work to get them vaccinated. I think that there's really intense demand where people are willing to go online right now and line up and wait and hit websites over and over again among maybe 75 to 100 million Americans at the high end. And we'll have worked that off by the end of March for sure. I mean, there will be about maybe 250.
Had the supplies, machinery they needed in order to hit the targets and then the impressive numbers that the Pfizer CEO outlined in terms of producing the vaccine. Is it fair for the president to take credit for some of those milestones being hit, or was this sort of already in process and more down to the company and the steps taken over the last year as opposed to the last month?
Well, look, there's a lot that's been in process, but there's no question that the Biden administration took some steps to help accelerate access to some of the equipment and materials needed to boost production. I'll let Pfizer talk about the specifics about what the administration did, but I know that they've been helpful, so I think it's fair for the administration and the president to take some credit here for helping to support the manufacturing.
Dr. Gottlieb, thanks for joining us. Sorry, so brief today.
Thanks a lot.
Straight ahead, Wall Street zeroes in on Palantir and winter weather wreaks havoc on the chip industry. Those stories and many more when we take you inside the market zone. That's next.
Most countries will experience recessionary-like conditions. Is it necessary for another 1.9 trillion to be directed at the economy?
We do need some more fiscal stimulus to continue to bridge the gap, to continue to allow us to move through this tunnel and get to the other side.
It is still about crossing that bridge to the recovery, but where the journey seems to be a little bit delayed, but should not be derailed.
We want to exceed the next generation, which we are seeing, and I think those will be flowing quickly around the world.
The challenge will be not a global distribution. The challenge always is finally the last mile.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
The first 100 days may be an effective political campaign slogan, but is it a benchmark that matters? Political analysts argue that the first 100 days is still a presidential honeymoon, during which they wield extra influence. According to data from the second half of the 20th century, US presidents fared better with Congress earlier rather than later in their inaugural year. With the exception of Lyndon Johnson and George H.W. Bush, bills that were supported by presidents passed more often than those considered later in their tenure. The percentage of votes from Congress in favour of the president's position on bills, motions and amendments during that time were on average significantly higher in the first 100 days than the rest of the year. One reason for this, according to political analysts, is that US presidents tend to be strategic in their support for bills likely to pass Congress, partly accounting for the perception of early-term success.
left in the trading day. We are now in the closing bell market zone. Commercial-free coverage of all the action going into the close. CNBC senior markets commentator Mike Santoli is here to break down these crucial moments of the trading day. We've also got Eugene Profit from Profit Investments here as well. Mike, we'll kick it off with the broader market. The major averages are sort of mixed off their highs earlier as we head into the close. The S&P is down fractionally, with the S&P and NASDAQ set to post their first weekly loss in 3 weeks. Like the NASDAQ weakness, it's being dragged down by names like Apple and Facebook and Microsoft. Are investors rethinking their positions in these big cap tech names as yields march higher?
That seems to be what's going on. Yeah, even, Amazon, which had gone sideways, people thought it was about to break out, had an outperformance yesterday. It's down a couple % today. So it does seem to me mostly about portfolio repositioning, reevaluating the valuation. Of the big growth stocks in light of higher nominal and real yields. Again, that's not some kind of fixed eternal relationship, but that has been one of the premises for why people were crowding into some of
small cap stocks are performing better. Large cap tech hasn't performed as well, but inside large cap tech, some of the names that weren't as light going into the market that are still good companies have performed very well, during this period, like Intel. If you look today, Intel's up. It's up 27% year to date, coming off a earnings. It bodes well for semiconductor stocks, but then AMD and NVIDIA, which a lot of investors like more, aren't performing.
Take most markets.
Palantir has also become a darling of Reddit's Wall Street Bets forum. Kate Rooney's got more on that angle.
Hey, Wilf, Palantir is the talk of stock trading forums on Reddit today. It's the most
genuine active management versus only a few stocks left that they can really move money into and out of in a serious way, given the enormous amount of inflows they've received.
Well, there's absolutely a self-fulfilling aspect to it. Her funds, the ARK funds, keep getting tremendous inflows. They publish their buys. They're it's sort of a semi-transparent portfolio. So it's unusual in the sense that in almost real time, you get to know what the incremental buys and sells are from that portfolio. And you kind of have confidence there's going to be money coming behind it in terms of tonight's flows. So for a while, I do think that that can work. It's also a style of investing that is completely in favor right now. This whole idea of long-term disruptive technologies, very expensive stocks on today's numbers, but maybe they're going after huge markets. It's just perfectly in tune with everything. And, you know, it doesn't necessarily always last in that mode, but it's fascinating with something like Palantir. It's 35% or something off its high. It's still up huge today, and because all the value is so far out in the future, you can have a huge argument about it today and be both right and wrong in the same week. So that's how it goes.
Eugene, I'm curious for your quick take here. Should be classified as employees, not independent contractors. Kate Rogers with those details. Kate.
Hey, Sarah, a big loss for Uber here as judges voted unanimously to dismiss the company's appeal against that ruling. This caps a 5-year legal battle between Uber and a group of former drivers who said they are workers and they have the right to things like holiday pay, breaks, and minimum wage. Keeping the workers as gig employees benefits Uber as it's more flexible, of course, and cost-effective. The news could have major ripple effects for Uber's UK business and the gig economy at large, although Uber says the decision only applies to the 25 or so drivers who brought the case against the company back in 2016. There are other companies that stand to be impacted and about 1,000 other similar legal cases against Uber in the UK.
Mega cap growth, that's where the pain has been this week. It's the FANG type stocks. They're declining, and then something like the transports or industrials have been well outperforming. So again, cyclical tone has taken hold here. The volatility index, it did, retrace from a recent pop earlier in the week, but still about 21, 22. This is where the zone it's played in. You could argue it represents a little bit of a wall of worry as people are hedging, or just sort of the kind of aftershock, distant aftershock of some of the recent correction fears, guys.
Mike, thanks for that. Just over 1 minute left, and all three of the major averages are lower on the session as we approach the close, albeit by just 1 basis point on the Dow, 0.2% on the S&P, and about half of 1% on the NASDAQ 100. Excuse me, the NASDAQ composite is still higher by 4 basis points. Materials, industrials, energy, banks, the best performing today, pretty much the best performing on the week.
And that'll make it 4 down days in a row for the S&P. Welcome back, everyone, to Closing Bell. I'm Sarah Eisen, along with Wilfred Frost and Mike Santoli, CNBC senior markets commentator. Take a look at how we finished up the day and the week on Wall Street. The Dow closed higher just barely. It did reach an intraday record high earlier this morning around 11:30 a.m. and then lost some steam lower on the week. S&P 500 closing down 0.2%, 4 down days, which is the longest losing streak we have seen so far this year. On the week, we're down about 0.75%, breaking a 3-week win streak. The NASDAQ closing higher just barely. It would have also been down 4 days, but down on the week, 1.65% for its first down week in 3. The Russell 2000 had a great day, best day since February 8th. Small caps gaining more than 2%. Straight ahead on Closing Bell, a first on CNBC. Interview with Twilio CEO on the heels of that company's earnings report that sent the stock soaring. And then later, an exclusive interview.
A window for a pullback. Second half of February, sometimes weak. Today,
down a bit today, but up week to date, and it just never seems to fall below 20 and stay there for a meaningful amount of time.
Yeah, Mike alluded earlier that this is sort of the happy zone for VIX right now. It seems to be where we've stuck ourselves. You know, one of the things to keep in mind is there's a new factor keeping VIX higher, and that's actually all the call speculation that we've seen. And the market's adjusted. Upside calls always kind of depressed VIX a little bit because those tended to have lower implied volatilities than at money or below market volatilities. And now we're seeing a reversal of that. Those are also having higher implied volatilities. You know, the smile, as we say, is getting more symmetrical. And that's putting a lift in VIX. And even stranger is when you look at VIX futures, they're anticipating real volatility out into April, where they're anticipating about a 28. So there's definitely an undercurrent of nervousness in the market that we're seeing through VIX.
So if you look at what's performed well this week, Eugene, and today in particular, the Russell 2000 up more than 2%. For the year, it's up 14.6% compared to the S&P 500, which is up 4%. A lot of that action today was in the financials, a lot of 52-week highs in regional banks. Are you repositioning your portfolio around this rise in rates we are seeing?
Only slightly. I mean, Russell really started back in November and is
exclusive interview with John Williams. He was explicit about his lack of concern for the rise in the 10-year yield, which Wolf was mentioning earlier. Williams said he doesn't believe it's going to act to restrain economic growth in the U.S.
Is the markets, especially the Treasury market, responding to some good news on vaccination and progress there, and maybe reduced downside risks there, and news around additional fiscal support. We're seeing signs of rising inflation expectations back to levels that I think are consistent, closer to consistent with our 2% long-run goal.
The 10-year yield has risen almost 45 basis points since the beginning of the year, a lot of it in the last 9 days. It's come along with the rising inflation expectations. Even some modest betting in Fed funds futures markets on Fed rate hikes later this year. But Williams and other Fed officials are focused on how far the economy has to go to get back what was lost from the pandemic.
Honestly, right now, the economy is still in a very deep hole. Employment is down by roughly 10 million from where it was before the pandemic. Unemployment is still quite high, and employment to population ratios are really quite a bit lower than we would like to see. So I think right now, the economy has quite a ways to go to get back to maximum employment, and we have a ways to go to get back to our 2% inflation target.
Williams joined the chorus of other Fed officials in refusing to say when the Fed might reduce its $120 billion in monthly bond purchase, saying he is in a wait-and-see mode. Sarah?
Steve, when I heard that line, we are in a deep hole, it sounded so familiar to what Secretary Yellen said yesterday when she made a forceful case for more stimulus to fix this economy, even in light of the better economic data like retail sales we've seen. Here's what she said.
Deep hole, and it would be good if we have really strong growth. And I think this package will help ensure this. The Congressional Budget Office projected that without a package like this, it would take until 2024 to get back to full employment. And I think it's, if all goes well with the pandemic, and that's an area of considerable uncertainty, how that will progress. But if all goes well, I think we could be back to full employment next year.
The Fed and the Treasury are really singing the same tune, which is this is an economy that still needs a lot of help and still has a lot of people out of work. And the stimulus is now, it's a powerful combination. You can see why the markets have embraced this idea. They really do sound very similar.
I think you have that right, Sarah, and I think there's similarities on two levels. Let's remember, John Williams is the former president of the San Francisco Fed before he came to New York. Janet Yellen, former president of the San Francisco Fed before she became vice chair when Williams was on the board, and then became chair when Williams was on the same Federal Market Committee. So there's those similarities. The two of them also probably cut from the same cloth economically, believing that forceful Federal Reserve and fiscal action are what's necessary to help economies when aggregate demand is falling below potential. The other similarity, though, I think is this, that right now, when you have situations when the economy is underperforming, the Fed and Treasury policy come together. It's when you have the economy overperforming that you have the politicians at the Treasury and Fed officials, that's when they separate. Right now, it's very similar to the financial crisis in 2009 and 2010 when the policies come together on both sides.
Steve Leisman, thanks so much for that. Steve Sosnick, which way is the dollar going to head from here?
Well, I think right now the path seems to be upward because it will follow the economic growth that seems to be better for the U.S. than other places. And I think it'll follow the interest rates, which follow from the economic growth. And that may be a little bit of a headwind on stocks, particularly because we tend to be led by multinationals that benefit a bit more from a weaker dollar in terms of their exporting ability. But all in all, I think that right now, I think until we get to a point where unless I should say, we get to a point where the Treasury has difficulty funding itself, which I don't see anytime in the immediate future, the dollar is going to have a little bit of support underneath it.
Yeah, and Secretary Yellen addressed that too. No, doesn't see any concerns with financing the debt. Eugene, we'll turn it to you for the last word, if you could, on technology, because we did see the NASDAQ pull back this week, and we saw some of those big beloved names like Apple and Microsoft get hit. Are you trimming positions, or you keep your faith in tech?
Well, I already had. I think that they are expensive from a historical standpoint, but it's just a little bit of a brief pullback. I just think that you can find less expensive securities in other areas of technology, but staying with Microsoft and Apple will reward you very well. And really what's going on, I think anyway, is that as the vaccine is coming online, that's the real driver of the stock market performance this year, right? So I think that's starting to go well. We're concerned about the variance, but as long as that goes well, large cap tech will come back in the focus.
Eugene and Steve, thank you both for joining us. Good to see you.
Thank you.
Shares of Twilio surged after reporting results earlier in the week. Up next, CEO Jeff Lawson will join us to react to the numbers and lay out the company's plans to help in the COVID vaccine efforts. That first on CNBC interview when Closing Bell returns.
Divided by distance, united by business.
This is the new reality we're all in.
Helping you navigate the new normal. Squawk Box on CNBC.
I'm not quite sure at this stage. I mean, we certainly want to get back to a 70% payout ratio as quickly as we can, but we just do want to be have confidence in see more stability and confidence in our future revenue before we do that. So I think going to 60% now is a good sign that we have a good level of confidence. We'd like there to be a bit more. So it may be the full year, but it could be later than that too, just depending on how this half pans out.
It's one of the world's largest accommodation search platforms. Trivago CEO Axel Heffer talks COVID's impact.
It's a very difficult point in time right now. In most countries, there are tight restrictions.
Recovery.
We definitely expect domestic to be the majority of the market. It will take some time to rebuild that confidence in travel overall.
And the future of travel.
We are using structured data to provide you with inspiration of where to travel.
Don't miss the CNBC Conversation.
Shares of Twilio falling today after hitting record highs yesterday. This comes after the cloud communications company upsized its secondary stock offering by 50% for proceeds of $1.5 billion compared to what it announced last night. This all comes as the company posted better than expected quarterly results and a surprise adjusted profit. Joining us now in a First on CNBC interview, Jeff Lawson, Twilio CEO. Jeff, good to see you. Thanks for joining us.
Thank you for having me.
So, I mean, clearly you guys have been on a very strong run. Congratulations for that. I guess my broad first question is how long can the party go on, and to what extent is it at a kind of COVID-related boost to your last couple of quarters versus something that's structural and going to accelerate?
Well, this is a large secular tailwind. The importance of digital and digital customer engagement to every company in this digital economy is something that's gone on for the last decade and is going to go on for a long time. And obviously, if you think about how companies are winning the hearts, minds, and wallets of customers in this digital economy, it's by building better experiences in mobile apps, in websites, and actually engaging with customers across all the touch points they have. And you think about the companies that you do business with, you say, wow, I really like that company. They tend to be the companies who are doing really well at digital execution these days. And those people are our customers. We now have over 220,000 companies in our customer base, and they represent companies in pretty much every vertical sector, continent that you can imagine. Both the digital disruptors as well as the incumbents in every industry are having to embrace digital, and they're our customers.
The customer addition numbers are very impressive, Jeff. To what extent is the size and type of company changing, though? And again, are you adding more, but perhaps lower quality, smaller size at this stage?
Well, actually, I think quite the opposite. We're adding some amazing customers to our roster. If you look at who we were able to talk about in our earnings call this week, we talked about J.P. Morgan Chase adopting Twilio to power part of their customer experience. We talked about H&R Block adopting multiple of Twilio products to build an amazing customer experience for tax filers. And so there's been a growth of the enterprise adoption of Twilio, and we've seen that trend for a while now, and we like to see it continue. I think it was interesting, actually, last quarter, talking about financial services. We see the adoption of Twilio by both digital disruptors and the incumbents in every industry alike. And so we had a Fortune 50 bank that adopted Twilio last quarter, or in the Q3 earnings call, and we also had Robinhood. And so you've got everybody who needs to embrace digital, both the startups as well as the incumbents. And when they do, they're all turning to Twilio, and that's good.
Well, it's good to hear that Robinhood is using you, because it sounds like they could use some good communication with their users. Jeff, I actually had a question about one of the other industries which has been harder hit, travel and leisure. I know the exposure there is not huge for you. It hasn't really been a weight, but you do have a peak. Are you seeing signs of life now that people are getting vaccinated?
Well, obviously, we've seen air travel and hospitality start to pick up. And I think it's a slow path to get back to what it was in the pre-COVID times. But, we are seeing those industries pick up. And what's interesting is even for those affected industries, they have had to really invent their way through this pandemic too. They've had to figure out, how am I going to keep my customers engaged through this pandemic when they're not taking as many flights or maybe any, or not staying in hotels anymore? But how do I actually maintain that loyalty? How do I make customers know that I'm here, that we're safe, and we're ready for their business as soon as they're ready to be our customers again? And so there's been a whole new set of activities that a lot of those hospitality companies have had to do in order to react to the pandemic as well.
What is the $1.5 billion raising for? And separately, how's the segment integration going?
The fundraise is just to have a healthy balance sheet. For a company of our size and our market cap and our growth rate, we wanted to make sure our balance sheet was right-sized. The segment acquisition is going fantastically. First of all, a great team. So the first thing you do when you start integrating is a lot of the cultural things. But as we've started to dig in with those teams, right, you start to see, look, every company out there is trying to grow. And you do that by understanding your customers, who they are, and then engaging with them in a really compelling way. And the way companies do that, especially B2C companies, is by taking the data about their customers that they have based on what you've bought, what you've looked for on the website, what you've used in the mobile app, when you've contacted support. Take all those data points that a company has and use it to forge a better customer experience about you. And that's what Segment does. They help companies take the data that's trapped in all those silos of all those systems that typically is really hard for companies to make sense of. They liberate that data. They let you form a full picture of your customer based on every touch point you have with them, and then using Twilio, engage with those customers in a better and more compelling way. So we're really excited for what the future holds.
I just had a question on the current quarter. It looked like political traffic revenue was a driver of growth, maybe one that people didn't see necessarily coming. What was that? Was that the election? And is that something that's repeatable?
Well, we are used by political campaigns to do things like get out the vote and to mobilize voters as part of the advocacy that goes on as a part of a democracy. We did call it out. It's more of a one-time thing for the election cycle. We saw, I think it was $23 million in the quarter. So we called it out and said, hey, don't expect that to repeat in the next quarter, because that's a kind of a one-time thing because of the election cycle. Well, actually, elections have been a part of our revenue base pretty much every 2 years here in the United States since we started the company.
Got it. Jeff Lawson, thank you for joining us to talk through the numbers.
Thank you very much for having me.
CEO of Twilio. Up next, Mike Santoli heading to the Telestrator with a deep dive on some underappreciated sectors, plus an energy drink bubble. I caught up with the CEO of Coca-Cola, got his take on the booming and crowded energy beverage space and the company's new investment in body armor. Those exclusive comments straight ahead.
Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
The declarations that I made yesterday one in which of equality. We will get to 50-50 gender equality by 2022. We created a breakthrough program, benefits program for parental leave, with 8 weeks for all mothers, fathers, and an additional 6 weeks for both mothers.
As the pandemic has unfolded, we've just seen this extra rapid pace of adoption of certain technology. Everybody had to think about grocery delivery, video conferencing, and telemedicine. E-commerce and video meetings are now part of the fabric of culture around the world. That's not going to change. At CNBC, we really remain committed to watching the data and bringing our readers and viewers the information that's most essential.
Week lower, let's go back to Mike Santoli taking a look at some overlooked parts of the market. I love it when you do that, Mike.
Well, Sarah, sometimes it means, looking at areas where you can understand why people are neglecting them, right? This is basically consumer staples as well as the sort of dividend aristocrats, these companies that have paid dividends for many years in a row. They are being neglected because everybody wants either leverage to the cyclical upturn that we're all expecting or fancy disruptive tech with huge addressable markets and very fast sales growth for many years to come. Well, this is not what this is, but in the process, these areas are becoming relatively less expensive and perhaps attractively valued. So this is a relative PE to the S&P 500 of each of these groups. And you can see that they really did stay in parity with the broad market for the last several years until very recently as the market's gotten more expensive, driven by those cyclicals and big tech. Now, this is the dividend yield, again, relative dividend yield to the S&P, and you get up to, about 50, 60% higher dividend yield than the stated dividend of the S&P 500. Now, why? We know why. Yields are going up on the bonds, so it's not as if everyone is chasing high nominal dividends, but I would argue that that's the environment, especially if you get some volatility in the stock market, where people are going to be looking for dividend growth and stability. So it's giving you a chance perhaps to add some of these boring sectors to a portfolio that could act as ballast down the road.
Mike, thanks so much for that.
All right.
Up next, getting back to growth, we caught up with Coca-Cola CEO James Quincy and got his take on the outlook for the rest of 2021. That exclusive interview ahead. Closing bell back in a couple.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
I wouldn't describe Hong Kong as a sticking point between U.S. and China. Sometimes Hong Kong has been used as a pawn by the U.S. administration. With the new U.S. administration, I hope that they will give us a fair hearing as far as the national security law is concerned.
We're not a protectionist country. Rather, China is trying to become a leader of a new round of globalization.
The pressure on Australia, the boycotts that we're going through at the moment, these are 180 degrees at odds with everything Xi Jinping solemnly told the Davos virtual conference.
It will take some time. I don't think there's, we're going back to where, we were before the Trump administration.
I think still in the early days of the Biden administration, but so far we have seen some companies that are listed in the U.S. returning to Asia, to our market.
We're ushering in the year of the ox. After an unprecedented year of turmoil, we'll look at what's ahead.
The U.S. is in recovery. The rest of the world is starting to catch up.
As China marks a major milestone.
The CCP goes into its 100th anniversary feeling very confident.
And will travel finally get back to normal?
In a normal year, you will see hundreds of millions, maybe 200 million people out there on the move. But this year, probably only at 50%.
All that and more in our special year of the ox, Plowing On.
We are getting a news alert here on President Biden's OMB nomination. Kayla Tausche with the details. Kayla.
Well, Sarah, West Virginia Senator Joe Manchin has just put out a statement saying that he plans to oppose the nomination of Neera Tanden to be President Biden's budget director. Because of the 50-50 split in the Senate, the Democrats cannot afford to give up even a single vote if they hope to pass Tanden's nomination. So this all but guarantees that she will not pass, because Tanden's nomination has emerged as something of a lightning rod for the GOP, who sees her as a highly charged and partisan nominee. nominee for the Office of Management and Budget. We are still awaiting a response from the Biden administration about how it plans to proceed with this, but certainly it would appear that Tandon's nomination is in jeopardy, if not the very end of the road for her, based on Manchin saying that he will not vote for her. Sarah?
That was always going to be the tricky one. Kayla, thank you. Kayla Tausche. Coca-Cola telling us today they do intend to acquire a controlling interest in sports drink company Body Armor. But in a statement, Body Armor says that although Coca-Cola buying a controlling interest in Body Armor is a distinct possibility, reports are premature. While this is one scenario for Body Armor, there are other potential options for the future of the business. Well, I did speak exclusively today to Coke CEO James Quincy and started by asking him about the company's intentions with Body Armor, that investment, and whether he thinks it can eventually take on the market leader, Gatorade.
We made an investment in Body Armor a couple of years ago, and the announcement today is really, in a way, a technical thing because we have to make a pre-filing with the FTC. The opportunity to take a bigger stake comes later this year, and so we have to go through the FTC before anything else can happen. But we're certainly very happy with our Body Armor investment. It's been very interesting. It's bringing new consumers to the sports drinks category, so a great complement for us between Body Armor and Powerade. We're very happy with the investment and the progress so far, which is, of course, why we're starting to begin the process of looking at the puts and calls for the end of the year. But great progress so far.
Is it something that you think you can do, though, eventually take on Gatorade, which still has such a tremendous share?
Yeah, I mean, there's certainly no guarantees in life, but there's nothing wrong with aspiring to be the leader in not just every category globally, but in each country as well. There are countries in the world, some not too far from the US, where we've started very far behind in the sports drinks category, and over some extended period of time, been able to take leadership. I'm not sure I would promise that at all in the US, but we certainly see an opportunity for a portfolio of brands to help the company and its bottling partners do a lot better in sports drinks globally and also in the US.
When it comes to sports drinks and energy drinks in a related category, it does feel like everyone is getting in, whether it's the big companies like you and Pepsi or celebrities. Is this there's obviously very high growth in this category, but is it getting a little too crowded?
Yeah, there are a lot of, I mean, if there's a fast-growing, profitable category, then people are going to try to get in. History would certainly seem to indicate that, exciting categories appear. A lot of people trying to get in, and then over time there's a shakeout, and you get clear leadership with a few other important brands positioned around the leader. And so it does not surprise me that there's a lot of innovation, a lot of interest in, the higher growth, more profitable categories in the broad beverage industry. And it's not that we have to focus. What we have to work at is what is it about what we're going to do with our brands and our innovation that means we will be one of the winners when the dust settles in these or any other new and exciting categories.
Well, part of that has been shedding the underperforming brands, which was huge news this year. Is that process over? Is Fresca safe?
Yeah, at least this time around, we've made our decisions on the portfolio. Clearly, not all of them have been implemented. Some are going to kind of flow through into this year. But we will have a continuous process over time of making sure that each brand that we invest in and support and is supported through the supply chain by the bottlers has the potential for scale and profitability and growth into the future.
So Fresca, just to be clear, stays, because I know there were some shortages this year. There are a lot of fans.
Well, that for the fans of Fresca, rest assured, it's not on the list of going. The shortages in 2020 were very much related to the difficulties in the supply chain, given all the restrictions on COVID and some of the restrictions on the number of cans available in the marketplace. So we did suffer on Fresca and a couple of other brands shortages, which were obviously very disappointing for those consumers, obviously disappointing for us too. We're working to fix all those problems. The can market is still pretty tight in the US, but those were due to supply chain issues, not lack of interest in making the brand available for everyone. So Fresca fans, rest assured.
You're clearly focused on the growth picture right now coming out of the pandemic. And I think it's why Wall Street has been so excited about new categories like alcohol and Topo Chico hard seltzer, which I know is in early days. Where else do you see the biggest growth opportunities in the portfolio? Which brands?
I mean, actually, the biggest growth driver in 21 and probably for the next few years is actually going to be Coke Zero Sugar. The Coke brand, was growing pre-COVID. Actually, Coke Zero grew in 2020 through COVID. And actually, on an absolute basis, is likely to be the biggest driver of growth for the company. And so there's a lot of exciting things happening around the Coke brand. And I think there are a number of other exciting brands. Yes, Topo Chico hard seltzer, some very interesting early days. AHA was very interesting when it launched in the US too. And there's a number of really good brands out in Asia, innovation in Japan and in China. So the important, fast-growing, good margin categories will continue to be exciting. But for us, what's really important, what will make the numbers work for the Coke company, is if we can marry together innovation and increasing the relevance of brand Coca-Cola, and particularly the growth of Coke Zero Sugar, with the acceleration of growth in other exciting categories supported by innovation.
It's also going to be somewhat dependent on the macroeconomic environment, always is. James, wanted to ask you about the U.S., where we've just seen this big growth spurt in consumer spending. Retail sales for January very strong after more stimulus injections. What are you seeing on the ground right now from the U.S. consumer? Yeah,
clearly there's some strength in consumer spending. Obviously, that's still somewhat affected by what degree of lockdown you're experiencing by state or by locality. But we are seeing a reasonable amount of consumer strength. I think there is a degree of pent-up demand, whether it's the US or other parts of the world for, post-lockdown, when we get to a point where there's a greater degree of vaccination, when there's more freedom to go out. And I think that's true because you can see it in the savings rates. And so I think there is some pent-up demand. There are other macroeconomic issues of how government support will or won't continue and in what form going forward, whether it's the US or some of the other European markets. But for now, the consumer is resilient, but waiting. And I think that's the key thing that we will see, hopefully, as we get into the summer.
What about globally? Which spots do you expect to see the most promising growth from the consumer, and which ones are going to be more challenging and slower?
We're already seeing growth in a number of the Asian markets, particularly where COVID programs have brought it under control, and so the underlying fundamentals of the macros are kind of reasserting themselves, and you see growth. We're also expecting to see Europe come back to growth, particularly as we get towards the summer, between the lockdowns, the vaccinations, and the likely natural improvement of conditions due to weather. So we're expecting to see Europe bounce back in the summer as well, and then the other parts of the world somewhere in between.
All right, thanks to Coca-Cola Chairman and CEO James Quincey there. Wilfred, positioning Coke as a reopening play, both on the macro and also on the growth picture. They spoke at CAGNY, the Consumer Analyst Group of New York conference today, and reiterated this target for 4 to 6% organic revenue growth. And it is built on innovations and M&A, like the stake in Body Armor, which they do intend to increase to a majority stake. They also said they're going to be investing in Coke Energy. So really positioning for those areas of the portfolio. Coke Zero Sugar, he said, is going to be the big winner for growth in the next year and years to come, versus the brand Coke and Diet Coke, which of course are the biggest parts of the portfolio, but not the fastest growers.
The alcohol-based stuff I find so interesting as well, as you discussed with him. At the moment, it's just dipping the toe in, but clearly a huge amount more they could go into if they just decide, well, look, why do we need to be a non-alcoholic company anymore? So many spaces they can go to long term. But the other area that's kind of interesting, not necessarily Costa on its own, but I remember you talking about this recently, the sort of mixture.
I knew you were
Coke.
going to go there.
But the Coke and coffee in one rather than just the Costa.
Yes. Yes, Coke Coffee. It's a new beverage that they tested out in Japan, which is where they often do a lot of their tests in that market, and they are taking it more global, and they are taking bigger risks when it comes to the innovations to play into consumers' taste. Coffee has been a big growth category, not as fast as energy drinks, but up there. And so they have done the Costa Coffee deal. That is a source where they can expand, which they really have not done. They were sidelined by the pandemic, and also release this Coke Coffee and see if it sticks. I like it. I think it's pretty good.
I haven't tried it yet,
a lot of
but
caffeine.
need to see Costa as well, more broadly available. We always discuss that. Anyway, we've got to go. Still to come, two big-name theme parks making a push to reopen amid the pandemic. The full rundown ahead. Closing bell back in a couple.
When can we expect some of these bottlenecks to be ironed out? How long is this supply shortage going to persist for?
So the manufacturing process is quite a complex process, and it takes quite some time to get new tools into the fab and to qualify it. So therefore, from that perspective, we need to assume that this situation will take several more months until we can see a relaxation in the overall supply chain.
Daybreak in the US.
Trade nerves all around. Tech stocks down again today.
Start on top of the news. Brian Sullivan, Worldwide Exchange on CNBC.
The stories and opportunities driving Wall Street and investors. Tyler Matheson, Melissa Lee, Kelly Evans. Power Lunch. Weeknights on CNBC.
News update with Rahel Solomon. Hi, Rahel.
Hi, Wolf. Hello, everyone. And here's what's happening at this hour. Just a day after South Carolina's abortion ban went into effect, a federal judge has temporarily suspended it. She will hold a hearing on extending the suspension on March 9th. Kim Kardashian has filed for divorce from Kanye West. That's according to multiple reports. Their celebrity marriage had reportedly been on the rocks for months now. The couple tied the knot 6.5 years ago and have 4 children together. And NASA releasing some stunning pictures from Mars, including the Perseverance rover during its descent to the planet's surface, and also the first full-color images from the probe. And take a look at this video. This is truly shocking. Keep your eyes on the middle of the screen. We'll put that up in a moment. A woman is lucky to be alive. Here it is after her car tumbled off a Wisconsin highway ramp. So the local sheriff's office there says that she was driving impaired when she lost control of the vehicle. She shockingly escaped with just back and neck injuries and a broken arm. Hard to believe, Sarah, but walking away with relatively minor injuries compared to what could have happened when you look at that video.
Oh my God. Rahel, thank you. Rahel Solomon. Sure. Up next, a fintech game changer. Chicago Cubs owner Tom Ricketts merging his bond broker with a Silicon Valley-based fintech startup. He joins us next with all the details. Closing bell. We'll be right back.
NatWest has reported a full-year pre-tax loss of £351 million. The British lender also confirmed it will exit the Irish market after more than 100 years of operations.
It was a really challenging year, but we really believe it was the year that as a group we really stepped up. It's disappointing to deliver a loss, obviously, but when you look at the operating profit pre-impairment, we were up 4%, and that, I think, in this environment was a really good outcome.
On the next Managing Asia, the man running Singapore's largest supermarket chain, FairPrice Group.
Before those gone orange, we could already see, the build-up of crowd at our stores. They were buying like there's no tomorrow. We are managing stockpile, covering a few key categories. We have had to review and rethink many of our strategies.
Seah Kian Peng, CEO of FairPrice Group, on the next Managing Asia.
Missed the show? Don't sweat it. The Halftime Report now has a podcast. Market-moving interviews, call of the day, unusual activity, and of course, Ask Halftime. Look for us on Apple Podcast or your favorite podcasting app and subscribe to the Halftime Pod today.
In Capital, an underwriter and distributor of fixed income securities announcing plans to merge with fintech company 280 Cap Markets this week. The new company will be called Inspirex and will focus on improving fixed income distribution and trading. The deal is expected to close by the end of Q1 this year. Joining us for more on a first on CNBC interview, In Capital co-founder and chairman Tom Ricketts. He's also chairman of the Chicago Cubs. Tom, great to see you. Thanks for joining us.
Oh, it's great to be here.
So reading through the press release and some other information around this, the main reason for the deal is to boost your tech capabilities. Is that fair?
Oh, well, that's part of it. I mean, I think it's one of the few mergers where 1 + 1 really does equal 3 because it's such a great fit for both companies. First of all, I want to say congratulations to the CEOs, John Dupre and Gurinder Ahluwalia of 280. They did a great job. Their teams worked really hard to get this done. But the reason it works so well is In Capital has always been about using technology and user-friendly product design to democratize the investment markets. Whether that's in traditional taxable fixed income corporate bonds, things we've done along those lines, or we're also the leading distributor of market-linked securities for people that do equity investments that want to build in different types of return profiles. So we've always had that. But the fit with 280 is great because first of all, they bring in a deep expertise in the municipal market where we've been more taxable historically. Their underwriting and trading of municipal markets is completely accretive to everything we've ever done. And secondly, they bring in the bond nav system. And what the bond nav system is it's a cloud-based system where we aggregate different platforms, all the information on bonds from different platforms. So like whether you're an RIA or a wealth manager or an institution, if you're looking for a bid or an offer, you can get the maximum amount of information. And then once you put the trade in, once you put that order in, one of our traders will take a look and see if there's a way to get some price improvement for you. And in about 70% of the cases, you can find price improvement. So in the end, that's really good for investors. And if you're an RIA or a wealth manager or an institution like that, you should be on our platform. There's about 370 firms now, and we expect that'll grow rapidly over the next few months. So it's a great fit between two companies, and I couldn't be more excited about it.
What about, Tom, retail investors? Clearly, there's been a massive surge over the last year. Are you expecting to capitalize on that surge and expect retail traders to embrace some of the more complex fixed income, mortgage-backed security structured products moving forward?
Well, it does. You know, we do serve a lot of retail investors, individual investors, and our product design has always been about making bonds simple, making bonds easy for people to purchase, giving their advisors a lot of tools to create simple ladders and manage portfolios for investors. I don't see a lot of individual investors coming out and trading. I don't know if there's any GameStop analogies in the bond market. And we wouldn't recommend you do that. In the fixed income world, what you want to do is be steady, build ladders, be consistent, don't time anything, don't try to outthink anybody, just be consistent. And with our equity link products or our market link products, there's a lot of ways you can hedge your exposure to the stock market through various return profiles. So anyway, I don't think a lot of traders are going to be running through this platform to do GameStop type trades.
Tom, in the time that we have with you, gotta talk a little baseball, of course. Do you think we're going to have anything resembling a normal season as vaccinations go out?
Yeah, I certainly hope so. Obviously, pitchers and catchers are down there right now. The full team's reporting in a couple days. It'll vary by state, by location, how many people will be allowed in each ballpark. You know, we're hoping to have people in Wrigley, you know, as soon as we can, and have that grow over the course of the summer. So I hope that with vaccinations and better treatments and better testing, by the end of the summer, it'll feel like a regular baseball game.
I think baseball fan Dr. Fauci has said as much as well. Tom Ricketts, thanks for joining us.
Thank you.
On the new investment. We appreciate it. Up next, a double dose of theme park news. Hong Kong Disneyland is reopening again. It looks like Six Flags isn't too far behind. All the details when Closing Bell comes right back.
Scampi. Crustacean.
Boiled shrimp. Divided by distance, united by business.
This is the new reality we're all
Helping you navigate the new normal. Squawk Box on CNBC.
For retail, actually, we don't want to get into long leases at the moment because, you know, we don't want to lock ourselves up. I think this is definitely the bottom of the market. You know, with the fourth wave ended, social distancing measure is lifted, I think, you know, I'm hoping that the worst is over for retail.
The news cycle is racing along. We have to be checking every bit of it along the way because one false narrative can change the course of how we respond to this pandemic. And we can't let that happen. We're going to do our dead level best to get it exactly right and never tell people how to think about it.
In theme park news, Hong Kong Disneyland is reopening again, and Six Flags has big reopening plans of its own. Julia Boston here with more. Julia.
Well, Will, this is the third time that Hong Kong Disneyland has reopened since it shut down due to COVID over a year ago. Now, Hong Kong Disney is the least financially meaningful of Disney's parks. That's because Disney owns less than half of it, and that park's performance has lagged in recent years. But this reopening, even at limited capacity, does represent a light at the end of the tunnel for Disney's parks business, which just reported a better than expected quarter. Now, as of today, it means that the majority of Disney's parks are now open, and that's meaningful because back in 2019, the parks accounted for 37% of Disney's revenue in that fiscal year. Now, this all comes as Six Flags announces it's preparing to open all of its theme parks and water parks, saying they are hiring and they are working with state and government officials to set firm reopening dates. Shares of Six Flags gaining nearly 5% today. Guys?
Julia, my question is on demand. So these parks are slowly and surely opening with no doubt lots of safety precautions. Are people coming? And are ticket prices having to be dropped? Are there promotions to get them in?
Well, I know for Disney at least, because we did get those quarterly results, which in the U.S. were really just reflecting what's going on in Florida. At Disneyland, at Disney World in Florida, the demand has been significant. And they said even as they've been looking at bookings further out, Disney says they've been reassured and excited to see that kind of demand. So I think it probably depends on the market. Here in California, there's no sign yet of when the theme parks will be able to reopen, though there has been some back and forth with the government on setting some dates there. But Sarah, it seems like people are excited. There might be some pent-up demand there.
Julia Borston, thank you. Up next, Etsy, Virgin Galactic, Airbnb, DoorDash, and many more names set to report next week. We'll tell you what you should be watching for straight ahead. And February is Black History Month. All month long, we are honoring some of our CNBC contributors. Here's CNBC contributor Jason Snipe on the importance of being active in your community.
It's important as a successful professional to give back to your community. It's very easy to forget where you came from. There's a generation that's coming up behind us that we need to impart the same knowledge that was given to us. And that's how you be an active participant in your community.
Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
I'm not quite sure at this stage. I mean, we certainly want to get back to a 70% payout ratio as quickly as we can, but we just do want to be have confidence in see more stability and confidence in our future revenue before we do that. So I think going to 60% now is a good sign that we have a good level of confidence. We'd like there to be a bit more. So it may be the full year, but it could be later than that too, just depending on how this half pans out.
She's a courageous corporate strategist.
She had a very high ambition and drive to succeed.
Fearless philanthropist.
To give such a transformative gift is incredible.
And Grammy-nominated musician.
Music is what I am. Everything else is what I do.
Defying all convention.
I've broken boundaries because I didn't know they existed.
The Brave Ones. Chandrika Tandon on CNBC.
Time for your Wall Street look ahead. Another big week of earnings on the docket. We will hear from the likes of Home Depot, Square, Macy's, Salesforce, Airbnb, and DoorDash also set to report for the first time since those two went public. And guys, we've also got a big decision day on Friday. The FDA panel of experts is meeting to weigh the J&J vaccine, whether it will grant emergency use authorization, which could open up another 100 million or so doses of supply, a promise to the U.S. government. And that's been a driver of all this good sentiment, Mike. Even though the markets did take a step back this week, they still remain right near all-time highs.
Yeah, without a doubt. I mean, the case count's really crashing faster than most people thought nationally, and all that stuff is fed into this idea. And really, it's a universally shared premise right now that the economy is kind of spring-loaded to have a pretty big acceleration in the coming months. So I don't know that, the approval of the J&J vaccine is going to really help or hurt that notion, but I definitely think it's in the hands of the bonds market, as we've been talking about all week. Treasury yields rushing higher and pricing in this sort of more normal type economy. And right now it's all to the positive. But at some point it becomes, slightly less loose financial conditions are a result of it. And you have to see how the markets do digest that.
And Mike, for a week that does feel like it's a negative week, and it certainly was for the S&P 500, though not for the Dow, not a terrible week by any stretch of the imagination. And if this is what a pullback is for the rest of the year, then not too bad at all.
Well, that's right. I mean, you can't guarantee that all pauses like this are going to be this calm and shallow and, all dips bought pretty quickly. I do think you have to balance the view that the market is extremely resilient with the idea that it also has kind of lost a little bit of momentum. And I'm talking here about just the large cap indexes, because they really are influenced by all those big, huge growth stocks that are under pressure. So I think you had a lot going on underneath the surface. I keep saying it all week. The cyclical stocks, the financials did great. So much of the speculative stuff continues to fly, the SPACs and all the rest of it. So it's almost like two parallel markets.
There's also earnings. I mean, we're still kind of knee deep into it. So far, the numbers have been better. The outlooks are coming back. Mike, is there a single mover you're going to be watching next week that we'll be reporting?
Well, I know we're going to get some of the early looks from Airbnb and DoorDash. So, you've had a pretty pronounced pattern in general of stocks not trading well off of numbers. But those are two story stocks that people are just, usually willing to just play the more distant hopes and dreams. And then, Salesforce, now a Dow component, we're going to get their numbers on Thursday.
As Mike mentioned, yields, one of the big stories of the week, the 10-year ending at 134, 30-year at 213. Stocks were mixed for the week as a whole. S&P and NASDAQ lower, Dow fractionally higher. We're out of time here on Closing Bell. Thanks so much for watching. Have a wonderful weekend. Fast Money starts right now.
I'm Melissa Lee, and this is